Good morning, everyone, and welcome to the first trade on Yahoo Finance for this Thursday, October 1st. I'm Alexis Christoforous, along with my co-host, Brian Sazi. Stocks are set to kick off the fourth quarter with a big rally, and that is despite new reports this morning that show the economic recovery is losing steam. The number of Americans applying for first-time unemployment benefits held steady last week at 837,000, while a separate report showed consumer spending rose 1% in August. At the same time, household incomes fell 2.7%. Investors, though, seem to be taking it all in stride. Taking a look at the futures now, we've got Dow futures up 187, Nasdaq futures up 165, and S&P futures climbing about 29 points. Despite a rough September, the S&P 500 and the Nasdaq had their best third quarter in a decade, with the S&P adding 8.5%, the Nasdaq rose 11%, and the Dow climbed 7.6% from July through September. That is its best third quarter in 2 years. Yahoo Finance's Emily McCormick joining us now for more on today's economic reports. Let's begin with those jobless claims. Emily, what else can you tell us?
Well, Alexis, taking a look at this jobless claims report, we did have a better than expected print on those seasonally adjusted new weekly unemployment claims. Those came in at 837,000 last week for a print better than the 850,000 expected and upwardly revised 873,000 during the prior week. Now, this marked the fifth straight week that new jobless claims came in below the 1 million mark. We also saw a decline in the seasonally unadjusted claims figure to reaffirm that improvement. Now, that said, we're still well above pre-pandemic levels when it comes to new claims, since those had been coming in at a rate of about 200,000 per week as recently as February this year. Now, taking a look here by region, want to point out that the majority of states did report improvements in unadjusted new claims last week. That was led by Florida with a decline of over 9,600 claims to about 29,000. Now, Texas and Georgia also reported sizable declines in new claims. Now, one quirk from this jobless claims report that I want to highlight is a technical note that the Labor Department included, which is that California has announced a 2-week pause in its processing of initial claims for unemployment insurance benefits. Now, if you take a look at this report, we did see those claims for California apparently holding steady at an unadjusted basis at 226,000. But again, that's because California is pausing its processing of these new claims. So something to watch in the reports to come if we see some give back there. The last thing I want to point out here is that we did see continuing unemployment claims actually fall below the 12 million mark for the first time since April in this week's report. We saw those come in at 11.77 million, better than the 12.2 million that had been expected. Alexis?
And Emily, what's the latest on Pepsi? Earnings out this morning. So far, so good.
Absolutely, Brian. Taking a look at those PepsiCo third quarter earnings, we saw net revenue of $18.1 billion, better than the $17.2 billion expected. Core earnings per share of $1.66, ahead of estimates by 17 cents. Now, taking a look at those results, those are driven by Quaker Foods North America and Frito-Lay North America, with both of those units organic sales up 6%. So still seeing that pantry stocking among consumers during the pandemic carrying over into this third quarter. I also want to note that PepsiCo's North American beverage unit returned to growth on the top line with organic sales up 3%. That followed a sales drop in the second quarter when a lack of live events, restaurant dining, and a drop in convenience store purchases had hit that beverage revenue. The company also gave guidance for the full year earnings that top consensus estimates, and the company does see full year core earnings of $5.50 per share, better than the $5.36 consensus had been looking for. Brian and Alexis.
All right, Emily, and I want to mention we're going to dig deeper into that PepsiCo report with the company's CFO, Hugh Johnston. He's going to be joining us here on the first trade at 9:40 Eastern. Also, before we let you go, Bed Bath & Beyond reporting a nice profit report here. First same-store sales increase in nearly 4 years, and I guess it looks like e-commerce driving things higher there.
Absolutely, Alexis. E-commerce really the strong point here. We saw digital channel growth of 89%, which more than offset an about 12% decline in comparable store sales at their physical locations. Now, that was good enough to bring their comparable sales up 6% in the quarter. Consensus estimates have been looking for a 1.3% decline. So that surprise upside we saw in that top line growth really helping propel shares here in pre-market trading. We did see those higher by as much as 21%, Alexis.
All right, thanks very much, Emily. Well, one thing investors don't have to worry about this morning, a government shutdown. Very early this morning, President Trump signed off on a short-term spending plan that will keep the federal government running into early December. But another round of stimulus, well, that's another story, with the House and Democrats still pretty far apart and more talks set for today. Our Jessica Smith has been following it all. She joins us now. So Jess, where do things stand at the moment?
Well, negotiators are going to give it another go today. They'll be making a last-ditch effort here to get a deal before the election. Democratic leadership postponed a vote on the updated HEROES Act at the last minute yesterday to try and give both sides more time to come to a deal. Right now, they are still pretty far apart on this. Democrats are still at $2.2 trillion. And the White House Chief of Staff, Mark Meadows, told reporters yesterday that the latest White House offer is above $1.5 trillion. But he says anything that starts with a 2 is going to be a problem for Republicans. Now, Bloomberg reports the White House latest offer includes about $400 per week in enhanced unemployment benefits. That is up from the $300 that the White House had offered previously, but it is still below what Democrats are pushing. They're pushing $600 a week. Another sticking point is state and local aid. In the updated HEROES Act, Democrats are asking for $436 billion. Reportedly, Republicans are now saying that they could offer $250 billion. So that's more than $100 billion more than what they had offered prior, but still not nearly what Democrats are wanting to see. So even if Mnuchin and Pelosi are going to come to a deal, even if they're able to get that done, and that still would require a lot of work, it's not clear that Majority Leader Mitch McConnell would be on board. Senate Republicans could still be a big problem here. There are still a lot of moving pieces. We are set to hear from Speaker Pelosi later this morning in her weekly press conference, so we'll be watching for any sign of progress.
And Jessica, who else is watching for signs of progress? Airline executives.
Yeah, exactly. And we heard from White House Chief of Staff Mark Meadows yesterday. He told reporters there is that sense of urgency as you have the airlines set to start making layoffs today. The White House proposal, according to Meadows, has $20 billion in aid for airlines. The Democratic proposal has $25 billion. So again, we'll be watching to see what they come up with, if they're able to come to an agreement, what number the airlines will get there.
All right, thanks a lot, Jess. We're going to be talking more about the airlines with a Cowen analyst a little later on in the show.
All right, Yahoo Finance's Oscar Williams joins us from the UK. Oscar, I know all morning long you've been tracking the pound under pressure this morning.
Well, Brian, it's been a bit of a roller coaster ride today for the pound. It took a real dive around mid-morning after the EU Commission chief Ursula von der Leyen came out and said that the European Commission had sent a formal notice of reservation to the UK over its internal market bill. Now, what does that mean in plain speak? Well, essentially, the EU is taking legal action against Britain for threatening to break the Brexit withdrawal deal. You remember, this is a row that's been going on for around a month now, centered around Northern Ireland. Britain says that they are simply trying to protect trade with Northern Ireland. The EU say that they are breaking international law and threatening to destabilize peace on the island of Ireland. An almighty row. Now, the UK was given until the end of September to try and resolve this conflict. They didn't, which is why today we're seeing the first stages of this legal action against Britain. Now, as I said, we saw the pound take a dive against both the euro and the dollar earlier this morning, down about 0.7% at its worst point. However, since then, it's really turned around and is trading more or less flat against both currencies. That's because we had a political reporter here in Britain for the Financial Times who tweeted saying that there was growing optimism around Brexit trade negotiations. These have been going on since Tuesday and are due to conclude tomorrow. The reporter in question said that both sides are now pretty optimistic that they could enter the tunnel by tomorrow. The tunnel is the super secret final part of trade negotiations. So some optimism there.
Oscar, that move in the pound, are you seeing it bleed over into European markets?
Well, Brian, actually, the stock markets have largely been ignoring the latest news flow around Brexit today. Instead, investors are focused on the hopes of a stimulus in the US. This has, of course, been a major theme around global markets all day. They were trading higher this morning, but have since tailed off a bit. The FTSE 100 and the DAX are more or less flat now, while the French CAC 40 is up about 0.5%. There is one particular big mover I want to pick out today, which is Rolls-Royce, the UK engine manufacturer. Their shares are down 10%, hitting a 17-year low today. That's after they announced plans to raise £5 billion in debt and equity to repair their battered balance sheet. Now, the reason we're seeing it trade so low today is because part of that plan includes a £2 billion rights issue, which is deeply discounted. So clearly, they are in a lot of pain today.
Clearly. Oscar Williams-Groot, thanks so much.
Thanks.
All right, coming up on the first trade, we're going to take a deeper look at thousands of layoffs announced today by two major airlines. What does it mean for travelers as well? We'll be right back. The airline industry continues to tighten its belt during this pandemic. Today, we learned that both American and United Airlines will move forward with laying off more than 32,000 employees. This is after Congress failed to pass a last-minute deal for a broad coronavirus relief package. Joining us now to discuss is Helene Becker of Cowen Securities. Helene, always good to see you. Before we get to your take on the airlines, because I understand you're still quite bullish. Are we done here with the layoffs, or is this just the tip of the iceberg, unfortunately?
No, this is just starting. So two things have happened in the last 6 months. The first is that most of the airlines have gone through a process where they've had voluntary furloughs or voluntary leaves of absences, I guess is the right way to say it. And then they've all given notice to their employees that will be affected by layoffs that they're going to be furloughed today, which is, obviously the day after the money runs out, unless there's an extension of the CARES Act funding. And that's just because you're looking at traffic numbers right now that are equal to where we were 40 years ago. And you can't run an airline like that, right? You can't have 800,000 passengers a day when a year ago we would have had 2.3 to 2.5 million passengers a day. So until we get caught up, what the CARES Act did was twofold. One, it kept airline employees in jobs. So from that perspective, we view it as a jobs program. And then the other thing it did was give airline executives a chance to look at their networks and figure out what works and what doesn't, and scale the airline to the new size. Alexis, it's kind of interesting because I think a lot of executives thought this would be short-lived and would be similar to what happened in China, where they had basically a V-shaped recovery. Their number of flights per day is back to where it was a year ago, about 13,000. Passenger traffic is only down about 3% in the domestic market. There's not a lot of international going on, but domestic, they're down only 3%, and we're down 70%. So we're still not near recovery status.
Helene, airlines are huge employers in this country. Can you give us a sense of the economic impact of the airlines laying off this amount of employees? It's not just the airlines. You have part suppliers. You have companies that refurbish parts. There's huge ramifications here for the U.S. economy.
Oh my gosh, this is so horrible. The pain is uncalculable, right? Or incalculable. So here's how I think about it. Travel and tourism is 5% of US GDP. So that's a big number right there. I think we have we had a $20 trillion economy. So 5% of that is just enormous, A. And B, the other way to think about it is for every one airline job, it creates 13 jobs behind it in restaurants, taxis, ride shares, hotels, airport workers, and so on. So, I mean, the damage to the economy is pretty significant, because if the US airline industry doesn't recover and isn't there to help the US economy can't recover. You can't have a strong economy without a strong airline industry. And that's so important. And, it's unfortunate that we're caught up in this situation, which is partly political and partly a function of this virus, which obviously people, 9 months ago, 10 months ago, didn't see coming to the United States.
Helene, when are you forecasting a recovery, or, dare we say pre-pandemic levels for travel? I'm seeing things go out as far as 2024. And if that is the case, are you a buyer right now? Do you have any sell ratings on any of the airlines at the moment?
So yes and no. I mean, a lot of questions in there. So for starters, we think it's a 3 to 5 year recovery process for domestic, and probably 5 to 7 years for international. So let's just say 4 to 5 years in general, right? That's number one. And, I think business traffic is going to start to come back. I mean, one of the issues is, if you think about the 2.5 million passengers a day we had a year ago, think in terms of 40% domestic leisure, 30% international, and 30% business. So, we're already at about 800, 900,000 passengers a day on most peak days, and it's clear there's pent-up demand. So you're talking about, I think at the holidays, we'll have 1 million passengers a day traveling by the end of the year, and that won't continue into the first quarter because it's generally a weak quarter anyway. And then for business traffic, if you think that 30% number, that's probably 700,000, 750,000 a day. I think business people will want to get back on the road. They might not get back on for the 1 hour meeting that they can easily do the way we're doing our meeting today. But I think they're going to get back on the road. So we're thinking maybe 500,000 passengers. It's what's the definition of recovery, right? My definition is pre-pandemic levels, takes 3 to 5 years domestic and 5 to 7 international. I think for the airlines, though, if they're seeing, some traffic, business traffic being down 50% instead of 90% would be, a win. If you're seeing, leisure traffic kind of flattish, that would be a win. Borders have to reopen for international traffic to come back. I personally think there's huge pent-up demand. And in that regard, I'm a little more optimistic than I was 6 months ago when I thought, one of the reasons it would take so long for the economy, or for airline traffic rather, to get back on track was because so many people were losing their jobs. They weren't thinking about, going on a vacation. They were thinking about how they were going to pay rent, utilities, and buy food, for their families. And I'm a little more optimistic now, just that we're seeing that demand around holiday weekends. So I think there's pretty good pent-up demand for that. That said, the second part of your question was with respect to our buys and sells. So we're kind of neutral on the group. We have 7 buys and 7 holds. And our view is that if we're back to, let's say 1.5 million, 1.8 million passengers a day by June of next year, I think the industry will be fine. But if we're still bouncing along this under 1 million and people are afraid to travel and there are quarantine measures in effect, it's going to be really hard for this industry to get through without liquidations and more job loss. I mean, like at the beginning, you asked me if this was, the start, and it is the start. And it's just going to be a long road back.
All right, we're going to have to leave it there. Helene Becker of Cowen Securities, thanks for being with us.
Yeah. Thanks, Alexis.
Thank you. Well, there has certainly been a steady stream of misinformation and falsehoods about the coronavirus since the beginning of this pandemic. And a new Cornell University study finds the #1 driver of that misinformation has been President Donald Trump. Our editor-in-chief, Andy Serwer, is joining us now. Good morning, Andy. I know you sat down recently with Gail Smith. She's the CEO of the One campaign, and you talked about this among other things.
Yeah, that's right, Alexis. And Gail Smith was the head of USAID during the Obama administration. So I guess you could suggest that she's partisan. On the other hand, she is looking at facts, she's looking at data, and she talks about the president's response to COVID-19 and finds it troubling. Here's what she had to say about that.
The response to the Ebola epidemic was extremely difficult. But I think one of the ways we were very effective, where I think we've got a contrast to right now, first was a tremendous reliance on facts, data, science, and expertise. And the American people are blessed by having huge talent within and among our U.S. government agencies. So we had a foundation to work with. Because fighting a virus, it's a science. There's data, you can track it, you know where it moves. So it's like an engineering logistical exercise at warp speed. So I think that was one, and we're seeing less of that, quite frankly, now. I don't think the response to the Ebola epidemic was not politicized. There was a little bit of political noise at certain points, but when, for example, we went to Congress to get supplemental funding for the global response, strong bipartisan support. And I think, unfortunately, the response has become quite politicized today. I think the biggest difference, though, and it's the one that in many ways I find the most troubling, is that we are not seeing a global response, and we are not seeing American leadership in marshaling that global response.
One point that is unassailable, and we hear this again and again, is that we lead the world in the number of cases. And there's really no denying that, and no getting around it, and no explaining it away other than we're not stepping up. And then, of course, by extension, we're not stepping up in terms of global leadership, you guys.
Andy, what was Smith's take on President Trump doing battle with the World Health Organization?
Yeah, she said it was really a tragedy that we had withdrawn to the degree that we had from WHO. And she had a metaphor, Brian, where she said, well, maybe you don't like the fire chief, but when your house is burning down, you don't burn down the firehouse, because that's not going to help your situation at all. And she said, as many have said, Bill Gates included, that WHO isn't a perfect organization, but the point is you want to engage, and it's a global organization tied to the UN, and it's only as good as its members. So simply withdrawing is probably not the answer. You know how President Trump really doesn't truck with organizations that have the word world in it. And so this is yet another example of that.
All right. You can catch the full interview with Gail Smith on Influencers with Andy Serwer tonight at 5 p.m. Eastern on our website, yahoofinance.com, or from your favorite streaming device on our app. Thanks a lot, Andy.
Thanks.
All right, coming up next, 6 minutes away from the opening bell, we're on track to open much higher. We'll talk about what's moving this market right after this. It's been a busy morning for earnings reports. Jared Blickery has been tracking all the action. And Jared, looks like ConAgra beat on both the top and bottom lines.
Yeah, first the numbers here. And by the way, the shares are up about 2.25% in the pre-market. First quarter adjusted EPS came in at 70 cents a share, and that's versus 57 cents estimate, and also much higher than 43 cents a year ago. Net sales came out to 2.68 billion. That's an increase of 12% year over year, and also higher than the Wall Street estimate of 2.61 billion. Organic sales were up a whopping 15%. A year ago, they were down 1.7%, and they're boosting their quarterly cash dividend by 29 cents. It's up to 27.50 now from 21.25 earlier. And they had a pretty interesting investor presentation where they were talking about people spending more time in their homes, and they think it's a trend that's going to continue. They mentioned higher Netflix subscriptions and rising demands for small appliances as well. So basically, they think they're going to have more new buyers to its products than their peers, and they've also been seeing gains against millennials, gains from millennials. So we can see the stock is up still about over 2% here in the pre-market. And on a year-to-date basis, well, this is over the last 6 months, up 21.7%. And year-to-date, they are up just a little bit, 4.29%. Also taking a look at Constellation Brands, because they also beat on their top and bottom lines. Second quarter comparable sales that came in at $2.76 versus $2.72 year over year, and the estimate was for lower, $2.53. That's comparable EPS. And comparable net sales came in at 2.26 billion, and that's down 3.6% year over year. Alexis?
All right, thanks a lot, Jared. We are just seconds away from the opening bell on Wall Street, but I want to talk about chip stocks for a minute because I'm seeing Tesla Tech leading the Nasdaq higher, and we know the Nasdaq's coming off a pretty good third quarter, up 11% from July to September.
Yeah, interestingly, it was the best third quarter for the S&P 500 in about 10 years, but also the worst September in about, I think, 7 to 9 years. So interesting situation there. But tech is leading this morning. We've got a number of semiconductor names. We can look at the Wi-Fi interactive heat map here, and we can see that NVIDIA is up 1.7%, ASML 1.6%, Broadcom up over 1%. And just looking at some of the sector action early on, we can see that indeed, tech is up. It's leading the way higher, 1.4%. Discretionary is up 0.2%, Alexis.
Yeah, and interesting that stocks can hang on to those early gains despite not great news on the labor market at all this morning. And here you have your opening bell on. All right, Thursday trading now underway. We saw futures rallying into the open. The Dow's going to start the day up 165 points. And here are the headlines making the first trade front page. Unemployment lines got a little shorter last week, but they are still historically high. The government says 837,000 people filed for unemployment benefits last week. That's compared to the 850,000 that Wall Street was expecting. Continuing claims came in at 11.7 million, below the 12.2 million expected. But there is a chance that we're going to see those jobless claims numbers rise in the coming weeks. And that's because today we learned that American and United Airlines are going to lay off a combined 32,000 workers. And that's because lawmakers still have not approved a financial relief extension for the airlines. American promises to bring those jobs back if an aid package is approved. Airlines and labor unions are pushing for $25 billion in relief funds, which will cover workers' salary for another 6 months. And we learned just moments ago that Delta's CEO, Ed Bastian, told flight attendants and frontline ground employees that they will not have furloughs. So mixed picture there from the major airlines today. And our third front page headline today, California now going to require diversity in the boardroom. Starting next year, publicly traded companies that are headquartered in the state will have to have at least one racially, ethnically, or otherwise diverse representation on their corporate boards by the end of 2021. A recent report found a little less than 17% of large cap company boards have at least one racially or ethnically diverse member. All right, we're a minute into the trading day. Stocks higher across the board to kick off a new month and a new quarter. We'll be back to break it all down right after this. 4 minutes into a brand new trading day on Wall Street. And what a way to kick off the fourth quarter. We have got the Dow up more than 200 points, the Nasdaq rallying 130, and S&P up now more than 30 points. Let's dive into the markets here now with Gabriela Santos. She is global market strategist at JP Morgan Asset Management. Good morning, Gabriela. You know, this market continues to defy reason, right? We've got a very toxic political backdrop. We've got a global pandemic, yet the Nasdaq and S&P hitting record highs during the quarter. Would you characterize this as a new bull market?
Good morning, Alexis. Yes, we would. A new cyclical bull market within what's still a structural bull market. And I think that is such an important point because it means that really equities are still the growth piece of a portfolio. It's so important to have enough exposure to it, especially if an investor has a longer term horizon. And in terms of this more recent direction over the past few months, I think it has a lot to do with the direction of travel. We started a brand new economic and earnings cycle. It's slowing down in terms of momentum, but we're still moving in the right direction. And it also has a lot of monetary and fiscal support associated with, which is not expected to be removed anytime soon. The issue is a little bit for us, the short term, October, November, December, daily volatility can stay a bit high. So we want to have some protection for the volatile ride, but the destination is still a very positive one.
Gabriela, I think so many folks, so many investors are looking around that next corner on what might take down the market in the fourth quarter. But what are some upside risks to the market in the fourth quarter?
Yeah, that's a good point because we always think about risk as being only to the downside, but it can go either way. There are upside risks. When we think about COVID, there are upside risks there. We can have a second round that is not as fatal as the first round of cases. And so we can continue to coexist with the virus better than expected. We might also have some news in terms of the vaccine front. It may get an approval, one of the vaccines, a bit faster than expected. That would give everyone confidence about what 2021 looks like. We also might get a result out of the election a bit faster than expected. We still think it'll take a few weeks, but maybe it won't take a few months as some investors are expecting. And lastly, just technicals. There's still about $1 trillion sitting in cash, more than we had pre-pandemic. That's still a lot of dry powder that needs to be put to work. So you do continue to see investors buy on dips.
Gabriela, do you think that investors have made peace with the fact that it's very likely we don't get another stimulus package before Election Day?
So I think everyone had very high expectations early August because it just feels like a very obvious thing that we absolutely do still need support. Just this morning, getting jobless claims that are still 4 times higher than what we had pre-pandemic. There's still a lot of pain in certain sectors of the economy. Those expectations, though, have been brought down significantly over the past few weeks, just given a lot of the political back and forth in Capitol Hill. So at this point, I think expectations are very low that we'll get a new fiscal package before Election Day. So it would be a nice upside surprise if indeed we did get something there. Our expectation is probably during the lame duck session before the end of the year, we might get something. It's more a question of when, though, not if. So we just need to resolve that uncertainty of the timing.
Gabriela, I want to get your take on the bond market because after consolidating for what seems like a few months here, we saw a bond sell-off, especially on the long end over the last 2 days. We've seen the 10-year yield climb about 6 or 7 basis points. What's behind this and what effect do you think this is having on equities?
So I think it's been a mild increase in 10-year yields, maybe related to a little bit of a better risk appetite here over the past couple of days. But when I kind of zoom out and look at 10-year bond yields, they kind of haven't gone anywhere in months. You've been in this very tight range of a low 0.5 and a really hard time getting over 0.7 on a sustained basis, just a really tight range. And I think that's actually a very positive thing for risk assets. It keeps the risk low in terms of the recovery. And of course, it forces investors to look for returns elsewhere. It is a challenge, though, if you think about the diversification piece of the portfolio. If treasuries stay in this range, they just don't give you the offset when we have volatility in the market. So we can't just have treasuries for diversification. We're thinking much more about the role that investment grade bonds can play, and also combining that with alternatives like gold, real assets, other currencies like the yen. We need to think more broadly about diversification. I think that's the challenge.
Gabriella, what number do you need to see on the jobs headline tomorrow that would keep this rally going?
So I think anything around the 800,000 range, which is around what consensus is looking for, would just confirm that we continue to make progress in job creation, but that momentum has definitely slowed from the million plus that we had. So it's a story of, we had an initial surge in activity. Now it's becoming more of a grind, and that's okay. I think that's expected by investors. So around 800,000 would confirm that positive direction of travel.
All right, we'll leave it there. Gabriella Santos, Global Market Strategist at JP Morgan Asset Management. Great to see you.
Great to see you, Alexis, Brian, and everyone. Thank you so much.
Take care. And coming up next, we're going to speak with PepsiCo's CFO, Hugh Johnston, about their latest earnings report. What is driving growth there? We'll talk about it right after this. PepsiCo did it again, beating Wall Street estimates on the top and bottom line. Its beverage business improved, but it was really the snacks business that was the standout. Joining us now is PepsiCo CFO, Hugh Johnston. Hugh, always good to see you. Good morning. I got to tell you, PepsiCo is one of our top trending tickers right now on the Yahoo Finance website. I know that third quarter revenue grew 5.3%, organic revenue up 4.2%. Can you tell us which product lines got you there?
Yeah, the gains were remarkably strong based. Good morning to both of you as well. We really feel good about, as you mentioned, the snack food business. Globally, it was about 6%, and the North American beverage business, as well as the global beverage business, grew 3%. If we dial into some of the specifics in the beverage business, where I think there was a big surprise on the upside, Gatorade grew high single digits, primarily on the strength of Gatorade Zero, which continues to perform extremely well as a new product. Mountain Dew, a notable turnaround. We've been challenged a bit on Mountain Dew. Mountain Dew grew mid-single digits for the quarter, again, primarily behind the new Mountain Dew Zero product, which we think is going to be a very big idea. And even Pepsi is back to growth. Pepsi was low single digits in North America. So overall, the beverage business did quite strongly. And the snack food business continues to deliver the strength that we've had in recent quarters.
You guys were peppered on the earnings call this morning with regards to COVID-19 costs. If about 150 million impact this quarter and in the fourth quarter, some of these costs, do they start to unwind next year as we start to return back to work?
They will. As we start to see vaccines and we start to see the pandemic move away, whenever that happens, then I'd certainly expect those costs to fade away as well. Look, our first and foremost priority has to be protecting our people, giving them the type of protective equipment that they need, ensuring that we're doing the right level of sanitation, and we'll continue to do those things, obviously. But I do think over the course of next year, those costs will probably fade away over time.
We know you're a global company, international business reporting organic sales growth of 4%. Did you see any pockets of weakness, though, when you look outside of North America? And is part of that tied to the virus and perhaps stricter lockdowns in different parts of the world?
Yeah, you're exactly right, Alexis. If you look at developing and emerging markets, they grew only 2%. Now, historically, those markets have grown somewhere in the 6 to 8% range. And really what you see happening is where the virus is picking up, it clearly has an impact on the economy, which has an impact on our business to some degree. Now, our categories tend to be relatively resilient through economic downturns, but clearly it takes a little bit of the top off of the growth. Latin America clearly has challenges in that regard, and India does as well to some degree. As we get past the virus, I do expect that we'll see those growth rates return back to their high normal levels.
We're getting reports that grocery chains, major grocery chains, are hoarding goods in their warehouses in anticipation of a next wave of COVID. Are you seeing that as well?
We don't see a lot of that because our business model is a little bit different. Recall that we actually bring the product ourselves right into the store. So we go to the back of the store, we put product on the shelves, and we're in most stores just about every day. So we don't see a lot of that. I've heard some of those reports as well. It's not much of an impact for PepsiCo.
One of your large competitor down in Atlanta is getting ready to launch hard seltzer. Any plans for PepsiCo to get in that category?
No, I really don't have any comment on that one. What I would tell you is, as a company, we leave no stone unturned. We look at every growth opportunity. So we'll evaluate all those on their merits, and we'll see if it makes sense for us. But nothing new to report there at this point.
Anything to report on CBD infused beverages? You still looking at that, Hugh?
Yeah, still looking. Same answer. It really is something where we look at everything because we feel like we have an obligation to look at everything. And if we decide to develop a product in that direction, you guys will be the first to know. Right now, our innovation is tending towards things that are a little bit more in the mainstream of what we do. One of the ones I really did want to share with you is this box of Cheetos mac and cheese. Right now, that product is flying off the shelves. We literally cannot make enough. So every box we make, we're selling almost immediately. And I expect over time, we're going to be adding a lot of capacity. We think this one's really a big new idea.
Well, I know I can tell you our producer, Nick Monty, is very excited about that product, Hugh. But what would go good with that are energy drinks. Tell us about the 2021 plans for your energy drink portfolio. You have really bulked up on this business this year.
Yeah, so three elements to that. Number one is obviously Rockstar, which we acquired recently, and we've got lots of innovation plans around Rockstar to really get that business tracking even at a higher and better growth rate than it's been doing. Number two is Bang, which we're distributing, and we're at 85% distribution on that product. It's off to a terrific start. And then Mountain Dew, as I've talked a little bit about in the past, more to come on that.
All right. Thanks for sharing those Cheetos mac and cheese with us. PepsiCo CFO Hugh Johnston, always good to see you.
Thank you. Great to be with you guys.
Coming up next, we're going to break down yesterday's big Pixel event from Google with Renee Ritchie right after this. Google held its annual hardware event yesterday, packing a number of new product announcements into a quick 30 minutes. And as expected, the company unveiled its Pixel 5 and Pixel 4a 5G, but it also revealed a few unexpected surprises. Joining us now to discuss is tech analyst Renee Ritchie. Renee, first off, just what were your thoughts about yesterday's big reveals, and what were the big takeaways for you?
I think it was quintessentially Google in that it was a slightly awkward presentation showcasing mid-range hardware, but with really, really, really good software and services attached to it. Slightly confused messaging, which they seem to actually like, gives them a lot of agility. And I think very value conscious, very affordable products going into the holidays.
Renee, anything that Google put forth yesterday that Apple should be worried about?
I think at the lower end, something like the Google Chromecast, it's super affordable, $50. You attach it to any television, and it essentially turns it into a Google television product. Apple has so far been at the higher end of the set-top boxes, and something like an Apple TV Stick or Apple TV Go, I think, would be a more compelling offering for that.
They also had plans for their Nest business. Now they've got this the speaker. Do you think it's going to rival what's already on the market? I'm thinking Sonos, for example.
Yeah, I think Google's doing a really good job sort of putting everything around the Nest brand now and offering really good computational audio quality. Sonos has always been good at making a mesh network and letting you move music around the house, but Google's really investing in making not just that possible, but making it sound as good as possible from as small a speaker as possible.
Renee, why don't these Google phones ever seem to blow up in sales? Sure, they've turned to a pretty good business for Google. And the phones themselves, they look pretty cool. Why don't they see a really strong rush of demand?
I think Google still internally has no idea what they want to do with phones. Their CFO clearly wants an iPhone. Their team clearly wants to dog food Google technologies. And then they also want to make them affordable. But every year, the Pixel phone is good, but it's completely different. It's almost a repudiation of the phone they made last year. So we saw the Pixel 4 with Project Soli, Face ID sensors, higher end parts. We're deliberately not doing a wide angle camera. And then this year they reverse every one of those decisions. So it makes it hard for them to build momentum year after year like a Samsung or Huawei or Apple will do.
Was there anything that just flat out disappointed you yesterday from the Google announcements?
I think it's still the lack of coherence around messaging. We have Google TV, which is different than the original Google TV, which is different than Android TV and Yahoo TV. I don't think there's a Gmail TV yet, but it wouldn't surprise me. And the same thing, like they seem to have loose opinions, really pugnaciously stated at every event, but then rapidly reversed at the next event. And it makes it hard to build brand affinity, but also they don't get the advantage of making each element of every device better year after year that every other vendor in the space is doing right now.
How will the 5G rollout impact the Google phone business?
I was originally more skeptical about it because there didn't seem to be very much good 5G. It seemed to be mostly driven by finance and marketing departments. But T-Mobile has made some recent announcements where they're putting mid-band 5G. And I think 5G millimeter wave is still going to be hard to find for most people. But increasingly, they'll just get sort of the promise of LTE that was never delivered, especially in suburbs and rural areas. Faster, better quality connections, less congestion, all of those things.
You know, buried in those announcements and those reveals was that Google's going to pay publishers $1 billion over the next 3 years for content for its new Google News showcase. Is that the best use of Google's money, do you think?
It's an interesting concession in that Google borders the line between providing access to other people's content and basically stealing that content. Like if you end up in a Google snippet, either they take so much of your article that nobody clicks through, or they take not enough and everybody clicks through. So it can be a complete boom or bust for you. And they don't seem to be aware of how much influence they have over the livelihood of publishers in that aspect. And I don't think this is an ideal solution, but I think Google hopes this prevents regulation that would lead them to an unideal solution.
All right, tech analyst Renee Ritchie, thanks for stopping by.
Thank you.
Taking another look at the markets, we're still higher, but off our highs of the morning, about 30 minutes into this trading day. Let's check in with Jared Blickery for what he's looking at. Jared?
Well, here we have the Nasdaq 100, and we do see a lot of green. Apple's up about 0.4%, but Microsoft and Alphabet almost up to 1%, Amazon 1.3%, and Facebook even better. Tesla also another outperformer here, up 4.5% over the last 2 days. I do want to get to some news about Ford because we have its new CEO taking the helm only today. And this would be, this is Jim Farley taking over for Jim Hackett. And the company is heading for its first annual loss in a decade, but he has put John Lawler as his new CFO. And this is a 30-year company veteran who headed Ford's autonomous vehicle unit. Now, Farley is saying in a statement that his predecessor had, quote, opened the door to making Ford a vibrant, profitably growing company. Now it's time to charge through that door. And see Ford is up about 0.3% in early trading here. Looking at the auto heat map, Nikola is a standout. That has been an extremely volatile stock, as we know, up 17.5% over the last 5 days. Just looking at over the last 3 months, wow, what a rocky ride here. It's down to about 65%. And we know they have more than a few problems there. Let's take a look at the travel sector. We have a lot of green here as well. Southwest Airlines up 1%, Delta up 1.2%. And this is despite having to potentially axe thousands of employees in the industry due to the expiration of the CARES Act. Also taking a look at the banks. They are outperforming today as we have the yield curve expanding. JP Morgan up about 45 basis points. Bank of America up just 0.2%, Alexis.
All right, thanks a lot, Jared. And again, want to recap one of our top stories for you today. U.S. consumer spending rose 1% in August. Incomes fell 2.7%. That was in part because of a decline in government aid for unemployed workers. By the way, jobless claims held steady last week at 837,000. We've got more to come on the first trade after this short break, so stay with us.
Welcome back to the first trade. And just like that, investors have pretty much put Tuesday's debate disaster in the rear view mirror. Lots of bullish bets being placed again this morning that lawmakers ink a new stimulus deal this week. If they don't, then, well, look out below because there will be stock prices. Inez Ferre standing by with a look at the markets. Inez?
And a deal would certainly benefit the airlines. Some of the airlines already announcing, Brian, that they will start furloughing employees, American Airlines and United, namely. Delta said it's not furloughing today, but the airlines that are starting to furlough say that this is because Congress hasn't been able to come up with more stimulus money to support their payroll. Even though they are, though, starting involuntary furloughs, the airlines say they would reverse those if a deal is reached. And the airlines have been pleading for $25 billion in payroll support to keep workers on for another 6 months. We're also watching Boeing up more than 2% in the green after FAA Chief Steve Dickson took a test flight of the 737 MAX jet. He said he liked what he saw on the flight. He has some debrief items he wants to see going forward, some tweaks he'd like to see on the 737 MAX. He said this test flight was not part of the recertification process, which Dickson says is in its home stretch. The 737 MAX, remember, has been grounded for about 18 months now. Boeing year to date is down about 48%. And then we're watching at PepsiCo. This is after its quarterly results, beating on the top and the bottom line. Net sales grew 5.3%. Quaker Foods North America and also Frito-Lay North America, a big driver, saw organic revenue growth of 6%. Tostitos, Cheetos, and Doritos, those were the big hits for Frito-Lay. Pasta and macaroni and cheese dishes for Quaker Oats, and PepsiCo's North American beverage unit returned to growth with organic sales up 3%, Brian.
Yeah, and as we just talked to PepsiCo CFO Hugh Johnson, pretty bullish on Cheetos, held up a new product, Cheetos mac and cheese. Go figure, that's innovation right there.
Big hit.
Thanks so much, Inez. All right, let's welcome in Gene Todd of Fiduciary Trust. Gene, good to see you here. So we're seeing the markets rally because I would think on hopes of a new stimulus plan. Let's say we do get that stimulus plan. Do you think the upside in the market will continue?
I'm sanguine that we will get it, Brian. I don't think they're that far apart. I think Mnuchin's at 1.7 trillion. The Dems are at about, 2.2, 2.3. So hopefully we'll get it. Right. The art of the deal. So let's get this thing done. I'm confident. We're confident that we are going to reach a deal. There's people out there suffering. There's small business owners that are suffering. You talked about the airlines, 40,000 furloughs, more to come. This economy needs it.
What's the next big catalyst to your mind for this market? Are we just going to be in sort of a trading range until the election and shortly thereafter because of all the uncertainty swirling around it?
I think the biggest thing clouding the market continuing to go higher is states reopening. We've got to get the big states, most of the blue states, to get the cases under control and reopen. We've got an unemployment rate of about 8.3%. It's dropping. It's going to continue to drop. But if you look at New York, it's got an unemployment rate of over 12%. California, 11%. Nevada's high. Connecticut's high. New Jersey's high. Illinois is high. So as these states start to reopen, I think that will be the catalyst that really drives the market higher.
Gene, listen, I talk to a lot of investors, and I still get the sense they're only invested in essentially 3 stocks: Facebook, Apple, and maybe some Netflix, and that they are not prepared. Should we do get that stimulus and things start to improve in the back half of the year, even with the election, what sectors are you focused on?
Yeah, so what's interesting about the S&P, the S&P is up this year overall, maybe 6% or so. But looking beneath the surface, those 3 stocks and add a couple of more are responsible for all the gains. Of the 6%, those 5 stocks are responsible for all of it. 495 stocks are actually down this year. 40% of the S&P is still in bear market territory. So we would look to see cyclicals, small cap, industrials start to outperform as we get the virus under control and these other states start to reopen.
How concerned are you that, the breadth of this market is just so narrow and that's just, not more companies are participating in the rally?
Well, it kind of makes sense. If you look at what's going on from an economic standpoint, things are improving. We got a jobless claim number today, 837,000 claims. That's an improvement, but that's still a lot of people out of work. Retail sales, they're getting better, but they're nowhere where they need to be. Really, the one extremely bright spot out there is housing starts. So I think if you look at what's going on with the data, it explains what's going on more broadly with the overall market.
Gene, you work with a lot of wealthy clients. How concerned are they about their tax bill going up under Joe Biden, especially off what we saw off of President Trump's tax returns this week, where, according to New York Times, paid only $750?
Brian, I think if we get a blue wave, then they should be very concerned. People who are making over $400,000 a year are going to see taxes go up for them. You're going to see corporate taxes go up if we have a blue wave from 21 to 28%, and you're going to see individual taxes go up. You're also going to see maybe dividends, cap gains being taxed as ordinary income, as high as 39.6%. So it will have an impact. It'll have an impact on earnings for corporations because the corporate tax rate will go up, but it will most definitely have an impact for individuals as they see their personal tax rates go up. But elections are hard to predict. We still have 31, 32 more days. A lot can happen. The last polling I saw had Biden up quite considerably, but let's see what happens. And if it is a blue wave, however, I think people should anticipate taxes, if they're high earners, going up.
If it is a blue wave, as you say, what changes, if any, would you be making to the portfolio?
Infrastructure is poised to do really well. The Green New Deal, and so anything that has to do with socially responsible investing is poised to do really well. And the other thing that I think is going to see significant upside is international. I think under a blue wave, less tariffs, some of the trade rhetoric calms down, and I think you'll start to see international equities really start to take off.
All right, let's leave it there. Gene Todd of Fiduciary Trust. Good to see you.
Thank you. Good to see you all.
As the race for a COVID-19 vaccine continues, one frontrunner has given a timeline update. Moderna's CEO told the Financial Times that the biotech company's vaccine won't be available to the public until the spring of 2021. Yahoo Finance healthcare reporter Anjali Kamlani is here with those details. So Anjali, what timeline did he provide exactly, if he got more specific than that?
Thanks, Lexus. Yeah, he did sort of indicate an end of Q1, start of Q2 for the broader public, as well as indicated that the late phase trial is going to sit into observation for an extra month, which is what a lot of health experts have honestly been asking for and have been pushing for the FDA to enforce. And that would really get the indication out to Thanksgiving, so it would be post-election. Now, this part is not a surprise so much as just a reinforcement of what has already been going on. We know that we've heard from, Dr. Fauci, Dr. Redfield, saying that there really isn't going to be a vaccine ready until Q2 at earliest. And so this falls in line with what we've been hearing for the most part. We know that Pfizer as well, waiting to hear a response back on whether or not they too will wait a little extra time just to hear about what goes on in that observation period in that late stage trial. A letter was sent to them by a number of health experts, no response just yet.
And how does this compare to others in the vaccine race at the moment?
So right now, what we know is that Moderna and Pfizer remain the two in the lead, especially in the U.S., even with some of those minor setbacks or sort of slowdowns. We know that Pfizer expanded its late phase trial to include 44,000 individuals, up from the 30,000. Moderna slowed down its enrollment because it was focusing more on diversity. We also know that this week we heard about its older population in that extended phase 1 trial, expanded phase 1 trial, and the results of that. So that also is, helping to sort of push it along in terms of the broad variety of data that we're going to be expecting. Meanwhile, AstraZeneca still on hold here in the US, another front runner globally. Even though phase 3 trials did restart in the UK, we still haven't heard anything about when those trials will start back in the US. If you remember, that was the trial that was halted due to some adverse events by 2 participants in the UK. And as a result, sort of a domino effect of halting the trials here. And still no response from the FDA on what exactly they're looking for or looking into. Meanwhile, Johnson & Johnson on track still right now to continue its phase 3 trial, and that was one of the later ones to start in. So as it stands right now, sort of waiting to see. The end of this month does have the FDA, the advisory group meeting to sort of talk about the prioritization of the vaccines once they're approved or authorized rather. So we're definitely waiting to hear about that by the end of this month for sure.
All right, thanks for the update, Anjali Kamlani.
The layoffs inside corporate America are piling up. More on that straight ahead. Welcome back to the first trade. Facebook's fight against misinformation continues ahead of the election. The company said it will not accept ads that delegitimize the results of the 2020 election. Inez Ferre is back here with the details. Inez?
And Brian, this came through a tweet from Facebook's product manager, Rob Leathern. And he talked about in the tweet the ads that Facebook will not be accepting, these ads that delegitimize the results of the 2020 elections or that speculate that voting will lead to illegitimate outcomes. So ads that claim, for example, of widespread voter fraud or saying that certain types of voting, like mail-in ballots, will lead to fraudulent results, those are not permitted. Now, this policy is for ads. It doesn't pertain to organic content, comments from users. But Mark Zuckerberg in early September put a long post on Facebook about rules and revisions to posts regarding the elections. He wrote that if any candidate or campaign tries to declare victory before the results are in, Facebook will put a label on that post that the results are not yet in. Also, Facebook will be reducing the risk of misinformation and harmful content going viral by limiting the forwarding on Messenger. So you'll still be able to share information, but you will only have a limited amount of people that you can share it with at a time through Messenger. Facebook says that they have already implemented this feature in WhatsApp during some periods, and they found it to be a very effective way of limiting misinformation from going viral. Brian.
All right, thanks so much, Inez. All right, I do want to stay on the social media beat real quickly. Breaking news here, Twitter appears to be down for some users in Europe and North America, according to Down Detector. More than 23,000 users have reported issues. Okay, as the world continues to struggle through the COVID-19 pandemic, we're seeing a slew of employee layoffs across major companies. Yahoo Finance's Sabeel Marcellus joins us with the details. Sabeel, what's interesting here, it's not just one industry in particular. Really, these layoffs are coming throughout different sectors.
That's right, Brian. We're seeing that new records are being set for layoffs. And September has been a very tough month for Americans. A new record was set in terms of layoffs. So a new report came out, showed that over 118,000 people lost their jobs. That's an 186% increase from September last year. Now, here's an indication of the tens of thousands of Americans who were let go just this week. Here's a list of some of those companies. Disney announced on Tuesday that it was laying off 28,000 workers across its theme parks. Goldman Sachs, among the banks that promised at the beginning of the coronavirus pandemic that it would hold off on layoffs, well, now it's pulling the trigger on that. Goldman Sachs cutting 400 jobs. Citigroup eliminated 3 managing director positions and is looking at further layoffs. Allstate, they are laying off 3,800 workers. Then you've got the airlines. They've been warning for a while that if Washington was not able to come up with another round of fiscal stimulus to help the airline industry survive, that tens of thousands of workers would be laid off. Well, that day has come. They were banned from doing it through September 30th. Today is October 1st, and we're seeing United involuntarily furloughing 13,432 workers. You've got Alaska Airlines announced that it's going to be furloughing 532 workers, and American is going to be letting go of approximately 19,000 workers.
Yeah, they're really tough numbers to watch and to hear. And, in terms of the airlines, Helene Becker rather, of Cowen Securities, an airline analyst, she doesn't see a recovery for this industry for the next 2 to possibly 5 years, and says that if the government doesn't step up, we could even start to see liquidations amongst the major airlines. But I want to get back to sectors for a minute, Sabeel. I know that we said, these layoffs are happening across many different industries, but is there one industry that has sort of taken the brunt of these layoffs more than another?
Yeah, so at the beginning of the coronavirus shutdown, we saw it was the leisure and hospitality industry that was the hardest hit. But as we continue in this economic crisis, we're seeing that other sectors that weren't initially affected, where people could actually work from home, we're seeing that those sectors now are laying off thousands of workers combined. So we're seeing that when it comes to the labor market, it's still very difficult, and there's still plenty of challenges for Americans, and that need for another round of fiscal stimulus couldn't be more dire.
Sabeel, you also cover politics for us. You see these layoffs, and you really get the sense that stimulus needs to be done. And in fact, it should have been done 3 weeks ago.
That's right. So we know that House Speaker Nancy Pelosi and Treasury Secretary Steve Mnuchin met yesterday. They're expected to continue talks, but we're not hearing what we want to hear, which is basically that they've reached a deal and that they're going to be enacting financial relief. So there's supposed to be further talks going on. We know that there's some squabbling over the price tag of the financial relief. But in the meantime, we're continuing to see Americans lose their jobs every single week.
Tough stuff. Sabeel Marcellus, good to see you.
Thanks, Brian.
Coming up, Goldman Sachs' Katie Koch tells us why ESG investing makes a whole lot of sense right now. Stay tuned. Welcome back to the first trade. Socially conscious investors are looking for ways to put their money to work, but they want to evaluate companies on how far advanced they are with sustainability, also known as ESG investing. Joining us now is Katie Koch, Goldman Sachs co-head of fundamental equity. Katie, always good to see you. So why now? Why is this the right moment to focus on ESG?
Yeah, so taking a step back, what a lot of our clients are struggling with is that in a traditional 60 to 40, 60-40 balanced portfolio, 60 equity, 40 bonds, which a lot of your viewers are probably have as well, it's actually really tough to get the returns they want over the next decade. Predictions are somewhere between 3 to 4%. So really big picture, we think clients need to lean into a bunch of secular growth themes: millennial consumer, future of tech, future of healthcare. But climate solutions is definitely something we think is going to be a great place to find opportunities over the next decade. So maybe I'll just tell you a little bit about how we're positioned there. We are underweight in our portfolios traditional hydrocarbons. We have been for a while. Just to give people the story there, you've got oversupply. We're still oversupplying at 7 to 8 million barrels a day. Demand is really tough because the world's weaning itself off of oil effectively. Even in the best of times, they were challenged business models because they struggled effectively to out-earn their cost of capital. And then, of course, we have asset owners, to your comments, Brian, divesting from that part of the market. And so that's putting pressure on the stock. Just to give people a sense, energy is now only 2% of the Russell 1000 broad U.S. market index. It used to be 16% at its peak in 2008. Tesla is actually itself 1%. So think about that. Tesla is actually half the size of the energy sector. And so what we're doing to answer your question is we're overweight some of the solutions providers to climate, which we think is the big growth opportunity over the next decade. That includes stuff like renewables, but maybe less obvious places like packaging and also sustainable agriculture. So in the renewable space, a big position for us is NextEra, who's it is actually the world's leading provider of wind and solar. Some of your viewers might know it as Florida Power and Light. They've totally reinvented themselves for this space. And then in the packaging space, we own an aluminum can company called Ball Corp. And that probably doesn't sound very exciting. Aluminum was not an exciting sector for a long time. Their packaging was used mostly for beer, domestic beer, and soft drinks, which were out of favor with millennials. But then the consumer kind of woke up and the images of plastic and landfills and ocean were bad. And so they started to provide much more packaging to more consumer products. Now 70% of drinks launched are actually launched in aluminum cans, and it's gone from an ex-growth industry to a growth industry. Plastic has a recycling rate of 9%. They have a recycling rate of 70%. So hopefully that gives you some context of just tremendous long-term growth opportunities that are available by investing in this space.
And speaking of energy, I mean, we just found out days ago that California is now mandating no gas-powered vehicles by the year 2035. Some are saying that's a little too ambitious, but sometimes as goes California, so goes the rest of the auto industry. So for investors hearing this, and this is really great actionable news you're offering here, Katie, but they're confused by they don't really understand ESG, or they say, listen, I don't follow these companies closely enough to feel confident making a good decision here. Yeah. What's the best way for them to go? I mean, is it an ETF, some sort of a mutual fund that focuses on these kinds of companies?
Yeah, so I'll just say at the outset, I'm going to be very biased on this answer because I run an active management business in equities, but this is really what active management can do for you. It can look at the energy sector and say, this is in secular decline. We don't want to move capital in that direction, and in fact, actually overweight climate solutions providers. And so you can get that in a broad market portfolio, global or US, that is actively managed. And then, of course, you can find some active portfolios in the climate space. My final comment on active management is I've told you a lot of exciting stuff, and I do think it's a great growth opportunity over the next 10 years. But whenever you're on the precipice of a growth opportunity, you're also going to have a high failure rate. And so you're really going to need someone who has the expertise to weed through you what is going to succeed. And then again, there's going to be stuff you want to avoid because there will be a failure rate. But we are at the cusp of a sustainable investing revolution, in our view. It could have the scale of the industrial revolution and the speed of the digital revolution. And yes, people should be invested, but they should be invested actively.
Katie, based on what I'm sure you've studied from Joe Biden's proposals to go green, it's not Green New Deal, but what he has put forward is very encouraging on the climate front. Would his presidency mean that ESG finally becomes more mainstream? ESG investing?
Yeah, so I think this is a really important question. So let me just start by saying we have zero edge in predicting elections. One of the most important things for successful investing is to have humility and take risk where you have an edge, no edge. Let's just walk through the two scenarios quickly. If Trump gets reelected, that is going to keep traditional hydrocarbons on life support for longer. So you might get some near short-term rally, but we don't think it's the place to commit long-term capital. Even if that happens, this story is not dependent on a Biden victory, although it would be turbocharged by it, which I'll come back to. Actually, in the U.S., Alexis, you just mentioned California, so we have state leadership driving this forward in the U.S., and then also, in addition, the corporate sector. So we got the FANGs, they have $8 trillion of market cap. They're all committing to do more in the renewable space. And so the states and the corporate sector are going to be a tailwind for this, regardless of the election. If we get a Biden victory, Brian, to answer directly, yes, that is going to turbocharge this. We have a $2 trillion infrastructure plan, a lot of it on climate solutions, and that's going to make this even more of an attractive place to be.
What about just your thoughts on Amazon? Co-founded the Climate Pledge, a commitment to be carbon neutral by 2040. Why is it important for American companies to head in that direction? Are we going to see more big name companies do the same?
We're absolutely going to see more corporates do the same. And why are they going to do the same? First of all, the price has gone down. So actually, from an economics and a margin perspective, it makes sense for them to transition to some of these alternative sources of energy. Second of all, the consumer demands it. These companies have to be responsive to what their consumer cares about. And we're seeing a lot more consumer focus on this space. And that is going to be a catalyst for companies moving in that direction too. And so Amazon actually already is using about 42% renewables as of last year. This year, it's obviously a bit higher. And they're pledged to be carbon neutral, I believe, by 2025 in their own operations. So, I mean, imagine, again, that just the scale of spending that will happen on the back as these FANGs will lead, but other companies will follow.
Katie, I'm sure you saw the news out of California signing or now mandating that boards have greater racial diversity. How do you think that decision will shape investing more broadly looking out into the future?
Yeah, so sure. I two things I'd say about this. The first is that our operating belief on diversity is really simple. Diverse teams perform better. So we like diverse boards because they unlock shareholder value. So that's how we come at that issue. Then there's this second consideration of, do we need all these policies around diversity? And I'd love to expand on that quickly because my thinking's evolved on this. I kind of started at the place that, thought about, do we need these bureaucratic policies to force people in this direction, or will they just get there over time? Our experience has been on gender quickly. We engaged companies for a long time to add more women to the board. There were still several hundred companies in the US with no women on the board. In 2019, we said, you know what, we've engaged, we've pushed, we've pleaded for long enough, we're going to put a policy in place. So we voted against the nominating chairs of any company in the US with no woman on the board. In 6 to 12 months, we voted against 200 companies. In 6 to 12 months, 40% of them added a woman to the board. And so that suggests to me that we need to do two things: frame this around an issue of performance and unlocking shareholder value, one, and two, yes, we have to put some of these policies in place to see the progress that we all want to see. We've done it on gender, and California's announcement last night was focused more broadly on underrepresented communities. We're working on that, and we expect to evolve our policy in that direction. And hopefully you'll have me back to talk about that when we're in a position to do that in the coming weeks.
You better believe it. It is always a pleasure talking stocks with you. Katie Koch, Goldman Sachs, co-head of Fundamental Equity. Good to see you.
Great to be on. Thanks, guys.
Thank you. Okay, coming up, Bed Bath & Beyond just surprised a lot of folks on Wall Street with its latest earnings report. We have the details. Welcome back to the first trade. Inez Ferreira is standing by with some stock tickers going bonkers on the Yahoo Finance platform right now. Inez.
Starting with Bed Bath & Beyond, Brian, up 31%. CEO Mark Triton really turning things around for BBBY. Comp sales increased 6%, the company's first comparable sales growth since 2016. Digital sales grew 89%. We're also watching Conagra Brands, down about 2% after its quarterly results. Its adjusted earnings per share came in at 70 cents, beating estimates. Organic sales increased 15%. The company said it saw strong growth across the company's three retail segments. As you'd expect during the pandemic, though, its food service segment net sales decreased 21.8%, and the board approved a dividend hike. We're also watching Ford after a shakeup near the top. A new CEO, Jim Farley, is shaking things up with top management. The executive changes include the departure of CFO Tim Stone, formerly from Amazon, who's only been there since April 2019. And he accepted an executive position at an AI software company. So some restructuring changes going on at Ford with new CEO Jim Farley. And then taking a look at Tesla up more than 1.5%. Tesla is cutting the starting price of its China-made Model 3 vehicle by about 8% to about $36,800. The standard range Model 3 will come in with a less expensive battery. And the Model 3, by the way, is a big seller in China. Just to give you an idea, in August, Tesla sold more than 11,000 vehicles in China, most of those being the Model 3, Brian.
All right, thanks so much, Inez. All right, this morning, online used car seller Carvana debuted its 26-car vending machine in the Motor City of Detroit. The 8-story tall location can hold up to 27 cars. Ernie Garcia is Carvana's CEO, and he joins us now. Ernie, good to see you again. Listen, your company has captivated the minds of Wall Street. Look at this note that I caught last night. Headline: bear case on Carvana nearly obliterated. What is going on with your company? How have you gotten the company to break even in this type of environment?
So I think most importantly, the experience we offer to customers is very high quality, and we've got a team that's worked incredibly hard through this whole pandemic to ride out the difficult times and then to position us really well to handle this new influx of demand that we've seen come our way as a result of more people staying home and shopping in new ways and opening their minds to e-commerce generally. And I think that served the business very well.
You expanded to operate into 100 new markets earlier this year. Not a lot of companies are expanding during the pandemic. Yours is. I think you're now in a total of 261 markets, is it? Are you concerned, though, at all? I mean, it seems like you're not, that when things start to get back to normal or somewhat back to normal, folks may start to move away from this trend of buying vehicles online, may want to go to the dealership and have that sort of in-person experience.
So we're not really concerned about that. I think every business has two layers. The first question is, do you give your customers a better experience than they would get elsewhere? And I think we felt really good about that for a long time. And then the next question is, are customers open-minded to trying your business and to trying a new thing? And I think what the pandemic has done is it's accelerated customers' willingness to try new things. And when they try new things, they often like new things. And so, we think that shift is a material shift that is likely to persist. And then we also would note that, we've been growing at roughly triple-digit rates since inception in 2013, just by virtue of delivering great experiences to customers and them telling their friends about it. And so I think there's a lot of inherent growth in the business that is independent of the changes driven by the pandemic.
Ernie, I'm one of those customers. In the third quarter, I tried Carvana out for the first time. I bought myself a car. I have never done this before. Overall, it was a very good experience, but tracking my car actually came from Nevada. It got delivered right to my house. Overall, great experience, couple bumps in the road, but all in all, really enjoyed it. But I couldn't help but to think, wow, they're taking my car from Nevada, doing a 150-point inspection and dropping it off my house. There's a lot of costs there. How do you could just contain those costs and just really drive leverage over that model? Does it come down to opening more vending machines closer to people's homes?
Sure. Well, there's a lot there. And first, most importantly, thank you so much for giving us a shot. And
Doing what I
please
can.
email me about whatever bumps were on the road, and we'll try to make sure we
Yeah.
see to fix those. But I think there's a lot in that. So if you think about a car being shipped, maybe a couple hundred miles to you at first, that sounds like it's expensive. And in many ways, it kind of can be. But you have to think about what it's replacing. It's replacing normally the cost of having a dealership that's extremely expensive that you would have gone to. It's replacing the expense of having someone in person that would have walked you through the entire experience and spent 4 hours as you bought your car. It's providing you with a broader selection, so you're more likely to find what you want, and that means it's reducing our customer acquisition costs. And then I think, importantly and interestingly, it also gives us the ability to buy cars anywhere in the country where they're inexpensive, and then provide our customers with an even better price because we can ship them for less than the variation in price across geographies. So I think there's a lot of really good things that happen there. No doubt there is shipping expense, but we think that's dwarfed by the other benefits.
Are you being able to buy enough cars?
So in general, in the market right now, there's clearly a dearth of supply. That starts with new cars, where many of the manufacturers struggled to spin their manufacturing capacity back up after the kind of initial onslaught of COVID. But I think that's trickled down throughout the entire market. We've been growing this business of buying cars from customers as well, and that's gone tremendously well. We announced that in July we bought as many cars from customers as we sold to customers. So that's a really big part of our business now, which is great because it gives us access to incredibly high quality cars from consumers themselves in a really scalable channel. So getting access to cars has not been our issue over the last several months. What we've been dealing with is trying to ramp up our capacity to do that 150-point inspection that you talked about and ensure that we deliver certified cars to our customers that are in great shape so they continue to have faith in us in the future. And we've got these large inspection centers. We'll put about $1,000 of parts and labor into every car that we deliver to a customer. Scaling that up really quickly is obviously a big undertaking, especially in this environment. But the team's done an incredible job, and we've been scaling it up very fast.
I know your earnings are coming out, I think, early November. You're forecasting record sales, break-even results for the third quarter. You've yet to turn a quarterly profit. Can you offer up any kind of timeline?
What I would point to is, as I said, we're a 7-year-old company. 3 or 4 years ago, we were at negative 20% EBITDA margin, and then negative 16%, and then negative 9% and negative 6%. And we announced that this quarter we expect to be approximately break even from an EBITDA perspective. So the scale in the business is really showing up in that incredibly rapid leverage. And then, as you discussed, we're launching our 26 vending machine today. We're in 260 markets. We opened 100 earlier this year. So we're pouring investment back into the business to ensure that we can continue to grow in the future. And despite all that investment, we're still making the progress that we discussed. So we're incredibly happy about that. And generally speaking, like to stay away from timelines.
All right, we'll leave it there. Ernie Garcia, Carvana CEO, and I will send you an email. Overall, happy customer. Happy customer.
Thanks. Appreciate it.
All right, do stick around. Much more ahead on The First Trade. Welcome back to the first trade. Parker Clay is a global luxury brand that makes handmade leather goods, but the company is not just all about making a profit. The mission behind the brand is to help keep women in Ethiopia out of prostitution. Founders Ian and Brittany Bentley traveled to Africa in 2014 and quickly realized they wanted to help the women there. But they didn't want to be another nonprofit. The couple saw an opportunity for the country not to be a destination for aid, but a destination for trade. Joining us now is Brittany Bentley, co-founder of Parker Clay. Brittany, good to see you this morning. Why choose Ethiopia?
Thank you, Brian. Well, it's a bit of a different story. Ian and I met in high school and got married shortly after college. And then we started our careers in business and design and had 2 boys and just really wanted to grow our family through adoption. And we chose Ethiopia specifically. From there, we traveled to Ethiopia. We just fell in love with the vibrant country and fell in love with everything about it. And so that led us to 1 year later buying one-way tickets as a family to move to Ethiopia to work with women coming out of prostitution and help with job training. And that led us to where we are today. It is a company of over 150 employees where we are making an impact through employment.
I think it's a super inspirational story, Brittany, and a risk not many people would be ready for. I mean, tell us, you're not obviously from Ethiopia, your family isn't, although I know you have adopted a couple of children from there, but what have some of the challenges been like working there locally and dealing with the government locally?
Yeah, so we are not Ian and I did not set out to become a leather industry. We saw this as an opportunity to create more employment. So it's definitely been trial and error from the beginning. We have had the company for 6 years and it's been growing year after year. And that has just always been amazing. We're so thankful for our community. There's been challenges working in the country and just starting something new for sure. Any entrepreneur would have challenges starting anywhere outside of their normal country, but we've had amazing leadership in country. We have a great staff. They are 100% Ethiopian based in with our staff there, and 80% of them are women. 80% of women here on our leadership in the US, and so we're really proud of that.
Brittany, what kind of skills do you teach these women?
Mm-hmm. Yeah, so we have an amazing basket of goods that just provides for many aspects of life in their community. A lot of the women come out of the Women at Risk program with no official job training that they've had in their life. So we start them out with a basic skills training. And with our Center of Excellence, they're able to gain further job training skills and receive certifications that they can carry through for not only Parker Clay, but to future career opportunities. Just being able to have the skills to do a job that provides them something amazing for their resume.
Brittany, you're a for-profit company. So how are things going? And are, is your company profitable?
We're operationally profitable, and we are continuing to find ways to create a strong impact and have that profitability. It is just as important for us to have that impact. People are very important to us, and our employees are extremely important. So we want to be growing at a pace that is sustainable and healthy for all of us.
How do you see the company evolving over the next few years?
Yeah, we hope to grow from over 150 employees to, by the end of the year, 250 employees. So we hope to keep growing in impact as well as profitable growth. We want to continue making amazing leather bags, better production, and just have a better world by people making conscious choices on what they're purchasing.
Well, I'll speak for a lot of folks out there. This is tremendous work and a tremendous business model. Let's leave it there. Brittany Bentley, co-founder of Parker Clay. Good to see you.
Thank you, Brian and Alexis.
and we'll be right back. Welcome back to the first trade. Playboy is making its way back to Wall Street. That's right. The company is going public through a SPAC transaction with Mountain Crest Acquisition Corp. This comes after the late founder, Hugh Hefner, took the company private back in 2011. The CEO of Playboy, Ben Cohn, joins us now. Ben, good to see you. So just take us through, what does the business look like right now? I feel as though a lot of people, when they think Playboy, they think Hugh Hefner, Playboy Mansion, printed magazines. But my sense is that's not what the business looks like today.
That's not what the business is at all today, Brian, and good morning. The business today is a commerce business. We are one of the largest brands in the world. We sell product in over 180 countries, and consumers spend in excess of $3 billion buying our products, really across 4 categories. The first is sexual wellness. The second is apparel and accessories. In China, we are the leading men's fashion brand. We have over 2,500 stores and 1,000 e-com stores. Gaming and lifestyle. We have a very large digital gaming business. And then the last is beauty and grooming.
I know that licensing is a huge part of the business. You've really pivoted to become this consumer products brand with the iconic Playboy brand behind you. But you know, when you look at the business, there's this heightened sensitivity, right, to the kinds of content that Playboy has been historically known for. And amidst the Me Too movement, you know, how does Playboy market itself to the general public in an effective way?
Yeah, look, we have always been for equality, for free speech, for free expression, and for owning your own sexuality. And I think that comes through with what we've done with the audience, with the content creators, and the ambassadors that we work with today. If you look at our audience growth over the last 2 years, we've grown our female audience 70%. Our average age, 85% of our audience is under 44 years of age. We've added 10 million new social followers. And 50% of our company today is made up of women across all ranks.
Ben, just looking into the numbers here, a big goal for 2025, $100 million in adjusted EBITDA. Are you profitable today, and how will you reach 100 million?
Yeah, we're very profitable today. The business is up 68% this year on revenue, over 106% on EBITDA. Next year, we have a target of 40 million. We're well on our way to it. Alexis had mentioned licensing before. You know, licensing gives us a ton of visibility into our forward book numbers. We have over 400 million of forward book cash flow through 2029 for the business. And so when you look at the growth that we're experiencing today and then what this capital will provide, the growth will come across all sectors as they are growing today.
Ben, talk to us about handling data protection. You've got to be having a lot of data on folks with all of this selling, especially online, privacy. I mean, for those who want to be discreet, but still participate in some of the things that Playboy offers, and maybe a little hesitant to do that online. How are you dealing with data privacy and protection?
Yeah, we're dealing with data privacy like other companies are dealing with that data privacy. It's key to our tech team and the infrastructure that we use internally. All of those transactions are private. But again, this is a commerce business today. And so when you look at our partnerships with PacSun, with Misguided, with our fragrance business, what people are interacting with us today is for commerce and for buying Playboy branded products around the world.
You know, key to this story, I think, Ben, is you in many respects. You were involved in that deal that took Playboy private in 2011. What are your plans after this deal? Do you plan to stay with Playboy after the public debut?
Yeah, so 66% of the company on a forward-go basis will be owned by existing shareholders and management. All of the existing shareholders, including management, which owned about 23% of the company prior to the deal, are rolling and signing one-year lockups. My goal is to continue to build this. This is the biggest opportunity I have ever seen in my career. You just can't fathom how large this business is and how large this brand is on a global basis. You couldn't recreate what we have today.
Speaking of opportunity, you see opportunity in the cannabis industry, and I know historically Playboy has been behind cannabis reform for decades. What are your plans for if and when it's legalized at the federal level?
So today, we've launched a line of CBD products. We have 3 products in market and many more in development. When it is legal on the federal basis, we do plan on rolling out THC products. We have developed them, but we will not roll them out until it's legal on a federal basis.
And Ben, real quick before we let you go, when do you expect to debut on markets? Do you have a date?
Look, a typical process is somewhere between 60 and 90 days from now.
All right, we'll leave it there. The CEO of Playboy, Ben Cohen, good to see you. I look forward to having you back.
Great. Appreciate it, guys. Thank you.
All right, let's get back to Inez Ferre with another look at the markets. Inez?
And Brian, we're taking a look today at Palantir and Asana on its second day after listing on the New York Stock Exchange. Looking at Asana, the work management software company, it had opened at $27 yesterday. Today, the stock is down more than 7%. It closed at $28.80 yesterday. And then just taking a look at Palantir, this is the data mining company. It had opened at $10 a share yesterday, closed at $9.50 today. It's trading down about 1%. We're also watching Constellation Brands, the parent company of Corona, after beating on the top and the bottom line for its latest quarter. The company also declared a quarterly cash dividend. And then looking at AMC, AMC is reopening some 14 more theaters in California and also in Michigan starting this weekend. This will bring AMC's U.S. theaters, about 80% of them now are open. I just want to mention Bed Bath & Beyond really surging today, up more than 31% after a strong quarter with comp sales increasing 6%, the first time the company's comparable sales grew since 2016, with digital sales growing 89%. Gross margin increased about 1,000 basis points to 36.7% compared to the period last year. And then just looking at Ford is relatively flat after new CEO Jim Farley announced some shakeups with restructuring at the top. The executive changes include the departure of CFO Tim Sloan, formerly from Amazon, who had been there only since 2019. He accepted a position at an AI company. And then just looking at Tesla up more than 1.5%, cutting its starting price for the Model 3 in China by about 8%, Brian.
Yeah, it's quite the move out of Bed Bath & Beyond. And it is October 28th, big investor day for that company. Thank you so much. And some quick breaking news here. A note from Twitter was down earlier in the day. They are now back up and running, fixed whatever issues that were impacting the platform. Okay, On the Move is up after the break. They'll speak with Kathy Ireland of Kathy Ireland Worldwide, where she's the CEO and chief designer, on how she's helping small businesses. And they'll have all the latest on stocks making big moves during the first trading day of the fourth quarter. On the Move is coming up next.
doing well. This has been a terrible tragedy, this whole COVID-19 in small businesses. I know a lot of small business owners that are suffering. But from a macro standpoint, because of the Fed's move, there has been a historic level of excess liquidity. Where the client base is challenging me a little bit, just like you folks did, is what's with this global synchronized recovery? We're still not great, and it's choppy. And the answer is, if you look at the market PMI data, if you look at the OECD Organization of Economic Cooperation and Development data, we have inflected off of a historic period of weakness and are moving back in the positive direction, just like we have after every other recession.
Well, let's hope it continues to go in that direction. Tony Dwyer, thank you so much. It's always great to see you. Canaccord Genuity, Senior Managing Director and Chief Market Strategist. Appreciate it. Let's talk about the state of higher education now. As we know, a lot of universities have gone back in some capacity to school, and we have seen an uptick in COVID cases as a result. So let's talk about that right now with the president of Florida A&M University. That is Larry Robinson. He is joining us from Tallahassee. And sir, if you could just unmute, that would be fantastic. I also want to bring into the conversation Ortiz Swaminathan on our staff who covers education for us. Larry, you all have at your university a page that tracks COVID cases on campus. Yes, 22 students currently positive, 22 employees currently positive. What made you come to that decision in terms of transparency and how you were going to track and reveal this data? And then how are you using that information?
Yeah, so we really just wanted everybody to know the status of things at the university. Students who are here, parents who are not here, members of our board and others who have vested interest in the university and its operations. We began with what we consider to be a fairly comprehensive plan to begin with. And so, in the state of Florida, as you know, there are very few things other than the names of these individuals that are not public information anyway. But we thought it would be to our stakeholders' advantage for them to know. And so what we have is in terms of our testing, we have a sentinel testing program. We test key personnel, certain staff members, the resident advisors, athletes, and so forth. And that's how we then determine how to manage things. And so we have really, the other good news is that we only have 2 students who are being isolated in some of our dormitories away from other students and staff. And we provide them in those units with the services that they need to continue their academic progression. So it's all about being open to our constituents, letting them know what's happening on the campus. Now, the numbers that I have, you have to get the time frame because they do change. We started posting them on the website as of August the 1st, and that shows, 88 total cases, 60 of them are students, and 28 are staff. We update that periodically, but that's the data as of the 25th, I believe.
Hey, President Robinson, I'm very curious about the relationship with the White House that you have. You got a bunch of tests from the White House, and also there has been a big initiative that the White House has been pushing. So I'm wondering, is this sufficient? And the second question is, what else do you need to weather this storm?
Right. So one of the things we have had at our advantage is that since April the 25th, we've had a community-based COVID-19 testing site on our campus, actually at our football stadium. Since April the 25th, just this week, we surpassed 51,000 tests being administered at the site. So that allows us the flexibility of having it readily accessible to citizens on the south side of town, low-income residents, minority residents. They can come without a physician's referral. They can come asymptomatic. They can drive up. They can walk up. So it's highly accessible. Those additional 7,000 rapid tests that we received this week from the White House will be very, very important in our overall testing strategy, because now we can target certain groups and get data back immediately. But the interesting thing about this is that, where we'll know who those individuals are, we'd have to share that information with the Leon County and the Florida Department of Health, because they do the contact tracing. And that's the other part of it that's important. It's not just the individuals who test, it's those who might have been exposed to the virus, for those who have been tested positive. So those are going to make a big difference for us. Now, what we're looking at next is sort of expanding our testing capacity beyond the state-sponsored site that we have on our campus. And it's not just to do the testing, but we would love to have our students and faculty engaged in learning the ins and outs of, this type of pandemic and how to get ready for the next one.
President Robinson, Adam Shapiro here. Your institution has survived more than 120 years. So I imagine you are prepared to survive this. But I'm curious, there are other pressures. It's not just COVID, but student debt. What are universities, especially historically Black colleges and universities, going to look like after the pandemic with so much pressure on students, the cost, as well as, am I getting the education I need, especially when we see all of this in a pandemic-like situation? What's the return on the investment?
Right, so Adam, let me correct you slightly. On Saturday, October the 3rd, we will celebrate 133 years as an institution, and we're really, really proud of that. With regard to our students, though, let me tell you that we're already seeing some of the economic impacts, we believe, of the pandemic on our students. We've seen a decline in enrollment about 5 or 6%. Right. And although we surveyed students ahead of time as to what would be determining factors regarding them coming back to us, and many of them talked about, how we operate in this COVID environment, but most of them talked about the financial implications that their families are already experiencing. And I think that's going to happen, for some time longer than, the next election. I really think we're going to see these students experience and their families some economic difficulties into the future. And so what we do at the university is first make sure that students have the right academic programs that are going to provide them the types of careers that will allow them to leave us with this, prepared to take on any debt that they can. But then we are very, very proud of being in the State University system of Florida, of having the lowest out-of-pocket cost to our students to begin with. So when you couple what they get in federal aid and what we provide them, in funding that we garner from alumni and others, it puts them in a pretty good situation. However, that doesn't necessarily make them whole because of their family income levels. They have to make loans in many cases to make themselves whole. So it's important for us to make sure that they get in and out as quickly as they can, and then they get into the type of employment opportunities that allow them to address any debt problems that they might have.
Hey, President, just quickly, what do you feel about the state of higher education right now with enrollment declines in multiple schools?
Yeah, I am concerned in particular for those persons in the socioeconomic realm that we serve, because I think they're going to be the most negatively impacted by it. They're going to be from the families where employment won't turn around as quickly as some others might be. Their households don't have sort of the bankrolls to rely upon to get things going. And so we've been articulating to our constituents, those who love us and support us, is that we're going to have to do more to support our students. And so I think we have to make sure that in this country, in particular, as we roll out these stimulus packages, the CARES Act was very, very helpful to us, right, in helping us through this. And the next package, I did see, the large, educational piece to that. That's critically important to us. And I think the way that goes in terms of funding for us will help make a huge difference. It has changed and will continue to change how we deliver education. We went from, less than 10% of our courses being offered virtually to now over 85% of them. And so some of that will stay. Students will have adapted to that environment. They're going to enjoy it more. It allows them who have opportunities to work to do it, perhaps unencumbered in ways they have been in the past. And at the same time, it puts us in a place where we're having to compete with others who may have been in that space a little bit longer. The competition was going to get fierce. It already is for the best and brightest students. And by the way, it's pretty much hand-to-hand combat. We are fortunate to be successful over the years in bringing some of those best and brightest students to Florida A&M University.
Larry Robinson, we wish you continued luck and success in that endeavor. Florida A&M University President, appreciate it, sir.
Thank you.
Well, we want to check on a couple of stocks as we take you to break. They are the companies that started trading yesterday. Palantir shares have been bouncing around a little bit today. Right now, they're down almost 2% after yesterday closing around 950 after kind of bouncing around throughout the session. We saw them trading as high as 1142 during the session yesterday. And Asana, remember, it rose about 6.7% from its opening price yesterday. Today, those shares are pulling back by nearly 9%. We'll be right back.
Welcome back to On the Move. Want you to take a look at some of the airline stocks right now. We learned that American Airlines and United have laid off a combined 32,000 employees. That's effective today because the payroll support program, which was part of the original CARES Act, expired yesterday. United actually put out a memo, a statement for everybody saying, quote, in a continuing effort to give the federal government every opportunity to act, we have made clear to leadership in the Trump administration, Congress, and among our union partners, we can and will reverse the furlough process if the CARES Act payroll support program is extended in the next few days. Pressure, obviously, on Nancy Pelosi and the Trump administration to get something through. We heard from Delta. They did not do any layoffs, and they said that fortunately, thanks to the hard work, shared sacrifices, innovations, innovative thinking of our people, Delta will avoid involuntary furloughs. Southwest did not do furloughs either. They did, however, take an additional $94 million from Treasury, in which Treasury will get some shares. Also want to talk about cruise lines right now. Carnival Cruise was down or is trading right now about 2%. CDC Director Robert Redfield allegedly had wanted to extend the no ships, no sail order until February. CDC put out a statement today saying that the extension of the no sail order for cruise ships will go through October 31st. They did say in their statement, though, there's this back and forth contradiction, right? Cruise ship travel continues to transmit and amplify the spread of SARS-CoV-2, the virus that causes COVID-19, even when ships sail at reduced passenger capacities, and would likely spread the infection into U.S. communities if passenger operations were to resume prematurely in the United States. So the CDC, maybe they know something the rest of us don't come October 31st. Jared Blickery, what other stocks are you watching today? Because we got some earnings.
Yes, we do. We got three in the food space. We're going to start out with PepsiCo. That stock is up about 0.7% right now. Their sales rose 5.3% to $18.1 billion. That's compared to estimates of $17.2 billion from analysts. And they were one of the first to provide guidance after the pandemic outbreak, and they forecast organic revenue growth of about 4% for the full year. The CEO, Ramon Laguarta, said the results showed continued resilience in the company's snacking and food businesses. And Hugh Johnston, the CFO, spoke to Yahoo earlier today. He said the gains were remarkably strong. We feel really good about the snack food business. Globally, it was about 6%. The beverage business grew 3%. And where there was a big surprise was in Gatorade, which grew in the high single digits on the strength of Gatorade Zero. Also checking out Constellation Brands. That stock is down about 2.5% right now. And that's after it beat on both its top and bottom lines. Second quarter comparable EPS came in at 276 versus 272 a year ago. And that compares with estimates for 253 by Wall Street analysts. Also, their Canopy Growth equity earnings and related activities for the second quarter totaled a loss of $34.1 million on a comparable basis, continues to be an albatross around their neck. Fiscal 2021 guidance is unavailable, and they're saying unavailable at this time due to the uncertainty and potential impacts on the business from COVID-19. And we're also checking out Conagra. That is down 1.2%, even though it did beat on its top and bottom lines here. Sales appreciated in all areas except for food service, which suffered from the shutdowns and also from capacity constraints at restaurants and institutional cafeterias. They did boost their quarterly cash dividend by 29%. And the CEO, Sean Connolly, saying in a statement, now that customers have begun to be rebuilding inventories and we have increased production capacity in certain areas of our business, we are selectively increasing our marketing support for the business where capacity permits. Adam.
Jared, also, let's check out a stock as we head to break. Moderna, we learned yesterday from the CEO in an interview with the Financial Times that they will not be ready to seek that emergency use authorization from the FDA here in the United States for their vaccine candidate. The trials are underway, but the CEO, Mr. Bancel, said that not ready to go for emergency authorization before November 25th. They said full approval for their vaccine will not be ready until next spring. Once again, those shares are trading down right now about 2%. More on the move after this. Welcome back to On the Move. If this were a normal period of time without a global pandemic, we would start talking about and complaining about retail outlets rushing all the Christmas merchandise onto the shelves now, right? That's the usual complaint. But this year, something really behind the scenes is threatening the Christmas holiday shopping season. So to talk about this, we invite into the stream Krista Pitts. She is the co-CEO of Loomis Stella. She's joining us from Atlanta, Georgia, and a lot of us would know your company. One of the products from your company is Elf on the Shelf. But the issue that I'm talking about that does threaten retailers as well as manufacturers is credit insurance. And very simply, we're talking about an industry, $600 billion in sales are at risk because manufacturers can't get the insurance to underwrite what they're sending to retailers, right?
Correct. I mean, if you think about the impact of a pandemic and then you add on top of it retailers, unless they were considered essential, being shut down, the very thing that small businesses, manufacturers, distributors, sales agents depend on is trade credit insurance. Underwriting your accounts receivable so that you can grow your business, and that a small company like mine can actually afford to work with a company like Amazon or Target or Walmart and meet their demand. And unfortunately, at this point, that insurance that was readily available to all small businesses is basically dried up for this year.
Krista, it's Julie here. So of the sales that you do, what kind of proportion is direct sales? And then how heavily do you rely on some of those other outlets? I mean, I would imagine, can you go without credit insurance in some cases as well when dealing with these big companies?
You can, but obviously it's a full risk then to you as a small business. Particularly when you're seasonal, as many of the goods are that you're going to be seeing hitting these shelves, they have now an opportunity to think through it. It's not an essential good. So if your supply chain dries up and there are difficulties there, you can't get your goods even on the shelf if you want to. From a financial standpoint, though, many banks have come to depend on trade credit insurance to even give you your lines of credit. So when it comes to some of the larger retailers, the ones that were considered essential, you're in good shape. But when you start thinking about your favorite craft stores, your favorite department stores, your local small businesses, I then, as a manufacturer or a distributor, am having to take the entire burden of that risk of goods I've already made, forecasted. In some cases, I already had purchase orders for. And so that's an enormous risk for the small business community. If any one of these retailers unfortunately has to declare bankruptcy or is in a slow payment situation, I have no recourse. So I can ship them, but it's fully at our own risk. There's no way to underwrite that with insurance, which in the past, as I said, was readily available.
Krista, it's Julia LaRoche, and it's such an interesting point that I had not thought of. You're talking about the downstream effects of the small business community, where the bigger players like the Walmarts, the Targets, the Amazons can handle this, but you're talking about maybe your local craft store that can't. What are you hearing from your peers? I would love to just unpack this challenge further and walk us through a pretty tangible example that you're facing.
Yeah, I have to say, I'm actually excited to share this and to talk about it because people are not talking about this and the serious trickle down nature. This is $600 billion of business, small business, that's being impacted by the fact that trade credit insurance is drying up. So if you were an essential business, I have no problem getting insurance on you, and I'm able to then not have that full burden of risk on my company. Last year, even though it may have been more expensive, I was able to get about 95% of my business insured. This year, I would say I'm closer to 50%. And we deal with retailers across the spectrum. We deal with book retailers, small businesses, gift retailers, specialty retail, and department stores, as well as some of the larger retailers with our line of brands. And so when you think about this impact and the risk of making these goods, I have a commitment for them. But if I send them to these retailers, it is a full-blown risk on anyone who's made these goods that if they have to go under or if they slow pay, you're taking the entire risk. So I can mitigate it. I can choose not to ship them. I can choose to short ship them. But then the goods that you're looking for aren't going to be on the shelf.
We're going to keep an eye on this because so many jobs are tied to it indirectly and directly. Thank you for joining us, Krista Pitts, the co-CEO of Loomis Stella. We wish you all the best as we head towards the holiday retail season. Want to check Tesla right now. As we head to break, Tesla has announced that they are cutting the price of their Model 3 In China, it's going to sell for less than $37,000. Shares of Tesla right now are up 2.5%. They say that they're going to be able to cut the cost because they're going to be making it with Chinese-made batteries, which are going to be a lot cheaper than if they were to make them otherwise. For the record, that 37 grand, my first big boy car was a Hyundai Excel 1987. I paid $5,200 for that a long time ago. And yes, I had to finance it because TV doesn't pay a whole lot. More after this. News on the move. Former Trump campaign manager and digital strategist Brad Parscale took a leave of absence from his role in Trump's re-election campaign. Police tackled and took Parscale into custody last weekend, which ended with Parscale being involuntarily hospitalized. In a statement to the website Politico, he said he was stepping down to seek help for, quote, overwhelming stress on both him and his family.
The heiress to the Seagram liquor fortune is the first member of NXIVM, a cult-like self-help group, to be sentenced. Claire Bronfman, 41, is set to serve almost 7 years in prison. That's more than the 5-year sentence that prosecutors had recommended. Bronfman had pleaded guilty to charges of harboring a woman who was in the U.S. illegally and fraudulent use of a deceased person's identity. Those charges connected to the sex trafficking case brought against NXIVM founder Keith Raniere.
The NFL is seeing its first coronavirus disruption to the 2020 season. The Pittsburgh Steelers and Tennessee Titans game, that's going to be officially postponed until later this season after multiple players tested positive for coronavirus. The Titans have a total of 11 positive COVID-19 cases, 5 players and 6 personnel. The NFL said the new game date will be announced soon.
And the king has a new castle. LeBron James has closed on the purchase of a $36.8 million Mediterranean-style villa that once housed film star Katharine Hepburn at the height of her career in the 1940s. The home was most recently owned by Lee Philip Bell, who died earlier this year and was one of the creators of soap operas The Bold and the Beautiful and The Young and the Restless. King James and the LA Lakers are currently playing the Miami Heat for the NBA championship.
Let's check in with Dan Halley, some tech support advice for everybody on the new iPhones and ways you can trade in your current phone. Dan?
Yes, Adam, the new iPhones are expected later this month. We're expecting the iPhone 12. So what does that mean you should do with your old phone? Well, if you want to, you can trade it in and get some good money for it. But before you do that, you're going to have to take some important steps. And number one is backing up your current phone. This way, when you get your new phone, you'll be able to load up your older phone's profile, have all the apps and software that you need on there. To do that, what you're going to have to do is go into the settings page and then tap Apple ID, iCloud Media, and Purchases. From there, you're going to scroll down to iCloud, choose iCloud Backup. And then from there, you're going to press Backup Now. And that'll start to back up everything on your smartphone to your iCloud account. Then once you log in on your new phone, it'll pull it all back down, and it'll be like you had your old phone again on a much more expensive, newer phone. So what do you do before you sell your old phone? Well, you're going to have to make sure that you completely erase it, because you don't want any of those text messages or photos that you have on there finding themselves into the hands of someone you don't know. To do that, you're going to have to go back into the settings app and then choose reset from the general tab. That's all the way at the bottom of the screen. You're going to then tap erase all content and settings. From there, they're going to ask you to enter your passcode for your phone. You're probably going to have to enter it twice. And then it'll say tap to erase iPhone. Tap that. It'll look like a scary warning. Then you're going to have to sign in with your iCloud password. Type in the password. You'll get another scary warning about deleting all the data on your phone. Press that, and then it'll start to erase your phone entirely. Once you're done with that, it'll go back to looking like a new phone. It'll have hello in a bunch of different languages, ask you to set up Wi-Fi. You can turn it off from there. At that point, you're done. You could ship it out to wherever you're going to send it. There are a few options to be able to sell your phone. You can use something like a Gazelle. You can use something like Verizon, our parent company, AT&T, T-Mobile, or you can just go straight to the source and trade it in at Apple. And some of the prices that you can get for your older phone are really impressive. An iPhone XS Max will get you up to $450. An iPhone 5, you're probably not going to get a lot, but some of the older phones you can get $35. And look, money's money, and if you're going to push it to your a new phone, that's great. Another thing that you can do, if you're not going to get any money for it, you can recycle it. And if you're feeling like you want to give back to something, you can donate your phone to something like a St. Jude's or a women's shelter or cell phones for vets. This way that they can have access to a phone that they might otherwise not. But that's where what you can do with your older phone, and then, have fun with your new one.
Especially if you get, I think the rumor is for that dark blue iPhone 12. So Dan Halley, we're going to keep an eye on the new iPhones, but let's check what's going on with Ford as we head to commercial break. The shares of that stock going up about 1% today, but the price they're trading at $6.75 and change. They named John Lawler as the new chief financial officer this morning. They've also unveiled new organizational changes with the new CEO, Jim Farley. Lawler is going to replace Tim Stone, who's actually leaving the company. Ford shares again trading up about 1%. More on the move after this.
Move. We were just discussing a few moments ago some of the challenges that small businesses are facing right now. We know there are many. We want to talk to someone who is trying to help in that area. That is Kathy Ireland, who is Kathy Ireland Worldwide Chair, CEO, and Chief Designer. She's joining us from Florida. Kathy, you have a licensing empire, but I know that you are also turning your attention to trying to help small businesses that need help right now. How are you doing that? Specifically, what kind of help do they need most at the moment? And how are you sort of targeting them?
Well, thank you, Julie. You know, one of the strengths of our company, Kathy Ireland Worldwide, is our ability to thoughtfully and quickly pivot and pivot again. And when COVID hit, our team rolled out our Kathy Ireland Small Business Network in an effort to help small businesses survive and scale during COVID and beyond. And last week, we announced our relationship with UBS, a multi-trillion-dollar business. And we always hear the cliche, Wall Street meets Main Street. This is truly multi-trillion-dollar giant comes to Main Street with tangible help. And that's what's so important. And this hasn't been done before. So big kudos to UBS on collaborating and working with our large clients, of course, and also our small business network clients. And Julie, blitzscaling, it's real. And with the fiscal disciplines of UBS, and also, you know, earlier you were talking about insurance, the insurance support from our long-term partners at American Family Insurance. I'll be giving a keynote for our Dream Summit this afternoon. And then also the licensing, marketing, media management, and product design renovation from our company. We're able to serve our clients in revolutionary ways during this pandemic and beyond. And another area where we've been able to pivot during this time, it's with our Kathy Ireland American Home, managed by Phil Baratelli. For years, our company has and still works with luxury estates and properties. With KI American Home, we're bringing affordable and middle-income homes to families across America.
I was reading that going into the pandemic before this, that from the licensing and the different elements of your business, over 2.6 billion, I think, in revenue. But I'm curious what advice you would have for that small business person, especially small business women who are using the opportunity of this downturn to fill a void, as unfortunately other businesses are falling to the side. What advice would you give them?
Absolutely. It is listening to and being so focused on the solutions. I'm seeing so many businesses close, which is just breaking our hearts. And being able to differentiate yourself, stand apart, being able to ask for help. You mentioned women-owned business. Frequently, something guys are really good at, it's delegating and being able to work with people who will help us. And that's what I love about our relationships with UBS, with American Family Insurance, great experts coming together to offer help. And what our company is helping to do is to help scale in these times in affordable ways to differentiate your business, help you stand apart, help you not only survive, but really grow.
Hi, Kathy. It's Julia LaRoche. And we actually met a couple years ago at the Berkshire Hathaway annual meeting of shareholders. And I know Warren Buffett is a mentor of yours. He likes to think of himself as a teacher. I'm wondering if there are any particular lessons or if you've had conversations with Warren Buffett during this time that have maybe helped you, and anything else that you might be able to apply to that small business owner who might be in need of some of this advice.
Thank you, Julie. Warren Buffett is a mentor and a friend. Met him through Irv Blumkin, the CEO and leader of Nebraska Furniture Mart. And something that Mr. Buffett does at the beginning of his annual shareholders meetings, he shows his film. And at the beginning of that film, he talks about the incident with Salomon Brothers. And he says, if you make a mistake, I'm paraphrasing, but if you make a mistake, if you lose us some money, we'll earn it back. But if you mess with one shred of our reputation, our integrity, I will be ruthless. And I love that protection. That is so important. And so in answer to your question, Julie, the how is of critical importance. And when we're thinking about scaling and growing in difficult times, I encourage people, don't be desperate, be thoughtful. yes, we have to pivot quickly. We must be thoughtful. The how is of critical importance. How are things being done? When we began our company back in '93 with a single pair of socks, we began by conducting surprise factory inspections. We learn a lot when we show up unexpectedly. And I recognize how important it is who we work with and how each company conducts their business. Philanthropy is a big part of what we do, and that is exciting. It gets us up in the morning because there's so much to be done. So the vision of our company, it's teach, inspire, empower, make our world better. Everyone who works with us commits to one of our initiatives that include everything from fighting human trafficking, supporting military veterans and their families, combating disease and hunger, supporting education and the environment.
Kathy, that's a really interesting way to get your partners and people you work with involved. Thank you so much for joining us. We really appreciate it. Kathy Ireland is Kathy Ireland Worldwide Chair, CEO, and Chief Designer. Thanks for your time. Appreciate it. Wanted to give you a quick check on a company that came public today. It's called Pulmonex. It's a company that provides lung kind of disease equipment, and the shares are surging on their first day of trading. They priced at $19 per share above the offering range, and then quickly just about doubled. It was $190 million that company raised in the IPO. We'll be right back. Time for Word on the Street, where we check in with our panelists, find out what stories they are watching. Surprise, surprise, Brian is looking at the Fed and an extension of some rules and regulations that they're putting on banks into the fourth quarter.
Yes, well, probably not a good thing for anyone wanting to invest in the banking industry, but the big banks will continue to face a restriction on their capital distributions. They will not be allowed to do any sort of share buybacks and will face a cap on the amount of dividends that they can pay out in the fourth quarter of 2020. Keep in mind that these are restrictions that the Federal Reserve had already put in place for the third quarter, the results of which are due in about 2 weeks or so. So the big banks, again, not able to pay out those distributions in the fourth quarter. Now, many on the street already saw this as the case. In fact, you had the likes of KBW saying weeks ago that it was probably the case that the Federal Reserve was going to extend these restrictions through the fourth quarter, which is maybe why we're not seeing too much of a reaction on the street right now. You have JP Morgan Chase up about 0.5% right now. The XLF index are actually up 0.25% right now. Worth mentioning one more thing that actually it was yet not a unanimous decision at the Fed to do this. Lael Brainerd dissented from that decision after the market fell yesterday.
Very interesting. And Julia, also interesting, a note out from Lori Calvasina of RBC, where she looks at the market perception surrounding a Joe Biden presidency.
That's right. It's their quarterly survey, and they just posted the latest results. And for the second survey in a row, most investors, approximately 57% of investors polled, expect Joe Biden to win in November. That is down from 63% from the survey back in June. However, those who expect a Trump reelection, that rose to 43%, up from 37% in June. And one of the big takeaways here, Julie, is that the investors feel less bearish on markets when it comes to a Joe Biden victory. They have been feeling a bit more optimistic. Lori Calvasina pointed to some of the overall economic outlooks and optimism of around another round of stimulus as kind of favoring that sentiment shift. Elsewhere here, the Biden victory viewed as bullish or very bullish ticked up to 13%, up from 7% in June. But the big takeaway, of course, is that they feel less bearish. Only 41% of investors view a Biden victory as bearish for equities. The last poll in June, that number was 60%. And when it comes to President Trump, most still think a Trump reelection would be bullish for the markets. 63% think he would be bullish. That is down from 65% in June. So it's always an interesting read as to how they view how the markets might go, depending on the election here.
Indeed. Thank you so much, Julie and Brian, for spending the last hour with us. Stick around for the next hour. We will have a preview of the jobs report with LinkedIn's chief economist. We'll be right back.
It's 12 p.m. here in New York City. We're 2.5 hours into the first trading day of the fourth quarter. And take a look at what's happening with stocks right now. You can see the S&P 500, the Dow, and the Nasdaq are all in positive territory. Not terribly high, but green is green. Let's make a deal. Both Main Street and Wall Street are focusing on D.C., hoping for possible second stimulus deal. The latest as lawmakers seem to make some progress in their negotiations. Election crackdown. Facebook takes on misinformation, banning militarized social movement ads, including those from the far-right group QAnon. But is it too little, too late? And the bunny's back. Playboy joins the growing list of companies to go public via a SPAC this year. The details of that are straight ahead. Welcome to On the Move. I'm Adam Shapiro, along with Julie Hyman. Joining us this hour on the panel are Melody Hum and Dan Howley from Yahoo Finance. But we want to talk about jobs. We got the weekly initial claims for unemployment insurance, that on top of what we learned from Challenger Gray and Christmas. 118.8 thousand layoffs were announced in September. That's up 186% year over year. Yes, that is attributable a lot to the pandemic. But what is happening with the pandemic? We've got the latest report on all of this from LinkedIn, and we invite into the program Guy Berger. He is LinkedIn's principal economist to talk about their latest workforce report. Guy, it's good to have you here. And there was something that jumped out to the team here at On the Move that we wanted to start off with you, which was the slowdown in the pace of the recovery and bringing people back to work may have actually hit a COVID ceiling. What does that mean?
Thanks, Adam. That's an excellent question. I think when you look at the first stage of the recovery, whether in our data or in the government data, the first few months we just saw this tremendous growth. I think, to be perfectly honest, was faster than a lot of economists expected. We've seen our data, and to some extent the government data as well, is we saw those big gains through our July data, and then all of a sudden, since in the August data that we had, the September data that we had, hiring hasn't gone anywhere. It's actually down a little bit. And this COVID ceiling is just the fact that a lot of activity that we were used to in the pre-COVID world can't come back yet. We hear that, for example, indoor dining is a restraint. People are still afraid to go to certain places. Travel's not coming back the whole way. That's really holding back whether we can return to 100%. So maybe we can come back to 90%, but not the whole way there until we really get a better handle on this pandemic.
And so, Guy, when you look at your numbers that you guys gathered there at LinkedIn, you showed from August to September a pullback in hiring of about 0.7%. Now, we also got the ADP report this week that showed an increase in new jobs. We'll get the overall jobs report from the government tomorrow. So how do we put all of this data together to get a picture of what's going on in the jobs market right now?
Yeah, sure. So I think that biggest underlying theme is there's a slowdown in the pace of improvement. Hiring has improved enough that the sign on that net jobs number we get, whether from ADP or from the BLS, is positive. But early in the summer, we were adding millions each month. Now the consensus and forecasts are going to add less than 1 million. That's if that's the pace we're going to be increasing it every month, it's going to take a long time to close the gap with all the jobs we lost back in March and April. So to me, the question is not whether we're slowing, but how much are we slowing? Is this something we're going to be back to normal next year if we're lucky with a vaccine, or is this something that is much like the last downturn, is going to take years and years to bring us back to where we were? I hope it's the former.
Guy, are there any particular areas where there are improvements, where we're not seeing any slowdowns? Are there any sectors of the economy, or is it just kind of all over the place, just bad news?
So no, I don't think it's bad news everywhere. I'll give it one example. Healthcare hiring is actually around back to where it was before, which is actually a great sign, not entirely surprising, given what we experienced in the economy. Also, I know that a lot of people, are talking about how hot housing is right now. Both real estate and construction, our data, are not quite back to normal collectively, but they're doing a lot better than the rest of the economy. So I really do think there are parts of the economy that are doing better. But the fact is that if you look at recreation and travel, it's still doing really poorly. Energy and mining is down by a lot. Even somewhat surprisingly, even though software wasn't hit that hard, hiring in software is a little softer than that in the overall economy, which is surprising given that a lot of software companies can work remotely. Maybe they're facing weak demand. But I think, again, this K-shaped recovery everybody's talking about is apparent in our data as well.
And Guy, you mentioned a couple of the industries there that have been hit the hardest, but according to your report, arts actually down 51.5% year over year. I'm curious, just thinking about the structure of LinkedIn and the kind of people who are actually looking for jobs on LinkedIn, is it because it's not including a lot of those creative opportunities? How do you sort of take that into account when you think about agriculture or arts or perhaps construction, where hiring may happen elsewhere and not through LinkedIn?
That's a great question. I think when we look at our data, there's certainly certain kinds of individuals that are represented more, but we see a lot of liquidity across all industries. So to me, I'm pretty confident that arts is weak, and it's not really surprising when you think about it macro. A lot of art spending is some of the most discretionary spending that that people choose. Right now, people are strapped for cash. A lot of them don't have a job. Their unemployment insurance benefits are shorter. They're worried what's going to happen to the economy next, even if they currently have a job. They're spending a lot of essentials. They're worried about paying rent. I think that to some extent what we're seeing with that extreme weakness, also the recreation and travel, is that's the last item people are thinking of spending money on. It's not surprising those industries are doing so poorly.
Guy, we're going to get the official employment situation report tomorrow from Labor Department. What is it that you're going to be looking for within that report to show perhaps a trend as to where we're headed?
Well, I think that still the most underrated item in the report is the number of people that are unemployed due to permanent layoffs. Even as we've seen total unemployment come down, the people that are unemployed due to permanent layoffs have been moving up month after month after month. It's now gone up as much as it did in the first more than a year of the Great Recession. It's at a level comparable to what we had in the 2000 recession. So we have this little mini recession still building up. We know that claims are still really high, way higher than we would have thought would be the case when the economy is recovering. To me, the more that number keeps going up, the longer and harder of a slog it's going to be to get back to normal.
Okay. Guy Berger, it's always good to have you here. LinkedIn's chief economist out with the LinkedIn workforce report. And of course, we've got the big Labor Department report tomorrow. All the best to you and the team at LinkedIn. We will see you again soon. In this environment, whether you are a bull, whether you are a bear, a lot of people are looking for protection. Even if you think the market's going up, you still want to protect the assets which have gained in value. Let's bring in Meb Faber, Cambria Investment Management Chief Investment Officer, joining us from Los Angeles to help some of us who are not incredibly skilled investors make heads or tails of how we might be able to use ETFs or other ways to protect that which we might have gained in the past couple of months. Welcome to the program.
Great to be here.
So what advice do you have to protect a portfolio? I'm going to say right now, if I'm optimistic, because we heard in the last hour, we expect to go higher in these markets. How do I protect what I've already gained? What would you advise?
Well, the best advice would have just been taking a nap or a sabbatical and just missed all of 2020. I think it's a great reminder that normal market returns are extreme. I think most people assume with stocks you're going to have this steady 8% return every year, but in reality, vast majority of the time it's up 30 or down 30, or in 2020 both, right? So the path is quite volatile. We wrote this back in March, but I think it applies for really any market environment. It was called Investing in the Time of Corona, and it was right in the middle where everyone was going crazy, and we said, look, markets are uncertain. You hear that every day on TV. That is well known. So as you think to the future, you could easily make a bull and bear case for U.S. stocks. And I walked through the virus impact and monetary fiscal policy, all that good stuff. So there's one case where you could go down 50% from here, or there's one case where by the end of the year, everything is handled well. We're hitting all-time highs in stocks. And most people, I think, thought that's crazy. There's no chance of that happening. Here we are. A lot of people, I think, still feel this real disconnect between Main Street and Wall Street. Now, if you're going to do the possibilities, the outcomes, you have your asset allocation, we say, look, I'm going to prepare for the bull case. I don't think the right way to think about that is I want to allocate to U.S. stocks. The problem is U.S. stocks are expensive. There's no question they're expensive. Any valuation metric you look at, they're expensive. Now, they're not crazy. It's not like late 99. It's not an insane bubble, but they're on the expensive side. Long-term P ratio around 30. So that's a headwind. And traditionally, looking at markets historically, high valuations don't really protect you if a big bad bear comes. Think Japan in the 80s, booming stock markets around the world, the 80s and 90s. Japan had the biggest bubble we've ever seen, has had no returns for 30 years. So the advice on the right tail, if things go really right, is the rest of the world. So in the other 44 out of 45 developed market countries, most are cheap. Foreign developed, totally reasonable valuation, about around 20. Foreign emerging is in the teens, and the cheapest stuff is down around a P ratio of 10. Nobody wants those. The US stock market's crushed it the past decade, but that's not normal. Normally it's a coin flip on who does better. So the first piece of advice is tilt towards value, and that should protect you if things do well. And you also have to, of course, think about if things do poorly too.
What if you don't want a view, right? Is it more important to have a view on whether stocks are going to go up and down or down at a time like this? or at a time like 2 years ago when it seemed like they were going to do nothing but go up? I mean, is it possible to be, and is it beneficial to be agnostic?
My best advice, we wrote a book called Global Asset Allocation years ago, looked at all the different asset allocations of the gurus, from Swinson to Rob Arnott to Buffett, all their recommended allocations for public market investors. The surprising takeaway was it didn't really matter. You know, it's like making, my mom's here, you guys can see the mess in the background. She's a Southern cook. She makes cookies, doesn't use a recipe, you know, does it by hand. As long as you have the main ingredients, chocolate chips, butter, flour, all that good stuff, doesn't matter exactly how much you have, it's going to turn out okay. Same thing applies to asset allocation. If you look at like the Talmud portfolio in the books, 2,000 years old, a third in business stocks, a third in bonds, a third in real assets like commodities and real estate, doesn't really matter. And the research shows that what does matter is how much you pay for it and avoiding taxes and not doing stupid stuff. So any allocation should do fine, just forget about it. That having been said, the hardest part that people have with these buy and hold portfolios is compliance, is not selling at all at the bottom of the financial crisis and never buying again. We talked to so many people that have done that, not selling in March and saying the world's turning into a zombie apocalypse and never getting back in. So this concept we talk about of tail risk as an insurance, you know, same thing, house insurance, car insurance, it's a cost. But if it allows you to sustain and behave and get to the finish line with the rest of your portfolio, it's a positive benefit. So the main stuff, have an autopilot, forget it, leave it, but consider all the possible outcomes behaviorally to at least let you survive.
Help someone who is not, and I want to be clear about this, as skilled an investor as perhaps someone like you, when you are trying, because most of us go into this looking at an individual stock and just the rudimentary metrics of those stocks, even if we're doing mutual funds or our 401ks. But then you get the ETFs, and you can protect yourself with puts or calls, and you don't have to necessarily enter those contracts. You can do it through the ETFs. Is this a danger zone for those of us who aren't doing it on a daily basis?
Yep, but to be clear, it's all a danger zone. So my starting point that I tell everyone, global market portfolio. If you bought all the assets in the world, that's about half stocks, half bonds, and of that, half US, half foreign. That's starting point. And that is the only passive portfolio. You buy that with a basket of ETFs, it's almost zero cost, no commissions, amazing. Now, are there things you should do from there? Tilt towards value, sure. Buy tail risk. So we have a fund that does this. It puts 90% in government bonds, right? So that used to give you some income, but now gives you a lot less, but gives you the benefit when things hit the fan. Bonds usually one of the only assets that help. This year is a great example. Bonds are up double digits. A lot of people, that's surprising given, you know, where rates are. I don't think they move negative, but it's possible. Rest of the world, a lot of sovereigns are negative. And then with the remainder of the fund, this is in tail, it buys puts, a ladder of puts. And so the whole point of this fund and all of our funds is it makes it easy to buy it with one click. I don't want to muck around with this on my own. So we designed a fund that's simple. It's the lowest cost fund in the entire category, and something that people can understand and it not be some crazy quadruple leverage, daily rebalancing mess that it just gets complicated. So if people want to do it on their own, God bless them. But I think it's a lot easier, tax efficient in the ETF structure.
All right. We want to say thank you right now to Meb Faber from Cambria Investment Management, the Chief Investment Officer. Good to have you here. And we're going to put in a plug with Room Rater, not to give you grief, because as the Talmud said, when your mom's visiting, you can have any mess you want. All the best to you.
And importantly, go Broncos.
Well, we can talk about that later. Let's talk about Facebook right now. Dan Halley, Facebook's making a pledge to ban ads that support far-right groups like QAnon, or what they're calling militarized social movements. Tell us more.
Yeah, essentially what's happening here is Facebook is sort of following up on their pledge to cut down on this kind of content on the site, but in a strange way. Rather than outright banning these groups or groups associated with them, they're banning the ads associated with them so that they can't show up in users' feeds who aren't members of these groups. And if you are a member of this group, then updates and things along those lines will show up further down in your feed than they normally would. But that doesn't mean you can't go to your group's website and look at information there. It just means that it's going to be further down than it normally would. And I think one of the important things to point out here is this comes after the Kenosha shooting, where Facebook was criticized for not taking down that group's page fast enough, the militia there. and more talk about taking down sites associated with militias of any stripe. Really, I think what it comes down to is if Facebook wants to talk the talk, then they're going to have to walk the walk and just take these kinds of sites down.
Dan Halley, I want to move on to something else that has to do with sort of politics in the election. That's not necessarily surprising here. When you get close to an election, it looks like somebody else might take power. Maybe corporate America gets a little closer to that person. That seems to be the case with big tech and Joe Biden. There's a new report that sources data from Open Secrets, which looks at contributions, showing that companies like Amazon and Google have been getting a little closer to the Biden campaign. Melody, this is going into more tricky times, perhaps, for regulation of big tech.
Yeah, I mean, one note of clarification for those who aren't familiar, companies are not allowed to donate directly, of course, to campaigns. So this was, the contributions were made through political action committees, PACs, and of course, individuals within the companies. Jay Carney, a notable press secretary for Obama, he actually worked specifically for Vice President Biden for the first 2 years of the Obama administration. Now he's with Amazon, has been vehemently opposing the Trump administration during his tenure, even at Amazon. So it's curious to think about even someone like him perhaps catapulting back into the White House, right? We saw this sort of surge with former Obama officials entering the private industries, entering big tech in particular, and finding opportunities there. I do anticipate that they're trying to perhaps butter up the Biden administration for potential roles, whether that's CTO, various sorts of positions that could be beneficial to their own career trajectory. I do want to point out that there is a lot of pushback, Julie, when you think about Obama's pretty much hands-off approach, right? When it came to regulating and scrutinizing big tech. Of course, that was prior to 2016. A lot has changed. The world has sort of been upended where a lot of these flaws and potential interference, not only from foreign actors like Russia and China, but also from within, and a lot of conspiracy theories sort of brimming to the surface. I anticipate that even if Biden does get elected, even if all these tech companies are pouring money into his success and potential victory, it's inevitable, right, that there will have to be continued regulatory scrutiny and antitrust scrutiny that, to give Trump credit for, his administration has been pretty vocal about, right? There hasn't been concrete actions just yet. There hasn't been many implementations. However, the conversation has gotten started, kind of cause and effect, right, because of the Trump administration's role and post-2016 election.
All right, let's check some stocks on the move as we head to break. And we're going to start first with Bed Bath & Beyond. When was the last time you heard us say a retailer's shares were surging? Well, BBBY is up, about 33% right now. And here's the phrase: digital first, omni always customer experience. They're obviously, like a lot of retailers, the emphasis is on e-commerce. And in their most recent fiscal quarter, they reported that they had revenue of $2.7 billion, which topped the expectation from analysts of $2.6 billion. That was due in part to an 89% annual increase in online sales. So BBBY doing very well in its fiscal second quarter as they make the shift to their e-commerce, really an emphasis there. Then there was yesterday's darling Palantir. Okay, Peter Thiel's, it's like chaos from the old Get Smart series. Shares are up at the opening bell 4%, but right now they're up about 1%. They debuted yesterday. The reference price was $7.25 a share. They closed at $9.50 a share, right now trading at $9.60. This is the secretive data company that does work for the U.S. government, and we're going to keep an eye on them because Peter Thiel is somebody a lot of investors keep an eye on. More after this.
Pardon me.
All right. Well,
go ahead, please, Adam.
Welcome back to On the Move. There's a lot going on today as we tech markets right now, and we're going to go to Oscar Williams-Groot. He is in London, joining us to tell us the latest on the cost of Brexit.
Well, Adam, it's as ever with Brexit, there's a lot going on, both in terms of what it means for the UK economy, but also the nitty and gritty about the negotiations. The latest twist today was that the EU said they were going to they'd sent a formal notice to the UK over its internal market bill, which you'll recall is this piece of legislation that Britain have tabled that will break part of the EU withdrawal deal related to Northern Ireland. The UK says that it's necessary to preserve trade between the four nations of Britain. The EU says it risks destabilizing peace on the island of Ireland. The EU gave them a deadline of the end of September to back down from this legislation, but they have not. As a result, that's why we've got this formal notice, which is essentially the first stage of legal action against the UK. The UK now has a month to respond. A spokesperson for Downing Street said that they would respond in due time after considering the notice. Now, the pound fell pretty sharply when this was announced this morning, down over 0.5% against both the euro and the dollar. However, we saw it bounce back this afternoon as new reports started to emerge from Brexit negotiations, which are currently ongoing. There was a political reporter for the Financial Times who tweeted saying that sources in Whitehall were saying both sides were pretty confident that they would enter the tunnel at the end of the week. Now, the tunnel is the sort of super secret phase of negotiations when the actual text of a deal should be worked out. So this is obviously pretty positive, and we saw sterling make up all of the losses that it had experienced earlier in the session. However, since then, it's come off a little bit. The Prime Minister's spokesperson this afternoon put out a statement that was a little more lukewarm. They said that dialogues are continuing in a constructive spirit, but said it was certainly possible that informal talks could continue next week, suggesting that maybe we aren't as close to this final stage of negotiations as we had hoped. However, they have to get things done quickly. The deadline for a deal is October 15th. And as time ticks away, back to the cost point, firms are not waiting around. EY, the consultancy, said this morning that 7,500 financial jobs have left the City of London since the 2016 Brexit vote, and £1.2 billion worth of assets have been moved to the EU, showing this huge drain towards the continent. Now, EY said they expect more announcements in the coming weeks, given how close we are to the end of the transition period. Companies need to be set up to serve EU clients by the 1st of January next year. And at the moment, we seem to be no closer to knowing whether we actually will have a deal. All eyes will be on negotiations tomorrow. We will get a statement when official talks end between the EU and the UK. Depending on the tone of that, I expect to see quite a bit of action in the pound tomorrow.
We'll be watching it. Thanks so much, Oscar. Appreciate it. We are also watching action in the companies that came public yesterday through direct listings. I'm talking about Palantir and Asana. Remember, Palantir actually traded down from its high of the session. In fact, lower than its opening trade. The shares are now up about 1%. They've been bouncing all over the place today. Asana went up in its first day of trading, but is trading down today. So there you go. Dan Howley, let's talk about Palantir for a moment here, because is it a situation where there was just so much hype, it couldn't live up to it? But we're seeing a lot of other companies come public and go up a lot that are hyped.
Yeah, I think there was hype and there was also confusion as to what Palantir does. They're still very secretive, despite now being a publicly traded firm. They didn't obviously have to go through the same scrutiny as a traditional IPO because of the way they went to market. I think really what the issue is, though, is, again, people don't know what Palantir is all about. It works with spy agencies. It works with different government entities, the DOD, the Pentagon. It works with local law enforcement. And then it also has a secondary arm where it works with manufacturers to streamline their processes. So I think the idea here is people look at it, they look at CEO, co-founder Alex Karp talking about drone strikes and capturing or killing terrorists, and then on the flip side, talking about helping automakers improve their processes. So I think it really is just an idea of this company being still a known unknown.
Interesting. Speaking of known unknowns, SPACs would seem to fall into that category, right? We've seen a lot of them this year, those special purpose acquisition companies that then acquire privately held companies and bring them public. There's less disclosure involved in that process, as we saw through the Nikola situation. A couple of things to mention on the SPAC front today. First of all, there is a new ETF that tracks SPACs. SPAK is the ticker on that one. And then there is also the news that the confirmation that Playboy is going to be coming public through a merger with Mountain Crest Acquisition. It's going to be about a $381 million deal. Adam, this is mostly sort of a licensing company at this point, but this is an interesting one to get SPACed.
It is, because when you consider, look, Playboy's been around. First issue was what, 1953, Marilyn Monroe on the cover. They went private when Hugh Hefner, obviously still alive, back in 2011. Now they're coming back to the public, and part of this is putting $100 million onto their balance sheet because they are expanding in some ways. But part of it is, if you think of them as just a visual entertainment kind of product, they're also going into apparel, adult apparel, obviously, but this is going to help them do that.
Kind of taking a quick pivot here, going from something very misogynistic to something perhaps female empowering. It's pretty interesting because the former Hearst editor, Joanna Coles, and former chief content officer there, she actually has been tasked with leading a SPAC through the Northern Star Acquisition Company. They're looking to sell 30 million units at $10 a share. This is one of only a small number of female-led SPACs looking to raise a total of 300 million. And she, of course, is on the board of Snap, based here in Los Angeles. And it's been interesting to see a lot of unlikely candidates, right, come into this space. And I guess time will tell if this will be a net positive, right, for the industry at large.
Yeah, we'll see what company they end up snapping up, or companies. Thanks, Mel. Well, as we take it a break, have a fun story for you, perhaps. Ireland's Supreme Court has ruled that bread sold by Subway contains so much sugar that it can't legally be defined as bread. This was part of a tax dispute that was brought by an Irish Subway franchisee. And the case rested on whether the bread for Subway sandwiches counts as a staple food and therefore would not be taxed. It looks like it did not indeed fall into that category, the smells that waft from Subways all over the world notwithstanding. We'll be right back.
And welcome back to On the Move. Let's check the share price right now for Medtronic. We talk a lot about pharmaceutical companies and the race for a vaccine, but here's a company that is making some of the devices that are necessary for the treatment of COVID-19. In particular, we're talking about these ventilators. And here's the problem. The Wall Street Journal has reported, you see the shares are off a bit today, that the Justice Department is investigating whether Medtronic, through a series of acquisitions that were taking place before they actually acquired Covidien back in 2000, I don't have the exact year, but this DOJ review goes back to 2012, whether or not they were trying to create a situation where they would be able to control the products that go into ventilator manufacturing. So this is an antitrust investigation, according to people that the Journal is citing, as DOJ probes this situation, because there are complaints about ventilator shortages during the pandemic. And this is something now that DOJ is zeroing in on. Julie?
Indeed, and where those various devices are made has also been a big focus of the White House. So let's talk about another company that is in this business, although a different part of this business. It's called ResMed, and it's a digital health company. It focuses on things like sleep apnea, chronic obstructive pulmonary disease, also known as COPD, and also things like COVID-19. I want to bring in the CEO now. That's Mick Farrell, who is joining us from California. Mick, thank you for joining us. I do want to ask you about this investigation, first of all, because I think this pandemic has really shown a light on the ventilator industry. But if you could talk to me about where you guys sit in that industry, because you do what, non-invasive respirators, if I'm not mistaken, those that don't require intubation. Is that right?
Yes, Julie. Well, here at ResMed, we actually do non-invasive ventilators as well as invasive ventilators. So everything from a CPAP or APAP, which treats sleep apnea, through to a bi-level device, a non-invasive ventilator, and an invasive ventilator that does life support ventilation. So we actually do the whole spectrum. During COVID-19, we have a plant in China, Singapore, and Australia. The China plant saw this huge demand signal in Wuhan, where demand went almost infinite right there in January, February. And so we were right there at the start of COVID-19, and we were able to ramp up our local manufacturing. As it moved to Europe, and we saw the demand signal in the Lombardy region in Milan. Again, demand went almost infinite. We ramped up our global manufacturing. And then, of course, we know it went to New York and across the United States and the developed world. And ResMed tripled our whole production. We made 150,000 ventilators from January 1 to June 30, which was 350% of the same period in 2019. So we and the other top 5 manufacturers really ramped up our production to meet almost infinite demand, just to keep people breathing. We didn't save their life, we just kept them breathing. And if their immune system overcame this coronavirus, then they lived.
So Mick, I would ask then, I'm skeptical that I don't know that you can directly comment on the Medtronic situation, but in terms of the competitive landscape then, have you seen any sort of what you would describe as antitrust activity or crimps on your ability to compete, as you say, among the top 5 ventilator producers?
Yeah, Julie, obviously I can't comment on another medtech company, but what I can say is what I saw as a board member of AdvaMed, which is an industry advocacy group across medical devices where all the top manufacturers sit. We sat with the AdvaMed group and said, when the demand signal came through, particularly in the United States, let's make sure that we're all able to deliver this. And so we actually worked with our supply chains and we had tech companies like Google help us set up interchanges from defense companies and aerospace companies to help us make the parts and pieces for these ventilators, because one ventilator might have 500 pieces or parts or 1,000 pieces or parts, and you're looking to triple production globally. So one of our biggest challenges together was to get the supply chain to be able to ramp up to 350%, even 500% of the flow of parts and pieces. But we were able to do it, and we were able to meet the peak demand in almost every city in the world. I think just Wuhan, Milan, and New York, which peaked very rapidly, probably got a little bit ahead of us, but we sell in 140 countries worldwide, and we were able to provide the demand pretty much for every city worldwide, apart from maybe 2 or 3 that had that super ramp up. Remember that super ramp up we saw in March and April? But look, between us and the other 5 manufacturers of ventilators, we pivoted our whole business to be able to take care of people during COVID-19. And it was a humanitarian sort of epidemiology-based model that we used to determine how many products we could provide. So when the demand in New York and the United States was infinite, the US government came to us and said, how many devices can you make, ResMed? And we said, well, this is how many we make globally, and this is how many we think we can make for the United States. And we said we can make 2,550 ventilators for HHS, for FEMA, and for a $32 million contract. And we delivered on all of those and have made all the final shipments of those. And so, you know, that's the type of thing we did in 140 countries worldwide. And I've got to say, I'm incredibly proud of our industry and what we're able to do, because before this crisis, ventilators was less than a single-digit percentage of ResMed's business. And we pivoted, you know, 7,500 of our team, of us ResMedians, to be able to quintuple production on a weekly basis, 350% across that 6-month period, and get the ventilators to where they were needed based upon that global epidemiology model.
I know the urgency right now can sort of be all-consuming, right? But when you think about the potential respiratory effects and long-lasting damages for those who've had COVID, for the family members who have been kind of inflicted with this crisis, how do you anticipate your business changing? Do you expect more households to say, hey, we need a respirator? This is going to be something that is an essential part of our livelihood?
Well, Melody, I think there'll be sort of 3 things that happen during COVID-19 that will fundamentally change digital health. I mean, the first is the importance of respiratory medicine. If I'd been on this show in December and asked you, Melody or Julie, you know, what's the most important organ in the human body and therefore the most important medical device, you probably, but you know, cardiovascular disease being the #1 killer, would have said the heart. And therefore, yeah, Medtronic or Boston Scientific or Edwards Life Sciences, heart valves and pacemakers. If I'd pushed you again and said, no, Melody, no, not the heart, give me another organ, you might have gone to the brain and talked about stroke and stents and neurostim devices to prevent or treat stroke. At best, the lungs, our industry, would have been third fiddle. And COVID-19 has raised respiratory hygiene, respiratory health. We make a digital health inhaler to help people take their COPD medicines or their asthma medicines for children. The use of pharmaceuticals to treat lung disease and asthma went up double digits, the adherence to the prescribed therapy, just because of COVID-19. The use of our masks for CPAP devices, there's these masks and filters and tubing that's used as sort of replaceable devices, they went up double digits as well. And it's been a permanent change. So respiratory hygiene has been very important during COVID, and that'll fundamentally change our industry, adherence to respiratory medicine. The second thing is digital health. Nobody wanted to go to a hospital. Nobody wanted to go to a doctor's clinic. And so we have cloud-based systems. We have 12 million 100% cloud connectable medical devices on people's bedside tables around the world. We have 6.5 billion nights of data in the cloud. We're able to use those data to contact patients, to work with them, to increase adherence, to lower costs for setup of therapy. So the importance of digital health picked up. And the final thing, the third and final thing, is that COVID-19 showed the importance of outside hospital healthcare. During COVID-19, they actually locked down 2 or 3 floors of most hospitals and put PPE in, reverse dealing with the air conditioning so that all the COVID-19 particles could be removed from the air. Nobody wanted to go to a hospital. ResMed's business is 95% outside the hospital. We think those 3 things, the importance of respiratory hygiene, the importance of digital health, and the importance of outside hospital care, were hugely important these last 6-9 months of the crisis, and will be fundamentally changing healthcare and how it's delivered for ResMed and for respiratory medicine forever.
Very interesting stuff. Mick Farrell, come back with us in a few months and we'll talk about how this is all evolving and changing. Mick Farrell is the CEO of ResMed. Thank you so much.
Thank you, Julie.
We'll be right back. Welcome back, Tom. We're going to check out now with the guest we had on a couple of months ago to talk about the launch of a business that stands at the intersection of important issues that we're talking about right now. One of them is buying BIPOC made and owned brands, that is Black, Indigenous, and people of color. It's also a woman-owned business and starting a business right now, at the time of COVID. We welcome back to the show Chana Janelle Ewing, who is the founder and CEO of Genie. She's joining us from Brooklyn. This is a marketplace, an online marketplace for beauty products. And Chana, first of all, tell us how it's been going. You launched just a couple of months ago. At the time that there is a lot of demand for products that are owned by people of color, the companies that are owned by people of color. How's it been going?
Thanks for having me again, Julie. Yes, so as you mentioned, we launched right at the tail end of July, early August. And we launched at the time with just five brands and five lipstick SKUs. And since then, we've expanded to 9 brands and have over 20 SKUs. And so we expanded with the help of our community. Genie is a community and marketplace that enables consumers to discover, shop, and share brands that embody their beliefs. So that's including BIPOC, LGBTQ, women-owned brands, but also sustainable, clean, toxic-free. So our idea is that you shouldn't have to bounce around the internet to be able to find brands and source products from communities that you'd like to shop from that also meet the same sort of ethical and clean values that you may also be looking for as a consumer. And so with our community, we were able to expand into both, so we started with the lipsticks and now we moved into eyes and also tools based on the feedback that we received from our community.
Hi, Ms. Ewing, and congratulations. It's still early, I imagine, to ask you for, what are the sales numbers and if you're going to make those public. But I am curious, because it takes such courage to launch a business in this kind of environment, what you're hearing from the clients. Clearly, things are at least on track, and I'm going to assume and hope they are going well because of the expansion. But where do you go next, and what are the clients telling you?
Yeah, so it's cool because we took a community first perspective, meaning that the folks who are shopping from Genie, we actually have an app that that we're using called Geneva that enables them to just have conversations with them on a regular conversations with each other on a regular basis. And so there's not a lot of pressure to shop all the time because they're just always connected with each other. They're always talking about and sharing new brands. So while they are shopping through the marketplace, we're also just creating a space for them to just, share their love for beauty. They're in there doing self-organized beauty tutorials. They're recommending brands that we should follow and highlight. And they also helped us figure out which colors and which products to use for our first set of brands. So when we said, hey, we want to bring on another color for Go Label Cosmetics, for instance, we polled our community and we said, hey, what do you think? And they decided which colors. So we got a lot of buy-in from them and they feel like they're a part of this process of growing the business with us and also supporting the brands that are on the platform.
John, I want to ask how the pandemic has impacted sales, especially of makeup. I know, we've talked about this before on the show about how sales had slumped at the beginning because people didn't necessarily feel the need to put any on. But now that this is kind of the way the world works, I guess, have you seen them pick up again for you guys?
So makeup in general tends to be recession proof, right? Like people tend to buy makeup all the time. I will say that obviously because we're not leaving the house as much and because we are wearing our masks, the value proposition for lipstick, for instance, we're like, wear the lipsticks when you're on Zoom. Like I have on one of our brands right now, Femme Power Beauty. And I think, having a great lip for Zooms is great. But one of the things that we polled our community on is, well, what makeup would you want to wear right now? And the natural progression was eyes, because everyone is wearing masks right now. Having a focal point on the eyes, on the eyebrows, makes sense for consumers, because they can see that their eyes are going to be visible and people are going to be looking at them more so than their full face.
That makes sense. We've all learned to smize, of course, a lot more. Chana Giselle Ewing, it's great to see you again. Appreciate it. She's the founder and CEO of Genie. Well, we also now want to bring you part of our Andy Serwer, editor-in-chief's conversation with the One Campaign president and CEO, Gail Smith. That's from the latest episode of Influencers. They talked about government response to the pandemic.
We need a plan globally so that we've got vaccine equity, which isn't simply fairness, but it is also the kind of coverage that the epidemiology tells us that we need so that we can shorten the lifespan of this pandemic. That requires leadership and engaging the rest of the world in a way that I don't think we're seeing now, where in contrast, during Ebola, President Obama convened a summit with the Secretary General of the UN. It was top of agenda in the UN Security Council, the G7, the G20. He sat in the Oval Office. I was with him many times, called leaders all over the world to say, what are you going to do? What are you going to do? We all got to work together and get this done. So I think we're much more fragmented, not nearly science-oriented enough, and we're not planning ahead. Other than that, it's great.
You can watch that entire conversation on the latest episode of Influencers. It'll be on our website this evening. We'll be right back.
Welcome back to On the Move. Word on the street, Melanie Hom, Google making a pledge, which I guess for those companies that got decimated by the internet over the last 20 years, it's a start.
Yeah, and the tech media convergence continues, right, Adam? Google pledging $1 billion in licensing payments to news publishers over the next 3 years. To put that into context, though, Google's parent Alphabet reported a net profit of $34.3 billion on revenue of about $162 billion last year. So what that means is $1 billion is 0.6% of total revenue. So it's a kind of a chump change, right? We're talking about when you think about this sort of an effort. They have not signed on any US publishers just yet, but they have collaborations across Germany and Brazil. And we do anticipate that there will be more tie-ups in place. What the feature will allow is images, a little blurb of a summary And this, of course, as more folks are getting their news on Google, on Facebook, on Twitter, becoming heavily dependent on these platforms.
Dan Halley, House Democrats are making a call that we've heard others say in the past, but what now? Big tech, break them up? How?
Yeah, they're going to be calling for big tech to break up likely once they complete this investigation they have into Facebook, Alphabet, Amazon, and Apple. This is the House Judiciary Committee subcommittee on antitrust, commercial, and administrative law. They've been looking into big tech for quite some time and apparent antitrust violations. And it seems as though they're going to, Democrats at least, are going to recommend that big tech companies are broken up in some way. This is just one of the investigations going on, though. There's still the DOJ and states attorneys general looking into them.
And it's one of the rare moments of unity among Democrats and Republicans, their criticism of tech. Melody Hom, thank you. Dan Howley, thank you. But first, let's check markets because we are looking at gains. Part of this is a phone call that's going to take place 1 p.m. between Nancy Pelosi, Steven Mnuchin. They're trying to push through stimulus. Remember, the Democrats, $2.2 trillion. The Republicans are saying, look, anything with a 2 is too much. So there's hope, at least on Wall Street, that maybe there is stimulus coming. Also, do not forget our coverage tomorrow here on Yahoo Finance. We've got the all-important September jobs report. We're going to be taking a look at that. We listened to Guy Berger, the chief economist at LinkedIn, who said, look at the permanent layoff number. That is a key we will look for. But right now, we're going to hand it off to the next show here on Yahoo Finance. All the best to you.
Welcome into live market coverage here on the ticker. I'm Zach Guzman. Right now, to kick off the month of October, all three major indices are in the green, with the Nasdaq leading the way, up more than 1%. The Dow and the S&P up by about 0.5% right now. When you look at the sectors on the S&P, energy, the lone sector in the red, off nearly 3% today as crude prices once again take a pretty big hit here. We've been seeing volatility in crude as they've tried to trade above $40 a barrel, but today off by about 5%, back down to $38.26 a barrel on West Texas Intermediate. Also want to highlight a couple other moves here with some announcements coming from some individual names. Canopy Growth shares are in the red despite announcing plans to bring their cannabis beverages here to the U.S. market, a much larger market when you look at the size compared to Canada, where that company has been operating through its partnership with Acreage. The company says that it will be rolling out those beverages in Illinois and California starting in the summer of next year. We'll be chatting with the CEO of Canopy Growth, David Klein, later on in the show, but want to highlight those. Also want to highlight the pop in shares of the Oxnard, California company, Mission Produce, the avocado supplier here, vertical integrated, coming to the market today. Quite the move here in Avo shares, ticker AVO. We'll be chatting with the CEO of that company later on in the show here as well. An interesting break from the traditional tech IPOs we've been seeing come out as a large producer here of avocados. It should be an interesting chat later on. Also want to highlight the update we're getting out of Washington, D.C. here as we again continue to track the talks between Treasury Secretary Steve Mnuchin and House Speaker Nancy Pelosi. The two are slated, according to Politico, to resume discussions right now, actually, after speaking this morning. The update was not necessarily good there when House Speaker Pelosi told her own caucus that she was still pretty far apart in those talks with Treasury Secretary Mnuchin, but we'll see what headlines come out of that, what headlines come from those debates here, as again, Democrats might move in the House with their own $2.2 trillion proposal here. That's come down from the prior more than $3 trillion they've been discussing. So we'll see what happens there. But first, want to kick off the show with the update we got on the unemployment front here, as again, we got the Department of Labor giving us the latest weekly initial jobless claims totals, and those actually ticked down by about 36,000 for the headline number, as well as the full report here. Want to get to Yahoo Finance's Emily McCormick, who has the details. Emily?
Well, Zach, we saw a bigger than expected improvement in new jobless claims this morning, though those are still elevated on a historical basis. Now, specifically, new claims totaled 837,000 last week for a print better than the 850,000 expected and upwardly revised 873,000 we saw during the prior week. Now, this marked the fifth straight week that new jobless claims came in below the 1 million mark. We also saw a decline in the seasonally unadjusted claims to reaffirm that improvement. Now, that said, we're still well above pre-pandemic levels when it comes to new claims, since those had been coming in at a rate of about 200,000 per week as recently as February this year. Now, also want to point out that there is a big caveat in this morning's report, and that is that California, the state that has consistently shown the largest number of jobless claims and increases in claims each week, is taking a 2-week pause in processing initial claims. Now, the state is using that time to reduce its claims processing backlog and add fraud prevention technology. But in the meantime, we aren't getting updates on new claims from California, so that certainly will be something to watch in the weeks to come to see if there is give back here once those claims are counted again for that state. Now, taking a look at the data that we do have, the majority of states did report improvements on an unadjusted basis in new claims last week. We saw that led by Florida with a decline of 9,600 claims to about 29,000 last week. We also saw Texas and Georgia reporting sizable declines in new claims. Now, on the flip side, do want to point out that Maryland and Illinois each added the most new claims at 2,800 and 1,900 respectively. And also want to note that the nationwide continuing claims count fell below 12 million for the first time since April in this past week's report. Those were at 11.77 million versus 12.2 million expected and 12.75 million during the prior week. Zach?
Yeah, and Emily, as we like to do, it struck me today too, because we got the update and the breakouts by state. As we've noted, Hawaii has been leading the nation when we look at the insured unemployment rate, the measure of how many workers are on unemployment. And it's states pretty steady. I mean, we've been talking about how these weekly jobless claims numbers have trended down, but been pretty steady in terms of holding around this 800,000 plus level here. But Hawaii has steadily always been leading the nation when it comes to that unemployment metric, still here at a notably high 21.3%, followed by California and Nevada above 14.5% there, as well as New York, Puerto Rico, and Louisiana, the ones that we see continue to kind of come in at some of these hardest hit states. But interesting to watch week by week how they continue to navigate this. And in the case of California, how they continue to deal with backlogs in all of these claims as well. But Emily McCormick, appreciate you bringing that to us. Meantime, let's talk a little bit more about the health of this recovery, because as we were just discussing, I mean, unemployment's one metric to be looking at here, but we also got the update in terms of Americans' income for the month of August, falling by the most in 3 months after we saw the first clip here reported after those July 31st benefits expire, the additional $600 coming in unemployment claims at the federal level. And that 2.7% decrease in personal incomes came after we saw an upwardly revised 0.5% gain the month prior, according to Commerce Department data. So let's discuss how the consumer overall here in the U.S. is holding up with our next guest. George See is Annandale Capital CEO, and he joins us right now. And George, I mean, putting these things together, you just heard the update on the unemployment front there from Emily. Of course, tomorrow we're going to get the big jobs number for the month of September. But as you put these data points together, what are you seeing in terms of the state of the U.S. recovery? And you might need to unmute yourself before you can give me the answer on that, because we're trying to put all these things together. But what do you see out there right now?
Well, Zach, that was framed very well. I think the quick answer is it's mixed. You go industry by industry. You know, some of these high tech industries that are really paying off for the aversion to going back to real estate sites and working from home instead, and things you can do from your own home or from remote locations are prospering. They're even aggregating their advantages over other such industries, whereas more traditional industries such as restaurants, hotels, airlines, real estate are just suffering. And I would also say there's a deep philosophical divide in our country right now, which I would view as unhealthy. I think we've gotten a lot more knowledge about the virus than we had 6 months ago. We know who's most vulnerable. Those people should continue to stay in a low profile and get out as little as possible. And everybody else needs to get back to work. And when you were talking about unemployment statistics and wage statistics, there's a real split between states that have gotten their people back to work and states that are still in the bunker. And I think there's a lot of political basis for states that are still in the bunker. And I think it's very unhealthy, and it's very bad for the common man and woman, the worker bee. And I think they need to change their policies. They're all waiting for pennies from heaven to come down from Washington, and that'll blow an even bigger hole in our federal debt and our annual deficit. And I think that's bad policy. I think some additional relief is warranted, but I think we need to get people back to work in every state, not just states that are taking a chance on that. We know how to protect the people most vulnerable, and everybody else needs to get back to work.
Yeah, I mean, I hear you on getting people back to work, but I think some of these statistics coming out here might show that the demand might not be there, at least in these hardest hit sectors. When you think about airlines, people not traveling, hotel stays, I mean, it's not surprising as to why Hawaii might be leading the nation when it comes to insured unemployment rates. But when you think about what's going on here, when you look at stocks too, because obviously you want to get your investor take on the volatility that could be up here as we approach the election. I mean, on that front, the data coming in seems to show a recovery that's slowing. That's what economists are seeing. I mean, even the income level we're talking about for August came in line. So economists were expecting that 2.7% drop. They had it at 2.5. But when you think about maybe where equities might be right now, what are you telling people out there for how they should be playing this if we're not expecting a lot out of Washington? We'll see what happens. But it seems like people are becoming a little bit more pessimistic that support's going to be there.
Yeah, that's why I said it was mixed. There's some industries that no matter what you do, they're still going to be suffering because there's just not the fluidity of movement among consumers to warrant them doing better. And there's other industries where people can just get back hard at it. As for equities and investments, if I were investors right now, you've got so much uncertainty going into the election, and the market has been relatively calm, which is really hard to believe considering all the uncertainty we've got going out there in terms of tax policy, regulatory policy, who's going to control the Senate and the House, so forth and so on. So I would really emphasize right now businesses that investors understand, that pay you a nice dividend while you wait, and where you know you're getting a historically priced equity that is deeply discounted to how it's traded in the past. I would really focus on stocks like that. I wouldn't be momentum oriented at this point because momentum can flip on a dime. And I wouldn't overweight companies that are strongly positioned against the pandemic, just especially those that are 3-4 times the valuations they've been in the past. I would really look for things where you're going to collect a nice dividend while you wait around to see what certainty looks like in 2021.
I mean, when we had the Nasdaq dip back into correction when volatility hit just a few weeks ago, it was those growth names that you're talking about that did get hit the hardest, something that we noted. We'll see what happens there. And of course, we'll see what happens when we get that big jobs update tomorrow. But George See, Annandale Capital CEO, appreciate you taking the time to chat.
Thanks, Zach.
Meantime, I want to shift over to the focus on the update we're getting on the coronavirus front there. Cases yesterday in terms of new daily case count came in at 43,380 new cases reported, which was up more than 5,000 versus the 7-day ago average. That's the biggest rise that we've seen since mid-July, if you go back and kind of factor for Labor Day distortions there. It has more people concerned as more economies here move to reopen, as well as schools bringing back students. What could happen here? So joining us to discuss that is Dr. Amish Adalja, senior scholar at Johns Hopkins Center for Health Security. And Dr. Adalja, first up, I mean, it's happening right here in New York. We're seeing the city, we just reported the most new cases we've seen since May. So very much in line with what we're seeing play out at a national level. But we've also been the first major city to reopen all schools. So I guess the question there, since we had about 500,000 students coming back in here from ages 3 all the way up through high school, how big of a piece of the pie do you think that schools reopening is playing here versus some other risks out there that experts are trying to parse through in this potential second wave?
So if you look at New York City, it's actually interesting. There's actually only 9 zip codes where you're seeing this increase, and you're not seeing that increase related to schools. You're seeing this in neighborhoods where masking is low, where social distancing is low, and it isn't really being driven by the schools. So I do think that there are other factors at play, and we know that schools are something that have to be handled very cautiously. But so far, it's been good with schools in general that we haven't seen large outbreaks linked to the opening of schools, especially when you're looking at the K through 6th grade level. But it is something we have to watch, and each part of the country is going to have different dynamics. But so far, it seems to be driven more by adult behavior than it does children's behavior.
When you talk about adult behavior, I wonder how much of that might be kind of stemming from confusion out there. We saw that play out on the debate stage earlier this week when President Trump was talking about Dr. Fauci and how he claimed he had kind of reversed his thinking around masks. Masks continue to be one of those topics, for whatever reason, it's still pressed out there. And an interesting new survey here, I guess a data look from researchers at Cornell, looked at who might be spreading some of these ideas out there or conversations around misinformation stemming from the data here. And they targeted President Trump, saying that he made up about 38% of overall misinformation conversations out there. When you think about what kind of direction we've been getting from the CDC, the FDA, or out of the White House here, how much of that do you think is to blame for some of the confusion on the part of businesses or consumers out there trying to navigate this crisis?
I think it's a major component. We know that there's been actually, I would say, almost a concerted disinformation campaign from the White House to minimize what this virus means and to take the wrong actions and then try and defend those wrong actions. And what we've seen is mixed messaging, undermining of expertise, undermining of people that are supposedly running the response at the CDC and the task force. So this is, if you're in the public, you're not going to have a clear message from the government, and that's not what you need in an emergency. You want to have clear messages that are actionable, that are based on evidence, and that reflect expertise. But what we've seen here is the opposite. So in general, I think it's actually a disgusting situation that the president is one of the major sources of misinformation on this life-threatening cataclysm that we're facing.
Yeah, and I mean, not to say that changing positions might be wrong. If you get new data that could come out and say, all right, look, we've learned this, and that's what we've seen, at least out of Dr. Fauci and the way that he's updated his thinking there, and he's explained that. But I guess, maybe to push back on the idea that things constantly reopening might lead to crisis. And I mean, we've had this discussion here on this show with the mayor of Kansas City, Missouri, when they were inviting fans back to NFL stadiums. They haven't necessarily seen an outbreak disaster scenario like some medical experts were warning about. Of course, we did get the update that the Titans-Steelers game is going to be postponed after new players there, a player and a team employee, tested positive for the virus today. That would bring the total infections for the team to 11, so they're going to postpone that game. But we haven't necessarily seen huge outbreaks in Dallas or Kansas City, some of these other cities that have been hosting stadiums and fans, up to about 20,000 fans almost in some of these stadiums. So what does that mean to you? Does that necessarily, I guess, signify that some of these safety protocols that were put in place are actually working, or that maybe the fears aren't as bad so long as people do wear masks and follow all these protocols in place?
I think mass gatherings are going to be very difficult to have. And I think it's good. It's reassuring that they've been able to have NFL games with fans in certain areas and not see any uptick in cases related to that. And I do think it reflects the fact that you have to put some kind of plan in place. You have to think about all of the different scenarios and try and minimize the risk of the virus. The virus is clearly in those stadiums. It's hopefully being kept at bay because people are following social distancing, because they're wearing face coverings, and because of all of the other steps that are put into place by the NFL. But it's not ironclad, and I think we have to continue to look at this and learn the lessons from them. And if it can be replicated other places, that's great. But I think we have to be prepared that this isn't always going to be as lucky as it's been so far with the NFL.
Yeah, I mean, when we looked at the Kansas City case, one test positive, one fan did test positive. They had about 10 fans that came into contact that were asked to quarantine. So, I mean, those protocols were followed, even though that fan technically wasn't supposed to be allowed into the suite since he did not report the test. And that data was supposed to be there before he was allowed into the stadium. But regardless, I mean, when we think about, just to circle back to the trust in the process here, specifically as we await kind of the data in these phase 3 trials, regarding these vaccine candidates, more and more polls coming out. This latest one here from Statton Harris shared with Axios, indicating that more Americans here, 75%, said they worry about politics rather than science driving the process here. And that could lead to a lot of those out there, a majority saying that they would not want to get a vaccine. So what do you say to that, and how, everything we were just discussing about mixed messaging could actually have real life consequences here, even if we do get a vaccine that's safe and that could be administered?
I think the issue is really that there's been so much misinformation out there that it is something that we have to understand that the general public is going to have problems dealing with. That this is something that we've seen from the very beginning, and it's not surprising to me that there is some reticence, because we've seen hydroxychloroquine and convalescent plasma issues really be colored by politics. And I think this is what we have to expect when we have this much disinformation and this much political meddling. And it's unfortunate, because a vaccine that doesn't get into people's arms is not going to be an effective vaccine.
All right, we got a lot to watch there. We'll see how all this plays out as we continue to wait, what kind of data we might get. Pfizer seems to be the closest to giving us that update. We'll see. Dr. Amish Adalja, Senior Scholar at Johns Hopkins Center for Health Security. Appreciate you chatting as always. We're going to take another break here, but when we return, taking a look at an unorthodox IPO to come out here, a break from the traditional tech discussions we've been having. We'll chat with the CEO of Mission Produce, the largest avocado name, new player out there for us to go ahead and trade around, why the growth there has been a bit more surprising than you might think. We'll chat that. Stay with us. Welcome back to the ticker. Right now, I want to have a discussion about a new IPO here, and it's a break to some of those tech stocks we've been talking about recently. Today, Mission Produce, an Oxnard, California-based company here. It's a leading distributor, grower, and packer of fresh Hass avocados, went public. And right now, shares are trading a bit higher than their opening trade here at $14.17 on day one. It was lower than the initial range that they were looking for here in the $15 to $17 price point. And we're opening now a little bit below that. But here to discuss the growth opportunity in the avocado space, as more and more Americans are munching on a guacamole, the CEO of Mission Produce, Steve Barnard, joins us now. And Steve, I mean, I noted there, it might not have been quite as high in terms of the price point here for shares in this. I'm not sure if that's tied to maybe the slowing growth as you guys reported it here in your S1, but talk to me about the opportunity here and the unique role that Mission Produce plays when it comes to avocados being consumed, not just in the US, but around the world.
Well, thank you for having me for starters, but Mission Produce is the largest producer and distributor of avocados in the world. We're based here in California. We started here in 1983, but as the avocado revolution took place, we expanded globally into Mexico and Peru and now in Guatemala and Colombia to have enough supply year round. But we actually led the revolution, the avocado revolution, by providing ripe avocados to retail back in about the year 2000 and when we started. And what that did, it provided a ripe avocado to consumers at retail specifically, but also we're doing that for food service also. But consumption went up 200 to 300% at retail in the first year that those retail chains switched over to a ripe program. So what we created is a revolution. And then from there, we had to back it up with enough supply to fill the need. And we're actually seeing that happen globally now. The consumption here in the United States went from 2 pounds per capita about the end of the 90s, early 90s, and now it's at 8 pounds, and we continue to see growth opportunities ahead. Mexico, by comparison, is at 15. So, I mean, we have a lot of runway to go here in the U.S., but we're continuing to look offshore. Europe is a big opportunity, and Asia is starting to eat avocados. So we've got lots of runway ahead. We're very excited about the future, and we're in position to get that job done.
Yeah, normally I would jump in here and say, hold on now, let's push back on the idea of this avocado thing being a revolution. But I mean, when you look at the growth rate, as you guys listed here, I was surprised to see a 12.5% compounded annual growth here in your volumes from 2009 to 2019, 14.5% on the same metric for revenues over the same time period. But also, I mean, the scale here is important when we talk about you guys vertically owning 10,000 acres in Peru, 8,300 which are already producing avocados. I mean, when you look at your customer base, I guess that might be a question when we think about COVID-19 and the impacts here, because your net incomes for the last 9-month period did drop pretty considerably versus last year. So talk to me about that client mix, since I know you work with Kroger, you work with Costco, you work with Chipotle. So what are you seeing in terms of demand now in this pandemic?
Well, the avocado demand is actually up. It's a healthy food. It's a superfood. People are eating healthier now. But how we sell them has changed a little bit. Prior to COVID, we were about 16% food service. That obviously has taken a hit. We're fortunate enough that over 50% of our food service business is casual, fast food casual, which is the upper end scale of the food service business. So we're back to about 90% of our food service business, but the retail side of it has really boomed. People are shopping less, but buying more when they're there. So what they're buying has changed a little bit. Rather than a ripe avocado, they're buying bags and bulk displays type of displays. So the volume's there. It's just a different avenue to get it to their plate, so to speak.
And when we talk about, I guess, your guys' own metrics and your own operation there, as you guys noted, in 2019, you produced about 11% of the avocados you sold, and you expect that to grow here as your own farming endeavors continue to take off. How might that help maybe turn around the fall in net incomes that we saw so far at the beginning of 2020 here? I mean, talk to me about how that shift might actually help Mission Produce moving forward.
Well, most of that production is in Peru. We have purchased 10,000 acres of land down there. We've planted about 8,300 of it. And of the 8,300, about a third of that is non-producing. It's planted. The money's been spent, so to speak, on the development. So we'll have ample supplies going forward. And one of the things that gives us is obviously a guarantee of supply as we continue to grow globally. we need to know where that product's originating and what the time of year of it is. So that's why we're operating in Peru heavily. We're trying to expand that season there by planning on different altitudes and latitudes is how you manipulate the time of harvest. We're expanding into Guatemala and Colombia to help develop a product for Europe and Asia to fill those gaps. Where if we can provide a year-long Hass avocado, which is the pebbly skin, thick skin, it's the premier avocado in the market today.
That's a good one.
Year-round, we can change consumer behavior and increase consumption globally, and that's what our goal is.
All right, we'll see what happens out there. Again, just want to highlight that the pop that we are seeing on day one, granted a little bit below in terms of where shares listed to begin here, below that target range. But Steve Barnard, Mission Produce CEO, appreciate you taking the time to chat, and good luck with everything.
Thank you very much.
All right, we're going to take another quick break here on the ticker, but when we return, the interesting new plans out of the cannabis giant Canopy Growth to bring cannabis beverages here to the U.S. We'll have that chat with the CEO over there on that rollout plan right after this. Welcome back to live market coverage here on the ticker. Right now, interesting news in the cannabis space. Of course, we've been watching how the election is going to play out, how that could shift things here in terms of legalization. But for those states already making cannabis legal here, interesting new plans from the cannabis giant Canopy Growth announcing distribution plans to bring their cannabis beverages to the U.S., beginning with Illinois and California in the summer of 2021 through their partner Acreage. And here to discuss those plans with us and how big of a market opportunity might be ahead is the CEO of Canopy Growth, David Klein, joining us once again. And David, good to be chatting with you. We talked about this just a couple weeks ago in terms of these plans. Now it seems it's official. Starting with Illinois and California, talk to me about what goals you have in mind for getting these out there and how excited you are for what these beverages represent to the company.
Well, I think they're a huge unlock in a couple of ways. For existing cannabis users, it's a great unlock because there are a lot of occasions that it's not acceptable to smoke or vape. For people that don't currently use cannabis, it's a great unlock because they don't have to come into the category through smoking or vaping, and so we get a chance to have people test out the space. In terms of how big it can be, I think this is like seltzer. This is a different experience that consumers can undertake that gives you that gives you the THC feeling. The brands that the products that we're bringing to the market are designed so they're like alcohol equivalent. So one can of our Canadian version of Tweed and ginger has about the same effect as a beer would have. So they're sessionable and they're accessible to the average consumer. We think, again, it's a huge unlock.
Yeah, talk to me about, obviously, if you're going to compare yourself to seltzer, you better bring the goods here. So talk to me deeper about where you're trying to price these bad boys at and where you're looking to distribute these, because it's not going to be the case where you can just go to your local grocery store and buy these things off the shelf. So talk to me about that and how that might be a challenge in getting these out to just average consumers.
Yeah, so the best example I can give is in Canada. So we launched our drinks in Canada at the end of March, and we're priced, depending upon the brands, somewhere $3.99, $4.99 when we're using that beer-like analog. But we know over time the price will have to compress. We'll have to get more competitive with beer. But as it stands right now, we have about a 70 share in Canada. We have, the top 5 SKUs at retail, and we're just now able to keep the product on shelf. But we know over time, in order for it to be that beer analog, we're going to have to be able to price it somewhat in line on almost a session by session basis with an alcohol session.
And beyond just the price point too, I mean, when we talk about accessibility and distribution here, obviously you guys are partnered with Acreage. You have that rolling out. That's how you're accessing the US market here. But in terms of where it's going to be sold, how important is that, as obviously you're not the first to offer cannabis beverages here in the US. We were talking to the co-creator of Blue Moon and how he was doing this as well a while ago. So talk to me about how you plan to compete against maybe some of those brands that already have a foothold in a lot of these cannabis stores here in the US.
Yeah, so for right now, like everyone else, we have to distribute through dispensaries. We're hopeful that any sort of federal legislation to decriminalize or legalize cannabis allows for interstate commerce and allows for wider distribution. Once we get there, we lean very heavily into Constellation Brands distribution network, where we're already striking deals with some of our non-cannabis brands to distribute through those channels. We want the opportunity then to bring our THC drinks into those channels through those distributors as well. So it's partly how we build in, or we play into that cannabis ecosystem we're building that includes Canopy's business, Acreage's business, and Constellation's business.
Yeah, when you mentioned Constellation Business, we got the update there in terms of that company reporting their earnings. Of course, they have a rather large stake in Canopy Growth with the billions that they've poured into you guys. That's where you come from. You have that in your DNA. When you think about growing this out, though, if you do see success early in 2021 with these beverages here, at what point, or maybe it's already happened, or the Constellation expertise comes into this equation, how do you see that maybe playing a larger role in this operation moving forward?
Yeah, we've used, in Canada, again, as the example, we've used Constellation's expertise to build out our drinks facility. We've used Constellation's, some of Constellation's analytics and insights work. We get input on a literally daily basis from Constellation's marketing team. We're comparing our costs to the cost of beer. There's a very symbiotic relationship, and we think that we're going to be able to unlock a lot of value over time as a result of that.
Last question to you before we let you go, and it's one that I've asked you, I think maybe 5 times now is what we're at, but you come on, and I'm going to keep asking until it happens. When it comes to federal legalization, we've seen obviously that get a lot more talk these days, but even beyond that, we still have 5 states that are putting it on their state ballots for legalizing, and some pretty big opportunities here, whether you look at New Jersey or Arizona or some of these other states. When it comes to legalization, though, what's the timeline for you, and has that changed at all as more states maybe look like they could pass these and the pressure mounts?
Yeah, look, I've said before, I think the date's sometime in 2022. There's a lot of focus on what happens with the White House. I think the more important thing is the Senate and how many senators will be representing states that have legalized. I think it's hard for a senator to vote against permissibility on a federal level when their states have already said that that's the direction that they want to go. So we'll be watching the election closely. We think it's a home run for the federal government to legalize cannabis. We think it creates 1.6 million jobs, generates $80 billion a year in federal revenue. And, we think it's a bit of a no-brainer, and we hope to see it move soon.
Yeah, we'll see what happens. Obviously, if New Jersey votes that way, it might be a little bit of a shorter drive for me to come over and try some of the beverages you're discussing here. But David Klein, the CEO of Canopy Growth, appreciate you taking the time.
Great, thanks.
All right, we're going to take another quick break here on the ticker. We'll be right back after this. Welcome back to the ticker. In the afternoon trade, we are seeing stocks hold their gains, at least for the time being. The Dow turning close to break even, though holding about 0.25% in the green for the time being. We'll bring you those updates as we get them. But right now, I want to introduce you to an interesting opportunity in the crypto space. It's offering a little bit of something that looks a little bit more attractive for some investors out there seeking higher interest rates. What if I told you you could be earning 4.9% instead of the close to near zero rates you could be getting in a traditional bank account? That is what's being offered by one crypto startup in BlockFi that's raised quite a bit of money here from some interesting backers, both Morgan Creek as well as Coinbase. We've had them on the show before, and now the CEO of BlockFi and founder, Zach Prince, joins us once again. And Zach, I mean, when we talk about 4.9%, that's a very attractive interest rate. And I'm sure a lot of ears perked up out there. But talk to me about how it works and who you're trying to attract with that offer out there.
Yeah, so first off, thanks so much for having me back on the show, Zach. I'm really happy to be here. And unfortunately, things are a bit weird because of COVID, and it's a very unfortunate situation. But for the cryptocurrency sector and for BlockFi, there's been a silver lining, which is that obviously everything digital is doing very well. The cryptocurrency sector is also truly global, and we've experienced a lot of growth at our company since we last chatted. And Bitcoin, if you look at it as an asset class, is the best performing asset class this year, better than gold, better than the S&P. So there's been a lot of tailwinds recently that have come to the cryptocurrency sector and to BlockFi. You touched on the interest rates. So right now on our platform as a consumer, you can download our mobile app or go to our website and earn 8.6% on cash, which is held on our platform in the form of stable coins that you can send in from your bank account. You can earn 6% on Bitcoin, and you can earn 4.5% on Ether. Why does that exist? It's really simple from a user's perspective. You mentioned your roommate might be a fan of it. It's really easy to use, but there's a lot that goes on behind the scenes to enable us to do that. We're the largest lender of cryptocurrencies to institutional borrowers who today are primarily market makers and proprietary trading firms that are active in this asset class and have been for a while, but they can't finance that activity with their traditional prime broker relationships because banks aren't active in the space yet. And that's the reason why the yields are still high, because this is a new asset class. It's nascent, it's growing quickly, and it doesn't have access to the traditional sources of debt capital. And as a result, when we're lending, we're able to charge higher rates, and then we pay that back to the folks who are our clients on the front end, whose experience is super simple. They hold a balance, they accrue interest, it gets paid out once a month.
Yeah, and I mean he's a crypto guy, so I mean he's interested in a lot of different things out there. But I imagine that your customer, who you're trying to attract here, might not be those people who traditionally have been comfortable with cryptocurrencies. And talk to me about that, because it's not just the high yield interest account that you guys are offering, but also a rewards credit card that also gives you rewards to use these things and attract them that way. So who are you going after? As you mentioned, banks might not be meeting them where they want to be met.
Yeah, so as we continue to grow as a company, we're definitely evolving in terms of who our audience is and who our products are relevant for. So the last time we were on the show, last December, we were paying around $1 million in interest every month to our clients. And those clients were primarily folks like your roommate who were already pretty heavily involved in the cryptocurrency sector and learned about our platform pretty early. Today, we're increasingly moving mainstream. Last week we did an event with Benzinga, educating folks on the benefits to your portfolio of diversifying and having some exposure to cryptocurrency. Everyone understands the benefits of our primary interest account product, where you're earning compound interest, your money is working for you, and we're going to continue to go down that path. We're really excited about the Bitcoin Rewards credit card. We think that everyone who already likes Bitcoin is going to use it. It's a total no-brainer. But also for someone maybe like yourself who's curious or interested, you might want to hold some Bitcoin, but it's like risky and scary and you don't know how to do it. Everyone knows how reward points work. You spend money on your credit card, you pay off your card, you get paid for doing that. Right now, you primarily get paid in either cash back, airline miles, or hotel points. And if it's airline miles or hotel points, we think it's a pretty attractive time to consider switching that to Bitcoin as your rewards currency, because we're all traveling less as what's going on. And Bitcoin has done really well. The performance and trends that have helped this sector historically are in motion and stronger than ever.
The last question too, though, would be tied back to, I guess, what might have some people hesitant to jump in, which would be the tax question around all this too. And that's something you address with new users around those concerns. Talk to me about how that plays into, I guess, the complexity of trying to do all these different things at once.
Yeah, so there's no skating taxes on our platform. We're heavily regulated both at the federal and state level as a financial services company in the US. We're going to be the first cryptocurrency platform to launch a feature which is coming out in November, where we have automated tax loss harvesting. So all of the basic stuff that you get in a brokerage account or a savings account with a bank in terms of tax forms that are produced for you every year that you can give to your accountant or use yourself when you're plugging them into a tax software, that's already available. That's a baseline. We're adding on to that a feature that exists on robo-advisory platforms in traditional markets, where if it makes sense to capture a loss on a position, you can opt into this tax loss harvesting, and our platform will automatically do that for you to save you money and boost your returns on an after-tax basis.
It's a very interesting offer out there in terms of where these interest rates are set relative to what you can get out there. If you assume the risks, of course, we need to note not FDIC insured when it comes to these things, as crypto is not necessarily the same as traditional banks. But Zach Prince, BlockFi CEO and founder, appreciate you bringing all of that to us. Very fascinating conversation. Love having it.
Thanks for having me.
Friends. We're going to take another quick break here on the ticker, but when we return, discussing a lot of the local question marks out there in this pandemic. We've been seeing that play out in Florida with a battle between governors and local officials. We'll chat that with the mayor of Fort Lauderdale right after this. Stay with us. Welcome back to the ticker. As we move along here in 2020, we've seen cases rising yet again on the pandemic front. When we look at that nationally, it's been a worrying trend over the last couple days and weeks, really. Just yesterday, we saw the national case count rise above 43,000 versus 7 days ago. That was up by about more than 5,000 cases. It was the largest rise we've seen on a week-over-week basis since mid-July. And overall, that's the story. But when you look at a state level, states still moving very differently to reopen the economy. The latest news out of Florida was, of course, the governor there, Ron DeSantis, choosing to take back those restrictions that were put in place, leaving local officials scrambling to try and clarify what they could do at a local level to kind of prevent an uptick in cases. And here to discuss that with us is the mayor of Fort Lauderdale, Dean Trentalis, joins us now. And Mayor Trentalis, talk to me about how that battle has been going on here, because you yourself had to issue an emergency order to kind of clarify what bars and restaurants and the workers there should be doing. So what have you seen play out since that order was put in place?
Well, first of all, thank you, Zach, for inviting me on the program today. It's been touch and go. Let's face it, pandemics are not the run-of-the-mill type of thing that government officials encounter in their responsibilities. So everyone is really trying to figure out ways, best practices, and see how we can work together. What we're finding in Florida is that the infection rate is continuing to trend downward. In my county in particular, Broward County, it's about half of what the state level is. So it seemed appropriate to start to open up more businesses. The point is that we realized when we shut down this summer that we thought the disease would go away, and when we opened back up, it wouldn't be here anymore. But clearly it's here. We've got to learn to coexist with it. And so right now we're looking for ways to do that. And part of that endeavor is to see how we get people back on their feet, back to work, and still do it in a safe way. So the governor on Friday issued a phase 3 opening emergency order, in which he said, okay, we can now move into a phase where more restaurants can open up, bars can now open up, and local officials were supposed to promulgate guidelines to help facilitate the process and give some guidance to the business community. Unfortunately, it didn't happen that quickly. We waited over the weekend, and Monday, Tuesday came around. So I thought it was important that my city, being a hospitality city, be able to provide some answers to the business community, which we did. We issued those orders yesterday morning, and it gave guidelines to the bar and restaurant community how they can operate safely and at the same time be able to function so that they can still make money.
Yeah, I mean, that's one of the questions here too, because obviously we're dealing with the same thing in New York. A lot of businesses saying, look, you can't keep us closed down forever. But of course, you want to see those improvements on the health statistics you're talking about there. But the other thing being discussed here on a national level also obviously impacts your community as well as other communities around the country is what could come through here between Republicans and Democrats at the federal level trying to get through another stimulus bill. When we look at that, local aid still seems to be a sticking point for Republicans and Democrats. So as a mayor in navigating this, as you've seen tax revenues fall off a cliff due to the pandemic, what have you seen in terms of aid coming through from the state and federal level here to battle all of this and really fill in those gaps that you're seeing here in 2020?
Well, through the summer, the federal government was giving checks out to people who are unemployed, and you can't run a government losing money at $1 trillion a month. That's totally unsustainable. We had to find ways to reopen the economy and do so in a safe way. So the federal government, the spigot has now been shut off. At the state level, the state has been very cooperative in allowing us to set up testing sites, has been paying for all of that, and continues to work with our cities in terms of trying to cope with the pandemic. Cash out, the unemployment checks, the state of Florida participated with the federal government for a short time in terms of paying additional money for unemployment, but that program is now ceased. The governor also established a moratorium on evictions and foreclosures, again, to help working people try to get through this. But the reality is We need to get people back to work. People want to earn a living. They want to be able to pay for their rent and get food on the table. And honestly, Zach, we never really took much direction from the federal government from day one. As you know, it's been very confusing up there. So we've attempted to work our way through this by looking and listening to local medical experts, working amongst my sister cities here in South Florida, and to just try to find best practices that will be safe for the community.
Yeah, which again, as you said, not really anything that a lot of people had expected to be doing here in 2020, not really the responsibilities of local governments, but interesting to see how it's all played out. Mayor Dean Trentalis down there in Fort Lauderdale, appreciate you taking the time to chat with us.
Thank you. Absolutely. Thank you.
We're going to take another quick break here on the ticker, but when we return, some interesting moves on the inflation front and still not a lot of clarity on how the Fed's looking to navigate that. We'll chat that right after this. Stay with us. Welcome back. It's been a few weeks since we've heard the Fed update their 2% inflation target policy here, and we've heard from Fed Chair Jerome Powell a few times as well, talking about how he's not even thinking about raising rates. But if you listen to a lot of officials, they might not be thinking about how they're going to manage overshooting their 2% inflation target either. And here to discuss that with us is Yahoo Finance's Fed reporter Brian Chung. And Brian, I think I nailed that. I think I set that up right. I think that's right.
I think that's right. I mean, what Chairman Powell has really done is he's got everyone thinking about what's the definition of inflation that's going to moderately overshoot for some time. And we've heard from a number of Fed officials since the Federal Reserve delivered that what they call very powerful, very strong forward guidance on September 16th. But none of that speaks since that point in time has really offered any sort of clarity in terms of how high the Federal Reserve would allow inflation to go or for how long. So you do have the likes of, for example, Raphael Bostic from the Atlanta Fed saying he could be comfortable with 2.2, even 2.3% inflation. You have Chicago Fed President Charlie Evans saying he might even be comfortable with 2.5%. But other than that, most of the other Fed officials, including Eric Rosengren from the Boston Fed, have dodged that. And the New York Fed President John Williams saying to reporters earlier this week, quote, "It's hard to say exactly what that amount should be or the amount of time it should be, because it will depend on the circumstances, will depend on what the outlook looks like, and the various factors that go into that." Not very much clear from that statement what they mean by that, which means that the Federal Reserve could be offering its own flexibility there with how high and how long it's willing to let inflation go. It just seems like, at least for the time being, the Fed says, we've got interest rates low. Let's just worry about that for right now.
Yeah, I mean, and they can, the Fed doesn't want to tie their hands here and want to leave themselves some wiggle room, but we are seeing inflation rise in terms of the updates that we keep getting here. So eventually they will have to start thinking about these things. But on that front, I mean, obviously it all ties back to maybe trying to let the market know it could be longer rather than more pressing when they start thinking about rising rates. And I guess that's the main message they want to convey.
Absolutely. And it is certainly true that inflation is on the rise. But keep in mind, that's after a period of pretty strong disinflationary pressures during the COVID crisis and the depths of it. During April, inflation, as measured by core personal consumption expenditures, was just a 0.9%. Now, since that point in time, it has rebounded quite a lot. For August, the core PCE figure was about 1.6%. All of those measures still well below 2%. Now, that trend could go upwards, where we might even be overshooting 2% by the end of this year on a monthly basis. But again, on an annualized basis, the Fed would like to see that overshoot 2% for some time. But as I just laid out, who knows what that means?
We'll see how much overshooting really is overshooting in their eyes, but I'm sure they'll be giving some updates, and you'll bring those to us when they happen. But Brian Chung, appreciate you joining us on that. We're going to take one more break here on the ticker. When we return, continuing the discussion on commercial real estate, we'll chat with WeWork's global head of marketplace on new business initiatives there and a platform launch to turn that company around, as real estate continues to be a big question, whether or not companies are going to be going back to the office. Stay with us. We'll chat that after this.
Welcome to Yahoo Finance. I'm Kristen Myers, and you are watching the second hour of the ticker. Checking market action right now. All three major indices remain in the green. Right now, the leader of the day is the Nasdaq, up about 1.25 percentage point, with the S&P 500 about 1/3 percentage point, with the Dow up over just 0.1 percentage point right now. Now, markets are in the green today after jobless claims continue to decline, and most importantly, optimism over a stimulus deal, which many are hoping could be passed in the coming days. On a sector basis right now, we are continuing to see energy lagging on the day, down over 3% right now. Communication services actually headed up over consumer discretionary, which had been the leader of the day, up over 1% right now, about 1.1 percentage point for those two sectors right now. Looking at stocks right now, first want to look over at two airlines right now. We have United and we also have American Airlines. United right now is actually up about 0.25 percentage point, with American up about 1.5%. Now, those two companies said that they would be moving forward with layoffs because they have not gotten any further assistance as a part of any stimulus package. We will be talking that later in the show. Also want to look over at Amazon right now. That stock is up 1.5% right now. Now, the online retailer has been given the highest target on the street. Pivotal raised their price target of Amazon to $4,500 from $39.25. Right now, they are at $3,200 a share. And my dog has decided to come join the broadcast right now. Apologies for that. We'll take a look at some of that economic data that got today. Jobless claims, initial jobless claims for the week ending September 26th, 837 versus 850,000 expected. That is compared, of course, to 873,000 for the prior week. I have my dog here, Titan, joining us for the jobless claims numbers. Continuing claims for the week ending September 19th, 11.767 million, 12.2 million expected. For the prior week, it was 12.747 million in that prior week. So we are seeing those unemployment figures come down, however, slowly. I do want to remind, however, everyone, that still means that roughly 11.8 million people are still unemployed. But of course, the big news today is those stimulus. The White House has countered the House Democrats' plan with one of their own, the price tag on that, $1.6 trillion. So 600 billion less than 2.2 trillion that had been offered by the Democrats, which is a scaled back version from a stimulus package that they passed back in May. Now, it would include a $400 unemployment enhancement. Now, this White House proposal is roughly half the original plan that Democrats had originally proposed and passed back in May, which totaled roughly $3 trillion. Now, talks between both sides are continuing, but this counter proposal is giving hope that a deal could be reached. And on the coronavirus front, 7.2 million cases in the United States right now. The death count has crossed 207,000. And in New York City, despite that rising positivity rate, it has become the first major city to reopen all public schools for in-person classes. And in the NFL, that game that we were talking about yesterday between the Titans and the Steelers, that has been postponed for a future date to be determined. This is happening now after another player on the Titans and an employee of that franchise tested positive for the virus. And this weekend, upcoming, President Trump is planning on holding a rally in Wisconsin in the red zone areas of La Crosse and Green Bay. But let's check now on those market moves. We're joined now by Paul Schatz, President and Chief Investment Officer at Heritage Capital. Paul, thank you so much for joining today. I want to start with those jobless claims that we received. They are declining. We're seeing those continuing claims continue to decline. But personal income also declined, which is pointing, of course, for the need for more stimulus that, Republicans and Democrats are talking about right now. But with that big picture number we're seeing on jobs, do you think that maybe we do not need as big an injection as before, which, of course, is in line with what Republicans are arguing?
We certainly need more stimulus because the have and the have-nots in the economy are clearer than ever. So while the stay-at-home, non-interpersonal economy is really rocking, we still know that the restaurants and the dry cleaners and the arenas and the travel industry, that's still in literally depression. And I think people have to be super careful. When you think about that initial claim number of 837, that is, if it wasn't for the pandemic, that's an unfathomable number. Yes, it's come down from some 7 million early on, but I think it's now starting to level off. Without stimulus, I fear that number ticks up to a million. Continuing claims, as you said, is coming down under 12 million. That's certainly a positive, but just think about it. These numbers are geometrically higher than anything we've ever seen in the modern era. So yeah, they're improving, but without the Fed, Lord only knows where the markets would have been. And without the CARES Act, I'm not convinced we're going to have stimulus before the election day. We better, or else those numbers are going to get worse and quick.
So what are you expecting tomorrow, Jobs Friday, especially after we got the ADP private payrolls numbers? That was a beat. Now we have these figured out. Are you expecting numbers in line with expectations? That's roughly 850,000, or do you think tomorrow's report could be even rosier than expectations?
Well, if you look at the last few months, we have typically beaten the number. So, I mean, the trend says it'll be better than expected. The trend says unemployment will drop further into single digits. That's what, way above my pay grade to model how pandemic unemployment's going to be. But for sure, it's gotten a little better. But we're nowhere near normal times. So even though these numbers are getting incrementally better, you look on a chart and you're like, you see, February, where we had 200,000 initial claims, and now the norm is, closer to 1 million. So tomorrow should be a little better, but I don't think it's cause to celebrate. And I certainly do not think there's any shot that we're going to have a V recovery back to where we were in February.
I want to switch now to stimulus. Of course, we have renewed optimism. We could be getting some sort of package in the coming days. Democrats and Republicans are talking today, but this counter proposal that we got from the White House is low and roughly half of what Democrats had originally wanted at around $3 trillion. So if Democrats reject that deal, especially considering there has been so much hope over the last just couple of days, where do you see markets heading?
So first, I truly believe it's not the actual absolute number, how many trillions we're going to print and create out of fabric. I think it's what is the devil's in the details. What's the fine print? What's included in that trillion, 1.6, 2.3, whatever number they arrive at? And I think that's the real argument. It's not the amount of money. Listen, we've spent the next 5 quadrillion generations money, and we'll never be able to pay it back conventionally. So let's forget about any party being fiscally conservative. Neither one is. But they each have their base to further energize into the election. And each party has things in there that are non-starters. That's the problem. To answer your question about the markets, I truly don't think stimulus, they're going to use stimulus as the excuse. What's supposed to happen now is the rally's supposed to peter out today, tomorrow, early next week, and we're supposed to have another decline to new lows in the second, third-ish week of October. That's what the trends say. That's what the data says, at least in our models. We've got one more decline coming. We bottom before the election, and then a better rally begins. They'll use some kind of geopolitical reason why the markets went down. But the truth of the matter is, I think whether stimulus passes or not, markets are still due for another pullback.
Now, yesterday we were chatting with Thomas Hayes, and he said that we are right now in an information vacuum with questions around the vaccine, the stimulus, the election. I'm wondering what you think is top of mind most for investors, and what do you think will be the next or perhaps the biggest catalyst for the market going forward?
I would definitely go. I'm in information overload right now. I feel like every day there's just a cornucopia of information being thrown at us. Remember one thing, markets discount future economic activity 3 to 6 months down the road. That's what's important for investors to take away. What are the catalysts between now and the election? I mean, to me, as an investor and to other investors, don't make wholesale decisions based on this one geopolitical event in November. Don't try to game who's going to win or how it's going to shake out, because the markets may not, like we saw in 16, the markets may not cooperate with your outcome. So I think between now and then, an individual investor can best be served by ignoring most of the headlines. They're just going to confuse the average person, and frankly, the pros as well. If you feel like you've got too much ups and downs in your portfolio, then you should revisit your allocation. I would find it very hard to advise someone to go all in or all out right now. I think we'll have a decline. I think there'll be a super opportunity as people fret over the election in a couple of weeks into the election. But I don't think there is a single catalyst right now that's going to propel the Dow to 30,000 in the next month. I think it's one of those times where patience is going to be rewarded.
All right, Paul, always great to chat with you. I had so many more questions for you, so we'll have to bring you back soon. Paul Schatz, President.
And I'll bring my dog for a play date next time.
I know. My dog is right here listening into this market conversation to make some investment moves. Paul Schatz, President.
And there's my dog.
Capital. Oh, so cute. Thanks for joining us. Well, we've been talking about an uptick in positivity rates and hospitalizations as it applies to coronavirus. And now we're seeing coronavirus cases have risen in half of the country. So to talk this surge, we're joined now by Dr. Andre Campbell, professor of surgery at UCSF and the trauma surgeon at the Zuckerberg San Francisco General Hospital. Doctor, thank you for rejoining us again. I want to talk about this latest uptick. Do you think that we're on the front end of a new wave of this virus?
Well, thank you so much for having me back. I really appreciate it. It's good to see you, Ms. Myers, this morning on the West Coast, afternoon on the East Coast. We have a lot of concerns now. So we are now 8 months into what's going to be probably a year and a half or 2-year cycle where things will not be normal. Regardless of the political landscape, the public health point of view is that we're really very early on in this entire game. And the thing that we're worried or a fight, really not a game, it's a fight against the virus. So started in February, now here we are in October. The thing we're worried about now is getting cold in the Northeast, Midwest, and the West, and that people going back inside so that there will be maybe a double whammy. There will be a resurgence of COVID, which we know last week we went up 13%. 45,000 more cases across the country, hotspots everywhere. But we're also worried about the flu. That's why we're trying to encourage people to take the flu vaccine, because the flu vaccine, you should have that on board no matter who you are. So we're worried about this second wave coming. The other thing that we're worried about is in Florida, where everything is opened up. And that is something that is quite stressful for us, is that opening up at 100%, when you open, you don't open up at 100%. You open up at a lower level so you can have all the things we've talked about with social distancing, hand washing, wearing masks, those kind of things going on. So we are very worried about, yes, there will be an increased second wave, and there has been increases in the central part of the country more recently.
So speaking to those reopenings, not just Florida, San Francisco, your city is also mulling over these reopenings. New York has also reopened indoor dining and also sending children back to school. Now, I know that economically people are saying, look, we cannot hold on for much longer. We have to do business, especially restaurants. Do you think that these reopenings, and you were hinting just a moment ago, but are they too premature?
Well, I think when you reopen, you have to do it smartly. I think the reason why the reopening is happening is because the incidence, I mean, New York went from being the epicenter with having 400,000 cases, 32,000, New York State, 32,000. That's New York City, obviously being tremendously affected and having 20,000 deaths, to now having less than 1% positivity. And that's kind of what was the impetus. So each state has a set of guidelines. Our guidelines in California are much like the guidelines in New York, is that if we have less than a percentage in a county or city and county like San Francisco, so I think we're about 1% positivity of the tests that we've had here. And if you're at that level, then you can think about opening. But when you open, you have to open smartly. Everybody wears a mask, everybody social distances, everybody washes their hands. We must do it in a very smart way. And you may need to do a combination hybrid where some open, some at home. Some of these things that are very disruptive to people's lives, the closing of the restaurants, the closing of schools, it hurts people who are working. So that we're still very early on in this, and it is nowhere near the end as some are predicting. We're just really beginning the first 3 innings of what's going to be a maybe 9 or 10 inning battle against this virus.
So, Doctor, as I had been mentioning at the opening of the show, the president has decided to hold a rally in Wisconsin in coronavirus spread zones. And of course, famously, Herman Cain died after attending one of his rallies in Oklahoma. We see that these rallies are often maskless. There's little social distancing. Do you think that the president is being irresponsible and reckless and potentially contributing to the spread?
So I look at each and every one of those events as a super spreader event. So whether or not it's in Tulsa, Oklahoma, where Mr. Cain died because he got exposed to coronavirus in a large setting, or wherever he has, every time there's an event, there's a potential for super spreading. Every time you get close, you put people together. It is, in my opinion, a dangerous thing to do. In a red zone, it's dangerous anywhere where you go in and have a big event. And the big rally that was in South Dakota with 250,000 people, they've now traced thousands of cases related to that. The wedding in Maine, where there were only 80 people in the wedding, and now it was over 200 people been affected with 4 people dying. So whenever there's an event where there is no concern for the public health issues of distancing, wearing a mask, spreading the virus, to me, it is a super spreading event. It is not advisable to have anything like those events happen anywhere in the United States when we're at this stage of fighting this virus.
I only have about a minute left with you, Doctor, but I wanted to ask about the vaccine that is largely unpopular to most Americans. They say that they don't want to take a first generation vaccine. They do not trust the president, even if he tells them that it would be safe. I'm wondering what your thoughts are on that. If a vaccine comes out by election day or even by the end of the year, if you would encourage folks, given how quickly a vaccine came out, to take it.
Well, that's a little bit more than a minute, but I'll try to give you as quickly as I can, if that's okay. So vaccination and vaccine development is important. And obviously, this is very compressed. So for me, I would not take it if it is done on a politically expedient basis. Now, if you listen to Anthony Fauci, and we all listen to him, he would say second quarter of next year, where it will go through all 3 phases, safety will be proven, and it can be then distributed. I don't think there's any way that anything safe can be done before that. We have a lot of people who doubt vaccines. Rolling out a poorly thought out vaccine is the worst strategy for the vaccination against this disease process. You have to have trust. You have to support the science. And I do not think that anything is going to happen. There may be an October surprise. They'll say, oh, it's out. But I think as a public health person, I would not advise taking it until it has been thoroughly vetted. And it is nowhere near being close to being thoroughly vetted at this time.
All right, Dr. Andre Campbell, Professor of Surgery at UCSF. Thank you so much for coming back on the program.
Thank you so much for having me on. I really appreciate it. Thank you.
And coming up after the break, amid a pandemic that has forced everyone to work from home, WeWork is trying to turn the company around with the launch of a new business platform. That's next. Welcome back to Yahoo Finance. Checking market action right now. We have seen the Dow flip into the red, down about a quarter of a percentage point right now. The Nasdaq remains the leader on the day, up about 1 percentage point now. The S&P 500 up just 4 points, about 1/10 of a percentage point right now. Now, on a sector basis, we're continuing to see communication services still in the green ahead of consumer discretionary. We are seeing more sectors slip into the red. Financials and health have now joined industrial materials and energy in the red. Energy down 3.5% right now. Well, after a failed IPO full of questions around its valuation, its governance, and its financials, WeWork is trying to turn the company around in the midst of a pandemic by launching a business platform aimed at providing companies with business resources. We're joined now by Prabdeep Singh, WeWork's global head of marketplace, and Yahoo Finance's Akiko Fujita. Thank you both for joining us for this conversation. So, Prabdeep, you guys have a new launch, which is shifting and transforming WeWork away from the real estate company that we have all come to know to a more business solutions company. I'm wondering if you could elucidate some of the challenges in making that transformation. And do you find that people are skeptical, perhaps, of this new platform, especially given all of the negative headlines and questions that were raised about WeWork around that canceled IPO?
Sure. Well, thanks again for having me here. I guess just to clarify as a start, our core focus still very much is our flexible space business. And with the new management team that we have, we're very focused on making that the best that we possibly can. And I think if you go back a couple months as we started to build, our new vision for the future, we put together this very comprehensive 5-year strategic plan. And the idea was for us to, again, like I said, build our company into the best, possible flexible workspace provider in the world, but then also build towards what we call an end-to-end business solutions platform. And so this to me is the first step in getting there. The way I think about it in terms of your question about how hard it is really, we know our customers well. Regardless of the headlines from the past, we really know, what they want and what kind of the challenges they have. And when launching this, we really thought about what are the core things that we can offer them that are going to move the needle for them when it comes to managing their business. So we looked at things like, HR, payroll, healthcare. How can we help them with those things so that they can actually just really focus on their core business?
Prab, you talked about doing this as a subscription service. You've already got hundreds of thousands of tenants within your WeWork spaces globally. Why go down that approach instead of just saying, look, if you've got a service that you want, we can provide it? Why was it important to go through a subscription offer?
Well, just to be clear, so we partnered with a company called Venture HR for this platform, and we do offer the ability for people to do a subscription on a monthly basis, similar to the way that most of our tenants actually are on a subscription. And the way we think about it is, there's a lot of things that we can do from a business solutions perspective, but we want to be really targeted. So we picked the things that, again, we think all companies have and all companies need. And the way that most of those services, so payroll, HR, healthcare, they're all based on subscription. So we just wanted to keep the model as simple as possible.
And when you think about where WeWork is going, you mentioned that you see the company evolving more towards a marketplace than just very real estate focused. What's the breakdown that you see eventually here? Is it about just having a platform where businesses can essentially start up from zero? Is it still, 50, 60% focused on real estate with services on the side?
Mm-hmm. It's hard to say the exact breakdown, but the way I think about it is, imagine if you're a small company, you've got a lot to deal with. If you can think about WeWork as a place where you just plug in and all of a sudden you've got your amazing space, you've got your coffee, you've got your Wi-Fi, you've got your HR, you've got your payroll, you have your accounting. If we can get to a place where we're really turnkey on the business side, it just unlocks a ton of possibilities. And the breakdown of that, again, have no idea. I think in today's world, even when you look at flexible real estate, there's still a lot of ground we have to cover there. It's only 3% of the total office space market. So I think, for the near term, flexible space is going to be our business. But I could see over the next couple of years, us having a significant portion of our revenue starting to come from these other channels.
And it's no secret that WeWork has undergone this transformation under your new CEO. You've also been trying to shed a lot of these real estate assets, sort of renegotiating leases as well. You recently gave up control of your business in China. what does occupancy look like right now? I think you've got a pretty good pulse on where businesses stand. We've been talking so much of people just working from home. What are you seeing in your spaces in terms of a rebound?
Well, what's been interesting about COVID is that, it's been hard for every company and every person in the world, obviously, but if you really think about the core DNA of WeWork, it's flexibility. And we're talking to companies daily about how they're reinventing the way they work. And we just happen to have, the largest global flexible, work platform there is. And so in some ways, our platform is actually more relevant now than it was in the past, because no one really has our footprint when it comes to flexible work. And so if you're someone sitting, in Brooklyn, or if you're someone sitting in Japan or wherever you are in the world, likely there's a WeWork near where you live and where you work. And so I think that type of flexibility actually makes our platform more relevant today.
All right, well, we will leave that conversation there. Thank you so much for joining us. Probably saying WeWork's global head of marketplace, and of course, Yahoo Finance's Kiko Fuji.
Thank you.
Thanks for joining us. Well, coming up next, airlines, United and American, plan to move ahead with layoffs. We'll be telling you all about it next. Sorry, everyone. I happened to be muted just now. Welcome back to live market coverage here on Yahoo Finance. Well, no stimulus package as of yet has meant that no extra funds have been heading to the airlines. Well, American and United say that they will be going forward with over 30,000 furloughs. So for more on this, we're joined now by Yahoo Finance's Sabeel Marcellus. Hey, Sabeel.
That's right. So the CEOs of major U.S. airlines have been warning us that if Congress is not able to come up with another round of fiscal stimulus, which would include bailout money for the airlines, they would have to involuntarily separate workers from their companies by October 1st. Well, as we know, Washington talks are ongoing, but we still don't have a deal. So as a result, we're seeing American. What they're doing is they've involuntarily furloughed approximately 19,000 workers. You look at United, they did that for 13,000 employees, and Alaska Airlines involuntary furloughing 532 workers. But the layoffs that we're seeing aren't just limited to the airlines. We're seeing layoffs from Wall Street to Main Street, just to name a couple of those companies. Disney announced this week that it's laying off 28,000 workers. Goldman Sachs said that it's cutting 400 jobs. Citigroup, they eliminated the jobs of 3 managing directors and are looking at further layoffs. You've also got Allstate, the insurance company, looking at 3,800 workers that it is laying off. So we're seeing the labor market deteriorate. Another over 800,000 Americans filed for unemployment last week.
All right. Thank you so much, Sabeel. I do want to mention right now, looking over at United, investors seem to be shaking off that news about those layoffs. United right now up about 0.5%, with American Airlines up roughly 2%. And later on today, you can catch both me and Sabeel for our special 2020 A Time for Change at 4:30 p.m. We'll be speaking with NBA player CJ McCollum, who is launching a new social justice talk show. You're not going to want to miss that. And with the elections heating up, Facebook is banning ads that will make false claims about voting. Yahoo Finance's tech expert Dan Howley is here with more. Hey, Dan.
Hey, Kristen, that's right. Facebook is going to be banning ads that basically try to delegitimize the results of the election. This comes as Facebook is banning ads for a slew of different purposes, including for far-right militias, things along those lines. But what Facebook is not doing is banning people from posting misinformation about election results. You would think that would also kind of be a smart idea. But what they are going to do is add kind of tags to these posts, these organic posts, saying that they are false or that it's misinformation. So it's kind of a way for them to protect themselves as well as protecting the integrity of the election. Obviously, this is a big deal for Facebook going into the 2020 election after the results of 2016, which were seen as being tainted in part by Facebook and Russian trolls and meddling along those lines. We're still seeing that pop up this time around with meddling from the Russians again, as well as China and Iran on social platforms. Facebook talks about how they've been taking down such actions, these kind of inauthentic user actions. So they really do seem to be trying to make some kind of difference here. But again, as I said, they're still going to allow people to post misinformation.
So Dan, tell me about Google as well, switching to another tech company, because I know that they have plans to pay content creators now.
Yeah, so this is a move on Google's part, and it kind of has to do with this kind of uprising from certain countries. Germany, Australia is a big one as well, Brazil, basically saying, look, Google and Facebook, you dominate the online ad industry. As a result, you've killed the media industry. News organizations, independent news organizations can't turn a profit because of you. So now, even though, by the way, those organizations get their news headlines from news companies. So now what's happening is Australia, for instance, wants Facebook and Google to pay news companies to basically use stories that are then posted on their sites. What Google is doing is providing $1 billion as part of an effort to kind of assuage these concerns. So they're starting with Germany and Brazil, publications in those two countries, and will set up this new kind of Google News entity that will pay these different news organizations to use their headlines and their articles. And when you click on the articles from this new Google News site, you will be taken directly to the news organization's web pages. So you won't be reading them directly in Google News anymore. You'll be reading them on the site. This is something that Google, news organizations have been fighting for, because the more information they can get about their users, the better they can target them with ads and then try to turn a profit through advertising that way, similar to what Google and Facebook do already. So it's kind of a change of pace here. Facebook is still trying to fight this. And Google, by the way, despite this $1 billion pledge, has pulled out of companies in the past, from countries rather, in the past, that have tried to get Google to pay up for Google News. So we'll see where this goes in the future.
All right, we will indeed. And I'm sure you will be giving us the update. Thanks so much, Dan. On the latest episode of The Influencers, Yahoo Finance editor-in-chief Andy Storr spoke with one campaign president and CEO, Gail Smith, about the ongoing dispute between President Trump and the World Health Organization over the coronavirus. Take a listen.
This isn't the first time we're going to face a global health threat. That should be sorted out. WHO is an institution that the world relies on. It's a little bit, it's the heartbeat of a global response like this. It is not a perfect organization. I've yet to actually meet a perfect organization. But it's a UN agency, which means it's also as good as its members. And so it's not as though this is an independent organization that we can just hold a referendum on, decide whether we like it or not. We are members, or we were. We are part of it, and it is our job, obligation, and I would argue opportunity to make it better and make it more effective. I think the tragedy has been to withdraw from the WHO and have an argument at the height of a pandemic. It's a bit like saying you don't like the fire chief, so you're going to burn down the firehouse while your house is on fire. I mean, okay, maybe you get the fire chief, but your house is still going to burn to the ground. So it's really that, I think that's really an unfortunate development. It's a really important organization, and we have, as I say, I believe, the obligation and the opportunity to make it an even better organization, but it needs our support rather than our attacks.
Strong words indeed from Gail Smith. You can catch the full episode on Yahoo Finance tonight. Coming up after the break, we'll be breaking down the details of the new White House stimulus package next. Welcome back to Yahoo Finance. Checking market action right now. All three major indices are in the green, so the Dow has flipped back into the green. The Dow up just 0.07% right now. The Nasdaq continues to lead on the day, up about 1 1/3 of a percentage point, with the S&P 500 up just under a percentage point right now. Well, the White House has countered the $2.2 trillion stimulus package from the Democrats with their own $1.6 trillion package. It will include an unemployment enhancement, stimulus checks, and aid to the state. So for more details on the package, we're joined now by Yahoo Finance's Rick Newman. Hey, Rick.
Hey.
So talk us through what is in the new White House deal and where the delta remains between those two packages.
So I'll tell you what we know about this offer, and then I'm going to tell everybody don't get very excited because I don't think it's likely to pass. But the White House has basically raised its bid. They're now saying they're okay with $1.6 trillion worth of new stimulus spending. So that's $600 billion below where the Democrats are at $2.2 billion. This would include a lot of new money for coronavirus testing, for vaccine development. There would be a $400 weekly stipend for unemployment insurance. That used to be $600, and of course that expired at the end of July. More money for states and cities, and a lot of things the Democrats want, just with smaller numbers. But let's remember, this is the White House offer. This is not the Senate, and this has really been a three-way negotiation all along. There's the White House, There are Republicans in the Senate, which are not on board with what the White House is proposing, and then there are Democrats in the House. So there's no word from Republicans in the Senate indicating they're behind this offer of 1.6 something trillion dollars in spending. But Mitch McConnell, the Republican Senate Majority Leader, has indicated at other times this week that there's just no likelihood, or at least very little likelihood, that they're going to sign on to such a bill. And without the Senate, you don't have a bill.
Okay, so to that point, because I'm glad you mentioned that, where then or when might we get a stimulus package? Do you think Democrats would at all be willing to come below 2 trillion? I mean, they were already at 3 trillion before, but I mean, if the White House is at 1.6 right now, and as you mentioned, Senator McConnell saying 2.2, frankly, is outlandishly high, where then do we come in for a deal? Or do we just continue on for a stalemate all the way through election and possibly the end of the year?
Stalemate all the way through election. That's my bet. And the reason is I think all sides are being disingenuous here. And I think for different reasons, each side here is probably fine with no deal. And I include the Democrats in that. I think Nancy Pelosi is making the Republicans an offer they can't possibly accept. And I think the reason she's doing that is look at the polls in the presidential race. Joe Biden is going up in the polls, not down. New polls out today suggest he may have gained a percentage point or two over President Trump from the debate earlier this week. It's looking like maybe a 50-50 likelihood the Democrats could actually take control of the Senate. So let's say we have the elections in early November and it turns out Joe Biden wins and Democrats take control of the Senate. Well, then Nancy Pelosi and Chuck Schumer, who would become the Senate Majority Leader, could pass just about whatever they want come next January 21st, which I think would be their date. So if you're Nancy Pelosi and the future looks pretty rosy, I think you're quite willing to, she would never say this publicly, but I think it is for sure part of her strategy to demand something she knows the Republicans won't give her. And then if the Democrats win, then go full bore.
I only have about a minute left with you, Rick. Just wanted to know, we already know what those thorny sticking issues are, but if you could just repeat them for everyone, on what points do the Democrats and the Republicans remain farthest apart? Is it about that absolute dollar number of the package, or is it something particular?
You know, I think they could easily compromise on the dollar numbers. They could also compromise on the time frame. I mean, you could say, instead of extending something through the end of the year, let's extend it through the end of November, if that helps us get the dollar amount down, and then see about doing something in December. That would be the pragmatic approach. There's a clause in one of the earlier bills that Democrats want to repeal. It's a big tax break that didn't really get a lot of attention back in March, but it only benefits people who make more than $500,000. Democrats would like that taken out, and they would like to see new tax credits or tax benefits for middle and lower income people. So that's a sticking point. The Senate still says we need to have liability for businesses. The Democrats say, well, we're not going to do that unless there's an ironclad safety guarantee and some high standard businesses have to meet. Those are a few. There are others, but there are plenty of disagreements here to prevent this from getting to the finish line before November 3rd.
All right, no deal before November 3rd. Thanks so much, Rick Newman.
See ya.
And we'll be right back after a quick break. Welcome back to Yahoo Finance. Well, as the pandemic spread, gyms closed across the country, forcing some fitness places to get creative. So to chat about this, we're joined now by Sadie Kurzban, founder of 305 Fitness. Sadie, thank you so much for joining us today. So as I just mentioned, we saw gyms closing en masse over the last several months, and only in some states and cities are they just now reopening. But I'm wondering, for you over at 305 Fitness, how have you guys been able to pivot and get innovative and creative to essentially stay afloat over the last several months?
Right. It's no surprise, just as you said, Kristen, that gyms, fitness studios were definitely suffering during a COVID epidemic. It's just not a safe environment to be in, and especially group fitness like we are, where we have a lot of people in one room all at the same time, breathing heavily indoors, not a good environment for this disease. So we have closed our studio doors, and actually even in locations like DC where we are allowed to open, we have made the call that we will not be reopening any studios until next year. And we acknowledge that it's still going to be a slow crawl back. So it's not as if the moment we reopen, everything's, fine and dandy. It's going to be a crawl back to pre-COVID revenue levels. And so what that's meant is we have pivoted. We've pivoted to instructor certification, which is a really awesome program that's grown 500% in the pandemic. We've pivoted to at-home content, outdoor workouts. We've done lots of things in order to generate revenue, both in the short run and actually, luckily, in the long run, really building the foundation of what I think could be a really big success story.
So I'm wondering, as you've pivoted more and more online, if you found that there has been perhaps even an increased success or even increased amount of folks coming to 305 Fitness because they can join essentially from anywhere, and we've all been lovingly calling the extra weight everyone has been gaining in quarantine, the quarantine 15. I'm wondering if you at all perhaps saw a boost to your business.
At home, being able, whether that's on YouTube or on our monetized at home platform for $29 a month, what we've seen is it's done two things. One is it's helped us geographically expand our reach. So now we have an audience in Peru, in the UK, in Japan, and places where as a brick and mortar concept, it would have been really a long time to get there. The second shift that we've seen is that people are able to take the class a lot more frequently, probably because they're at home, they don't have to deal with parking or the subway, or because it's just simply more affordable. So we're seeing people on average do 10, 12 workouts a month, which is really exceptional. We're really excited about this ability to just have 305 everywhere.
So I imagine that for a boutique gym or a fitness place like 305 Fitness, it might be a little bit easier for you and for some of your competitors and fellow owners and founders in this space to pivot. As you're talking to other, folks that own boutique gyms and fitness places, are they echoing some of these sentiments, or have you seen that some folks are really struggling?
I would say across the board, the industry is really struggling. It's hard to be in fitness right now, with the exception of having a big at-home offering. Those are obviously growing a ton right now. Businesses like mine that were primarily brick and mortar focused, especially bigger box gyms, we're seeing them close left and right, file for bankruptcy. It is really not a happy time in fitness. So the ability for us to not just survive, but thrive during this time, I think is a real testament to our community. It's also a testament just to the unique size and time, that we are right now. We're not so big where we're weighed down by brick and mortar, and we're also not so small where cash reserves were so small that it became impossible to maneuver. So it's really, we just sort of got lucky with this sweet spot where we had enough cash in the bank to be able to pivot, enough to be able to reforecast aggressively. But it is really not a pretty picture for the fitness industry at large.
I want to ask you, we've been talking all day about stimulus, which would, of course, include funds for small businesses. And the PPP program had a lot of failures. A lot of small businesses did not get the funds that they needed. We saw big businesses that probably didn't need funds have to give them back. I'm wondering what you're hoping for, perhaps in the next package, in the next coming days, weeks, or months, what you're hoping to see fund-wise for a company like yours.
As a small business owner, I would say that the government really failed us in many, many ways. Initially, the PPP funding was for 8 weeks. We did get 2/3 of, runway for 8 weeks, but we're looking at a 1 year or 18-month climb back to pre-COVID revenue. So what I unfortunately think what's happened in our country is that in not giving small businesses the ability to be able to operate during this time and not giving our workers, right, the amount that they can so that they can go home and not worry. It's a really, really challenging time. And it unfortunately just means that either the people with the largest cash reserves or the people who are lucky and innovative and are able to pivot will get by. But I think COVID is going to absolutely destroy a lot of small business and fitness.
All right. Well, we will have to leave that there. Sadie Kurzban, founder of 305 Fitness, thank you so much for joining us.
Thank you.
And up next, we will be talking real estate and specifically, where is most at risk for a bubble? That's next. Welcome back to Yahoo Finance. We're going to talk now about real estate. The global housing market is slowing down, and some cities could be due for a price correction. That's all according to a new study. For more on this, we're joined now by Yahoo Finance's Sarah Painter. Hey, Sarah.
Hi, Kristen. So this study looks at cities around the world, the 25 biggest cities, and we're seeing that Munich, Frankfurt, Paris, Amsterdam, all of these Eurozone cities are a little bit overheated to the point that experts are concerned that it could be a housing bubble and that they could have a sharp price correction. We also, for the first time, are seeing more concern around Zurich, which has grown 50% in prices since 2010. So around Europe, there's a lot of concern around these rising prices that people won't be willing to pay them, and there will be a sharp price correction. But in the US, it's a very different story. We're not expecting to see any sharp price corrections, and even as the housing market is really hot in the US, cities are less in demand than the rest of the country, and so they're cooling down a little without popping as a housing bubble would.
So, Sarah, I actually just left yesterday my apartment in Berlin, and I have now moved to the suburbs. I know that I'm not alone. Can you talk about how that's contributing to this?
Yeah, absolutely. So during the coronavirus pandemic, obviously a lot of people want to live in the suburbs as they're sheltering in place to have a little bit more room. And they aren't as tied to their offices now and confined by their commutes. So the US is seeing an explosion in home demand, which is driving up prices for homes across the US. In cities, though, that's where people are leaving. So prices in the cities aren't keeping pace with that of the rest of the country, and but they're still considered overvalued. They're not considered at risk of being a housing bubble, but they've been overpriced for a long time, especially if you look at New York and San Francisco, serious affordability problems. And so the way that balances out is because there's this shortage of demand that has been lasting for 10 years in those places or more, it kind of balances out as people are leaving and keeping that pushed up so that the market doesn't just deflate as people move out to the suburbs.
All right, Yahoo Finance's Sarah Painter. You can check yahoofinance.com for article on that. All three major indices now in the green. Live coverage continues here on Yahoo Finance. Final round is next.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Hudson with you in New York on this Thursday afternoon, the first trading day of October, first trading day of the fourth quarter of 2020. We have almost made it to the end of a year. None of us will forget anytime soon. Let's take a look at the markets here. And again, we've got an interesting day on our hands. The tech index and the Nasdaq is up about 1.5%, notably outperforming the S&P and the Dow. Now we've seen the Nasdaq, of course, during the rally off of the March lows do better than the S&P and the Dow, but it's not too often, at least in the last few trading sessions, that we have seen such a market outperformance from the Nasdaq on the upside. Again, tech index up about 1.5%. The Dow is just barely hanging on to green figures, up about 10 basis points right now. The S&P 500 is up about 0.5%. Now, driving this to some extent is what we are seeing on the fiscal side. A lot of bullishness from the market about conversations in Washington right now between House Speaker Nancy Pelosi, Secretary of Treasury Steven Mnuchin. There's a lot of course, crosstalk between, White House Chief of Staff Mark Meadows suggesting there's really no deal, but then you have Senate Majority Leader Mitch McConnell saying as much as well. But the fact that Pelosi and Mnuchin continue to talk to one another has investors believing that something is viable here between the two sides. Now, we've been operating under the assumption, and we've talked to Jess Smith down in D.C., our Washington reporter, about how the working assumption really for the last 6 weeks has been that there would be no stimulus, certainly not until 2021, and certainly not until after the election, but probably not until next year. And now all of a sudden, it it starts to seem like there's going to be some momentum towards getting a package passed. Once you have Republicans saying the word trillion, it seems like we are moving in the right direction. $1.5 trillion is really where most headlines have pegged a potential package, but this is very fluid. We will see, of course, what happens. But some of this, I think, underwriting what we are seeing in the equity markets today. Just taking a quick look around the market just to see where we are seeing some of our outperformance. Chip stocks today doing quite well. Philly semis up about 2%. If we look more broadly over at the sectors in the S&P, 7 of the 11 sectors are in the green today. Energy, the real loser. Price of crude is off some 5%. XLE is down 3%, or crude had been down as much as 5%, off about 4% right now. XLE off about 3% in sympathy. XLC Communication Services, as you would expect, leading the way higher here, up about 1.6%. All right, I want to bring in Shauna Smith joining us now for the next 90 minutes on today's program. Shauna, just for your first impressions on today's market.
Hey there, Miles. Well, I mean, it's an interesting start to the quarter when you take a look at the market action today. Right now, we are in positive territory, but it's been a pretty choppy start to the quarter. So I think that's something to note. When we talk about, you were just mentioning the latest on the stimulus talks, really the lack of clarity there, questions from investors just in terms of whether or not things are going to get done, what the timeline looks like. I think that uncertainty is keeping some of the gains today in check. And that, of course, the debate out there is whether or not it's a must-have for the markets or it would be nice to have for the market. So I think that's what we've been hearing, both of those sides from our recent market guests. But it's interesting, at least for today, when you see some of the questions just in terms of whether or not we will get that done. I think that is keeping some of those gains under wraps just a little bit. And then also on the econ side of things, it's pretty much a continuation of what we've seen over the last several weeks. And that, of course, is just mixed data. And that is also keeping sentiment in check just a little bit in the manufacturing front. U.S. manufacturing activity is slowing. Jobless claims better than expected, that week over week drop, but still it wasn't a drastic drop. We have jobless claims kind of plateauing over the last month or so, still way above those pre-pandemic levels. So of course, the labor market, where that stands, adding some worry to the markets today. And then on the consumer side of things, two different reports. On the one hand, we got higher spending in August. On the other hand, personal income fell, dropping almost 3%, falling 2.7%. Much of that, of course, is tied to the expiration of additional unemployment benefits. But I think that mixed data is adding some worry here to the markets. In terms of where we stand, we're coming off a very weak September, a pretty weak September, I should say. The major averages of recording their first monthly decline since March. The Dow was off just over 2% in the month of September, S&P falling nearly 4%, Nasdaq off just over 5%. So when you take all that into account and look at what's moving today and what's favoring, Nasdaq is the biggest gainer. And I think investors are still seeing some opportunity there. We talk about how tech led the decline over the last 30 days. So investors are still seeing some attractive entry points for some of those big cap names. So I think that that is a trend that we could see at least play out over the next couple of weeks. And then one other big outperformer we should mention in the market today, because we're still getting earnings reports before the bell and also after the bell, but Bed Bath & Beyond is a massive standout today. The stock surging just over 30%. It had a very strong quarter for the company, hitting a 2-year high. Of course, this is a stock that has struggled kind of to regain footing over the last couple of years. The company has been under a turnaround strategy. It seems like their strategy is at least paying off for now. But again, a huge beat here for the second quarter for Bed Bath & Beyond, and that stock amongst the biggest outperformers today, with shares surging just over 30%.
Yeah, when was that? Was that before the pandemic, Shauna, when they laid off like their entire C-suite? Because I remember there was a time when Bed Bath, they brought in a new CEO, and they're like, oh yes, everyone who works here, they are all fired, and we're going to start over. And the stock was at 4, and now it's at 18.
Yeah, that was a little bit before, I believe, the pandemic. So right around that time. And we just talk about how retail has really been put in this spot where there's this clear winners and losers. And I think coronavirus pandemic has exacerbated that. And we've seen a lot of these retailers either go one way. We've seen a number of bankruptcies. And on the other hand, other retailers are figuring out how to perform and perform well in this type of environment. And Bed Bath & Beyond, at least for now, it seems like is trending in the right direction. Although it almost seemed like they couldn't do no worse a couple of months ago. So we have to make sure that we point that out. But again, shares today, investors extremely excited about that quarter with the stock popping just over 30%.
Yeah, online sales up 89% in the company's last quarter, their first positive comp quarter since 2016. As you know, comps got easier over that time, but certainly a welcome sign for investors looking at a turnaround play there. Again, stock up about 30% today. All right, let's go to Jared Blicker now for how Jared sees things in the market. Jared, let's start with the oil markets. I know you follow commodities closely for us here. We saw that huge sell-off in crude. Obviously, we are still down considerably. And all of a sudden, we had crude kind of floating in the mid-40s. Wasn't all that interesting. Weren't really focusing on it. And now we've got WTI back around 35.
Yeah, it's worth taking a step back and looking at a longer-term picture here for crude oil, and then we'll get into some of the energy stocks. This is over the last 3 months. In fact, let's do the entire year. After oil went negative, that's this huge drop right here. It was pretty quick to rise back up to $40 a barrel, but it's been slow going ever since then. And we dropped off in September and haven't really been able to reclaim that $40 per barrel level pretty convincingly. Haven't been able to do that. And so you look at some of the stocks here, and I'm not seeing any incremental news today. We have concerns over cheating at OPEC Plus with the production cuts. Also, OPEC Plus giving a pretty weak demand picture for 2021. But here's ExxonMobil with a dividend yield of more than 10% right now, down 52%. And you can see while a lot of stocks do have something akin to a V-shaped recovery, this most decidedly does not. And a lot of people are saying this is just dead money. It's a sector that's going to be dead money for a while. Plus, you have the headwind of the clean energy movement. A lot of these big companies are trying to reposition for that, but good luck. That's going to take a lot of restructuring. And oil is simply, these companies really can't produce much of a profit at $40 a barrel, especially the shale plays. Now, some of the majors have, they can drill in the Gulf and whatnot, but those are my thoughts on the energy sector. It's been very, very, not even slow going. It's going in the wrong direction here. But let's take a look at the market overall real quick. We'll go to the S&P 500 because I consider this a fairly productive day. I'll put in the 3-month chart with the 50-day moving average. You can see we're now holding above it, which is an important development. Still looking at 3410 as the real resistance here. I don't think we'll see much of a pullback until we get into this area. And I do expect to eventually go higher, but over the next few months, especially the time leading into the election, probably going to be choppy. Don't expect to see record highs, and I'd be surprised to see this low taken out too, but anything can happen.
Jared, as you were talking about Exxon there, we had a guest on the program in the 4 o'clock hour yesterday. I think they were talking about Hess and talking about how they were able to, buy a part of a competitor's business for, essentially nothing, considering the cash on the balance sheet. And I was thinking about that last night, and I was like, well, I think there's a reason why some of those energy assets are sold for quote unquote effectively nothing if you do the accounting in the balance sheet. As you note, a sector with all kinds of secular challenges. At the very least, I think Exxon, it was down 18 of 20 sessions not too long ago, and I think maybe we'll bank this one, production team, for a special in the future of the oil markets, because I don't think it's great, and I think there's a lot of trends in play that have been working against the space for some time, certainly been accelerated here during the pandemic. All right, coming up on the other side of this break, we'll turn our attention from Wall Street to Main Street. We'll talk about one company that is helping to fund women and minority-led businesses. We're back with that conversation coming up here in just 2 minutes. On around here on Yahoo Finance. Miles Udland with you in New York. We talk a lot on this program about what's happening on Wall Street. So what is the situation like on Main Street, and how are female-led and minority-led businesses faring during the pandemic? For more on that, we're joined now by Dr. Roshana Novelis. She is the founder and the CEO of Enricher, a platform that allows people to invest in small businesses led by women and minorities. Dr. Novelis, thanks so much for joining the program. So let's just start talking a bit about Enricher, the way you guys have changed the business just slightly during the pandemic, and what the last 6 months have really been like for you and the businesses you're investing in navigating this time.
Yeah, there are so many companies led by amazing founders of color and women that need resources right now. So what we've done is brought together training, coaching, and even capital to make sure these companies sustain and grow even in the current times.
And so tell us a bit about the model that you've built at Enricher, where you have the membership that allows people to invest in the businesses. And then are you the one who is making the ultimate investment decisions in some of these companies? And what are you looking for, when it comes to the businesses that you like to deploy capital into?
Yeah, so funders who believe that more women-led businesses and more businesses run by people of color should get access to capital and resources can join as members on our platform. If they join, they see the pre-vetted companies that have already gone through cash flow analysis, analysis of analytics such as market demand for their product or services, and community outreach and community buy-in to those companies. So we go through a thorough analysis of each company, take them through business finance and training to make sure their cash flow models, their financial models are all up to par and make sense, and they have the ability to repay any capital that they receive. So that's what the funders would have access to if they join as members to our platform.
And then on the applicant side, I actually was quite surprised. The average applicant, according to your website, has over $250,000 in annual revenue, has over 2 years of revenue history, and of course has a high credit score. So if you think about your own process or what sort of demographic you're trying to attract, they're clearly people who have a proven business model, right? You're not actually trying to get folks from the seed stage or perhaps just have some lofty idea that they haven't been able to execute. How do you feel like that is the prime kind of target for you to pursue? And do you imagine sort of broadening your scope in the future?
So that's exactly right. We are focused on existing small businesses that are already employers of people in their communities, because we believe that if more women-led and Black-owned businesses can keep their employees engaged, society will be more diverse, there will be more balance in the community. So while that is the average statistics that you just mentioned there, our minimum is much lower. So the minimum is $100,000 in revenue, 1 year in business, and credit score above 600. So we do feel like that's more inclusive to a wider range of business owners. But though that average just gives people a sense of what we actually see through our platform. And so funders know that these are sustainable businesses that have cash flow and revenue and customers, and just need this capital to stay in operation and grow their enterprises.
And then a quick follow here. I know Miles mentioned, we talk about Wall Street all the time, but we're focusing on Main Street, but they're not mutually exclusive all the time, right? So if you think about some of the businesses you're helping fund, is their ultimate goal to go public? Is their ultimate goal to really get more VC funding? And are you sort of losing some of those customers, right? Are you kind of propelling them and catapulting them, and then they go off and want to get funding from Silicon Valley? What has been your track record here? How do you anticipate that happening?
So we focus on companies that have cash flow. So those are typically traditional businesses, all the way from companies that create dog treats to IT consultancies. While that's true, we also do help those who are positioned for VC funding. So we've funded a beverage company that has 39 flavors of beverages, a financial SaaS platform. And a lot of times they need this funding either as a bridge between equity investment rounds, or as a way to provide or purchase some inventory for their company. So there is a need for different types of capital depending on where you are in your business. And simply because your equity, that company doesn't preclude you from getting working capital for your company as well.
Speaking of different needs and where to put capital, obviously COVID has had a massive impact on small businesses. We're seeing that play out. Of your clients and who you're talking to, how many of them are just at risk of closing because of COVID? And what are the necessary steps, or what are you finding successful that they're doing in order to survive this very challenging time? Because when you take a look at the number of cases and the possible trajectory of this virus, this isn't going away anytime soon.
Right. So we all know the statistic that they expect about 42% of Black-owned businesses to close during this time. So it's really important that every business owner become laser focused on what's their most profitable service or product, and restructure their product offering so that they can sustain and maintain through this pandemic. So that's the kind of training that we're taking everyone through that's a part of Enricher. Like, what are people still buying right now? What is your highest demand? Can you reduce the number of SKUs if you have a large portfolio so that you can become lean and focus on growth and sustaining?
All right, Dr. Roshana Novelis is the founder and CEO of Enricher. Dr. Novelis, thank you so much for joining the program today.
Thank you.
All right, coming up on the other side of this break, we'll talk to Catherine Rooney-Vera about everything going on in this market. We're back with more on that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. I'm with you in New York. As we noted, we've got markets higher to start the month of October. Tech stocks leading the way. How should we be thinking about the fourth quarter of this year and the setup for 2021? For more on that, we're joined now by Catherine Rooney-Vera. She is the chief global market strategist and the head of research and strategy over at Bulltech. Catherine, thanks so much for joining the program once again. So let's just start with your thoughts on the end of this year. We've had an incredible 6-month run through the second and third quarters of 2020. As you look to the end of this year, is there anything you feel compelled to do within portfolios right now as we set up for 2021?
Well, I think there will be opportunities, especially if, in fact, we get a disastrous November 3rd, polling and election outcome. If there is a contested election or if there's a recount, then I think we'll get some opportunities to go long the markets in specific sectors that we're recommending. Number one, I like Miles's industrials. I think industrials under either scenario, either a Biden or a Trump 2 scenario, are more likely than not to get a bit of a boost from infrastructure spending and economic recovery. Depending on who wins, I think you could see a better bid for non-conventional energy, some of the more democratic leaning aspects, which is, green energy, I would say anything that doesn't have to do with oil or banks. So those are what I would say would be the top picks going into 2021. Again, I think it matters quite a bit who takes home the prize on November 3rd, or how long it takes to determine who is the ultimate victor.
And so I guess in thinking about that, then we saw the market, have such kind of a spotty September, I guess we could say. This week has been better so far. In your view, was that about the markets starting to really price in the election? We talked about it for so long. And then,
sure.
I mean, obviously the pandemic was a more pressing concern, but it seemed like we waited till Labor Day to really start to understand this was only 8 weeks away.
Yeah, I mean, we have a 10% correction in the S&P in most recent trading. We thought that was a buy, so we told our clients to go long the broad S&P and proceed with a barbell strategy, which is, of course, married put options or the purchase of gold or the purchase of tips. I think these continue to be good strategies going forward, Miles. And again, depending on what the market brings us in this fourth quarter, if we get the stimulus package or not, if the Federal Reserve continues to fuel asset price surge or not, that could also give us the opportunity to engage further in the markets in a very pragmatic way, which I think one must do, because my view, Miles, is that this is really a very stimulative environment, which over the course of the next few years, we will see inflation as a result. So that's why I'm telling our clients, look, gold has retraced very nicely after it's massively overbought a position a few weeks ago. It's a good time to go long, good time to go buy tips, time to buy some put options, and even not a bad time to raise a bit of cash.
And so we're talking about a number of the macro trades in the market. We haven't yet mentioned the dollar, which has had such a huge move over the last couple of weeks. And we've talked about it a lot on this program, is really influencing for some time there, day-to-day trading action. It seemed like everything was tied to, a dollar rally or a dollar unwind. How do you see that fitting in to the setup here?
Well, I think long term, of course, the dollar is going to face a weakening trend. But over the near term, if we get a second bout of the virus, or if we get some conflagration with China or a contested election, then the dollar will be near term positive for the dollar. Not to mention, of course, that the DXY is more than half comprised of its relationship with the euro. So if we were to see London close down or Europe revert into economic closure, then of course it would be fuel for the positive for the dollar. But I certainly think over the long term that the higher deficits, higher debt, a monetary policy that's certainly nothing but expansionary. And I think fiscal packages is in the docket. I mean, that's coming. That's going to be in the next few months or more. And if one compares this, Miles, the reaction to COVID-19 versus, say, Lehman Brothers or the European crisis, the fiscal response makes those things look like child's play. So I think we do have to be smartly positioned, but positioned to the extent that we continue to enjoy the wake of the Federal Reserve's asset purchase program without missing out on further opportunity costs.
And so you mentioned, that fiscal stimulus, and I don't even know where the headlines stand now, because it seemed like there was a new one every hour during today's session. But you mentioned that it's likely to come to pass. I mean, as you think about, excuse me here, if you think about, next year for GDP growth, are you looking at a number 5-6%, something like the Fed has kind of forecasted there?
Well, I think economic growth is going to be spotty in 2020, especially given the base effects. So 1Q -6, 2Q -30, 3Q is going to be probably +30, 4Q maybe +6. Then 2021, I think, is going to be more tumultuous than a lot of guys are anticipating. I think that the economic recovery is not fundamentally based. And in fact, if you look at, for example, in the month of April, when the Fed first came with its stimulus checks, Miles, the important thing to realize is that a lot of the consumption has been fueled by these checks, by the Federal Reserve zero rate policies and by the CARES Act and the multiple fiscal stimuli. So I think it's wrong to suspect that there won't be additional stimulus, given that is what has taken us to these levels. And I think that the government is unlikely to risk a retracement in the economy because we suddenly get fiscally responsible.
All right. Catherine Rooney-Vera is the Chief Global Market Strategist at Bulltick. Catherine, thanks so much for joining the program. Always great to get your thoughts.
My pleasure. Thank you.
All right, coming up on the other side of this break, we will keep our eye on a market here rallying on the first day of October. Plus, got our call of the day talking about Deutsche Bank's latest note on Zillow. We're back with more on that in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's go over to Jared Blicker now for a look at where things stand in the market. About a half hour to go in today's trading session, Jared. Jared, you're muted.
I guess I just blew my one chance for October on the very first day here. All right, let's take a look at the Wi-Fi Interactive. We got Apple up 0.6%, but Amazon really knocking it out of the park. That's up 2% right now. Microsoft and Alphabet each up more than 1%. And just looking over the last 6 months, Amazon really nice run here, up 68%. If you take a look over the last 2 months, we did have that dip into the 3,000 level, but we're up and away from now. Let's take a look at the Dow as well, and then we'll get into some sector action. Walmart's a standout. It's up over 2%. Some of the industrial names had been having trouble, but I would note Boeing is up 1%, while Honeywell down 0.8%. And here are our sector leaders. We got communication services and discretionary, two FANG-heavy sectors. Those are in the lead, followed by real estate and tech. And then to the downside, we talked about energy earlier. Just kind of a disaster there, down another 3%. Seems like it's 2 to 5% down almost every day, but also seeing materials down over 1%. And looking at our leaders, our canaries, retail is at the forefront. XRT up 2.3% on the upper left there, followed by chip stocks. We've been talking about the strength in that industry. And then followed by software. IGV is that tech software ETF. And that's up 7% over the last 2 months. Over the last 5 days, up nearly 6% there. Then we have IPO. That is the Renaissance IPO ETF. And this hit a record high today. And just looking at what has happened year to date, that's pretty incredible that we're seeing the heaviest month for IPO issuance, and that was in September, of all time. So we had a couple of new entrants today in the market, and we can take a look at how those are doing. The first, as we pull up here, is Mission Produce. That is up 14% from its IPO price, and Pulmonex, that is up 110%. We had 100% pop on that opening tick. And then also Defiance Next Gen SPAC IPO. So finally, we have an ETF for SPACs. Made my day.
Jared, it was only a matter of time. And I know you saw earlier, Trump administration is looking to bring rare earth metal mining back to the U.S. We're bringing all the bubbles of the 2010s back. Hopefully there will be a rare earths SPAC. And then, I don't know, Dan Roberts will tell us how that relates to crypto and daily fantasy somehow, but we'll save that for a later conversation. All right, let's turn now to our call of the day. Today, we were talking about Deutsche Bank's latest note on shares of Zillow. The firm maintains a buy rating on the stock, raising their price target to $140 per share. That's up from $115. And we're joined now by Deutsche Bank research analyst Lloyd Walmsley to talk about this call. So Lloyd, thanks for joining the show. Let's just start with kind of the way you guys opened the note here and referencing Opendoor, a company that came to the markets via a SPAC just in the last couple of weeks, and how, I guess, in your work that maybe sets or helps investors understand a little bit better where Zillow is at right now.
Yeah, so we've been having a really tough time valuing the core home segment that the company rolled out a few years ago, where they're buying houses, fixing them up a little bit, and reselling them. It's a venture-like business. I mean, they're investing a lot of money. It's not going to be profitable for several years. We've had trouble valuing that. That is essentially what Opendoor is, and Opendoor we can now get a valuation on through the IPOB SPAC that is agreed to acquire it. And so we use that now to help value Zillow's business, and it's compelling. It's worth almost $50 per share for Zillow for that business, and that is the primary reason we took our target price up today. Although there's lots of other reasons we're bullish on the stock over the next year beyond that.
Yeah, well, I mean, if you look at Zillow, they've had a number of catalysts within the last year, and I guess we could kind of take them in order. I would ask, just to kind of start, and maybe this steps back from the pandemic, but Rich Barton rejoining the business. Is that an event that kind of started to maybe change the way investors thought about it? And then maybe we can talk about how COVID and the change that people have in terms of their homes has set the business on a different, or at least the stock on a different kind of trajectory.
Yeah, I do think Rich Barton coming back changed the perspective on the stock. I mean, it's always been a very controversial stock with some ferocious bulls, some ferocious bears. And when Rich came back, I think there were questions around this iBuyer business, but a lot of the bears immediately said, I don't want to short Rich Barton. And so that was the beginning, I think, of a lot of covering in the stock. And then, at the end of last year, the company really started to fix a change they had made to their core advertising product in early 19. And so they really got the product right. And if you go back to when they reported the first quarter, while the pandemic had started, they said January and February had seen nice acceleration. And so they were really on a great trajectory before COVID. We saw a freeze up for a minute during COVID, and now everything's bouncing back spectacularly in the real estate industry. So that's been kind of the most recent evolution, I think, in the Zillow story.
Lloyd, Dan Roberts here. Let's stick with the pandemic. I mean, to what extent has the pandemic and that supposed suburban exodus helped Zillow and all those other businesses? I feel like we've done a few segments here on our live shows during the pandemic about the various companies that either have started offering more services for or have just launched to offer the service of virtual house tours. And more people are making the decision without even going to visit a house. Has Zillow benefited from that? It actually sounds like more of the plus column for Zillow came before the pandemic.
Yeah, it's a great point. It's a bunch of pluses. So for starters, it's harder to go out and see houses. There's more activity going on through Zillow's website. It's harder for agents to hold open houses where they get a lot of their new client leads. And so they're more dependent on Zillow. There's been, a burst of activity in people coming out of COVID looking to move. We've done a lot of survey work internally at Deutsche Bank on the likelihood of people both wanting to work from home more even after COVID, and then looking to potentially move to a house where they get more room because they can work more from home. In our note overnight, we highlighted recent survey results showing an increasing percentage of people that we survey, their employers are more comfortable even after the pandemic working more from home. So, we think this can unleash an elevated amount of moving for the next few years coming out of this. Obviously, we'll have to see once we get a vaccine, do some of these, intentions fade, but at least everything we're seeing right now, there's a lot of interest in people moving to more suburban locations, where they will tolerate a longer commute because they intend to work a little bit more from home. They want more space. And so I think that's really bullish for Zillow.
And then thinking about some of these structural tailwinds, Lloyd, I guess for Zillow, the housing market itself, when you look at supply demand dynamics right now, I think there were 3 months supply of new home sales, per the census's last report, which is essentially nothing on the market. Does that sort of dynamic help a company like Zillow, where most people there are going to be scouting an existing home or neighborhoods in most cases that are already built up, and it's kind of a again, it's an existing home type market more than it is a developer buying a new plot and selling it off kind of situation.
Yeah, I think it would be better for Zillow if there was more supply on the market and effectively enabling more transactions to happen. Ultimately, their agents are buying ads on Zillow, and the way they evaluate those is, did I get a close coming off of this lead from Zillow? So I do think more supply would be good, but I think you make a good point. Most of Zillow's business today is people focused on looking to buy, and so if it's harder to buy and they spend more time on the website and ultimately, connect with an agent, there's still a lot of value in that. And so they're not quite as directly tied to transaction activity as one might think. So they can thrive in a low supply market, but it would probably be a net positive if we did see more people coming to market with inventory.
All right, Lloyd Walmsley, analyst with Deutsche Bank. Again, firm out with a new price target on shares of Zillow, $140 per share. Lloyd, thanks so much for joining the program. We'll talk soon.
Thanks for having me.
All right, coming up on the other side of this break, we'll do a quick preview of tomorrow's big jobs report. Stephen Blitz of TS Lombard will join us for that conversation coming up here in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udman with you in New York. Well, it is a Thursday, so we know we got initial jobless claims this morning. Still more than 800,000 people filing for unemployment insurance. Earlier this week, we saw private payrolls jumped by more than 700,000. So how are we to think about the state of the labor market as we head towards tomorrow's big jobs report? For more on that, we're joined now by Stephen Blitz. He's an economist over at TS Lombard. Stephen, let's start then with tomorrow's jobs report, what your expectations are, and what data, I guess, you've taken in over the last month that you've deemed most important in thinking about the state of the labor market recovery.
Well, I think there's two, as there's been since the beginning here, there's two labor markets, right? So I think that the overall numbers are going to improve. We'll probably see something like 1.5 million new jobs, net new jobs, and that'll get everybody excited, and it'll continue to keep negotiations stalemated in Washington over the stimulus package. But the real number that we need to focus on is the number of people who have lost their jobs or claiming that their jobs loss is permanent as opposed to temporary. That keeps going up. It's over 4 million now. It's clear recession territory. When I look at the unemployment rates by the different job sectors, it's clear that what's occurring is that the people who originally said that their jobs loss was temporary is now permanent. And that means that you've got a lot more people who are sitting there in need of unemployment insurance, in need of care, in need of the government continuing to ring fence the economic, or I should say the income impact of that group, because it's a lot of people. And, and if government fails to do that, then this thing leaks out, right? And this isn't your typical recession. And that's one of the reasons why so many narratives continue to fail. Why, for example, you have high unemployment and high consumer confidence. Because when we look, we'll see, and this probably is going to improve again on Friday.
Mm-hmm.
Leisure and hospitality employment is still 25% below where it was in January. But for most other industries, it's around 5%. Mm-hmm. So you've got one group in depression and another group in a very mild recession. And that matters a lot in terms of policy, matters a lot in terms of impact, especially when we know that it's the lowest income. Yeah, go ahead, Michael. I'm sorry.
Right. No, I mean, and I wanted to ask, about the kind of the K-shaped recovery. I think we can all agree is kind of the consensus now. I mean, shoot, Joe Biden's talking about it in the debate. I think that probably is consensus at this point. And one point where we see an interesting dynamic was this morning with the savings rate, the way that household savings came down. Now it's still higher than pre-pandemic levels, but there's basically, you could run the math. There's 2-3 months cushion that people have to draw down some of the benefits from the CARES Act until we are, at the breaking point, I guess we could say, of people who have gotten enhanced assistance and, rent relief, things like that, that will run out. And so I guess, I would ask, are we maybe understating, is the market maybe understating the urgency behind the situation in the economy right now?
Yeah, I think they're understating it. I think Bethany, they're misunderstanding it. So, in the top quintile is 30-odd%. The top 40% of income earners is 60% of consumer spending. The bottom 20% is 9% in terms of income. And so what that means is that right now, the stock market is more important to consumer spending, and the equity market is high. It makes expectations high. So retail sales look great, even though you have really probably like 10, 11% unemployment rate. What the misunderstanding is that the reason why all that can work together is that fiscal policy ring-fence that impact, right? So this isn't a downturn because of economic malfeasance, right? This isn't 2008. This is a mandated shutdown of activity that is still, it's not as mandated as it was back in the spring. That's why half the people who were unemployed then are back employed now. But you still have a tremendous number of people who are unemployed. They're at the lower end. You're ring fencing that economic impact. You tear down that fence, you open those gates, and now you start getting the bankruptcies that start traveling up through the commercial real estate system, that start impacting the banks and on and on and on, then it will begin to become a problem. And that's why Mnuchin and Powell were in front of Congress a couple of weeks ago saying, you got to keep up with this. You have to keep up with doing this, because if you don't pay people, because these people aren't out of work because they did something wrong. They're out of work because the government said where you work can no longer be open.
And I guess in thinking about this as well, the market has taken a very positive view on what a vaccine could mean for 2021 and reopening a lot of these businesses. We're talking, you and I are both sitting in Manhattan, and we see all the businesses that support large office buildings that are not open and haven't been open, and who knows when they will open. Is the market maybe being too bullish on what a vaccine does to those sorts of businesses that have been closed for 12 or 18 months at that point? And just turn the switch on, just turn the lights on to bring everybody back. It's going to take a very long time for the positive impacts of a vaccine to make their way into growth. And our lawmakers also being too complacent about that kind of timeline.
Well, that's exactly right. So if you take away that income support along the way, when the office building fills back up again, if that guy who was there has gone bankrupt and is shut down, you have to find somebody who's going to rent that space and start that business. And who in this environment is going to recommit that capital to do that when you don't know if in a year some other virus comes around, and then you're stuck again, and then you're out of business. So there's a lot that needs to be done here that in terms of income support to keep that going. And if you fail to do that, if government fails to keep that income support going, you do set up for a bigger problem next year than the markets are anticipating. Now, if the fall winter isn't that bad, and in terms of the virus, and we can paint a very good picture that by the spring things are doing a lot better than we anticipate. And that's why Powell has said, and I mean any intelligent person would say, the virus is still in control of the direction of the economy.
Yeah, and it certainly feels like, and I'm sure as well as anybody, a lot of people in markets are tired of hearing that. But I think that Jay Powell is probably right in that.
It doesn't. The problem is it doesn't fit into a model, right? You can't model it. And what the virus does at the moment is it caps how high economic activity can get. So the ceiling on economic activity, so the pace of growth, and you're already seeing the pace of growth starting to slow down sooner than most models forecast, because most models are forecasting that the pace of activity is going to get you back to prior potential. Now, the potential is still there, but it's capped at a lower level because the virus is preventing a certain amount of activity from re-engaging. And in a wealthy economy like we have, leisure spending is a big part of it, right? If you're a small, poor economy that basically manufactures widgets for the rest of the world, you bounce back from COVID pretty quick, right? Because you get back to producing, and you're not a wealthy country. You don't have people with a lot of money spending a lot of money on leisure. That's not what we have here. Leisure is a very important industry. Restaurants are an important industry. All these things, flying around and visiting places. You cut that off. You lower the top in terms of how high the economy, the level of economic activity can get to, which means you start to slow down sooner than what the markets are anticipating. And you lower that cap even more if you allow the income support to that closed off area to dissipate.
All right. A very important conversation. We will certainly continue in the months ahead. Stephen Blitz is a U.S. economist with TS Lombard. Stephen, always great to get your thoughts. Thanks for joining the show.
Thank you. See you soon.
All right. Coming up on the other side of this break, we'll keep our eye on the market here. About 7 minutes to go in today's trading session. We are back with more on that in just 2. All right, welcome back to the final round here on Yahoo Finance. Got about 5 minutes to go in today's trading session. Let's take a look at the price of Bitcoin. Today we've got Bitcoin off about 1%, trading above $10,000, 10,600 right now at about 3 o'clock Eastern time. But really the story in the crypto space this week has been what's happening over at Coinbase. The company's CEO publishing a memo over the weekend outlining the company's new set of values, and then the company making an offer to employees that if they didn't like what Brian Armstrong said in that Medium post, they can hit the road. Dan Roberts, really a fascinating story to play out. I guess on the culture of Bitcoin continuing to redefine itself, I thought about this in the context of Palantir going public this week. I mean, how are you kind of making sense of this news?
Yeah, Miles, I view the Coinbase memo as really a symptom of the larger Silicon Valley crisis right now. There is a reckoning, a political crisis happening with all these companies. They're wondering, should we stand for something? Should we take a stance? And boy, we have talked to death in the last 4 years about how political corporate America has become and how so many brands have been pushed into politics, sometimes not by choice. And so as a result, many brands have chosen proactively to come out and take a stance on social issues, on racial justice. Brian Armstrong's memo basically said, we're never going to do that. We want to be apolitical. And the term he kept using, the euphemism, was mission driven. Well, what is their mission? Coinbase says our mission is to build cryptocurrency products. But that really is the key meaning there is they want to make money. It's naked capitalism, and that's okay. There's nothing wrong with that. Coinbase's mission is to make money. The company wants to be the Goldman Sachs of cryptocurrency. It is expected in the next couple of years to go public. I'm sure it'll be a big, much hyped IPO. But at this time, a lot of employees did not like that memo. And clearly the company is having an internal crisis. And so a few days after the memo, Brian Armstrong sent out, here's our exit package we're willing to offer you. If you want to leave, that's okay. If you don't like our mission and you don't like our stance right now. But it is, to me, symptomatic of what lots of Silicon Valley companies are going through. Palantir is a good example. And in many ways, Brian Armstrong in this memo comes off a lot like Mark Zuckerberg, which right now is not really a great thing.
It's not great, but at the same time, he didn't wait until his company had 4 billion users or 3 billion users or whatever to then decide maybe there are some consequences with the platform. So again, I think certainly a culture story, as you note correctly, that is going to play out, has been playing out in the Valley and will, I think, as remote work and all these things that COVID has accelerated continue in the years ahead. All right, coming up on the other side of this break, we're going to have the closing bell live from the floor of the New York Stock Exchange. We're back with that in just 2 minutes.
Welcome back to the final round here on Yahoo Finance. I'm Shauna Smith. A choppy first trading day for the month and for the quarter as it stands right now. The Dow on track to close in the green, up just around 45 points, give or take a little bit. S&P up just around 0.5%, and the Nasdaq, it's been the outperformer all day, still the outperformer into the close, up just around 1.5%. And that does it for the first trading day of October and the first trading day of the fourth quarter. Again, all three of the major averages closing in the green. The Dow was flip-flopping between positive and negative territory for the last 60 minutes or so, but closing in the green, up just around 35 points. The S&P up 0.5%, and the Nasdaq, the leader all day, up just over 1%. In terms of the sector action, technology, a big outperformer. That's why we're seeing the Nasdaq up by such a wide margin today. But also consumer discretionary and communication services are also outperforming along with tech. On the flip side of things, on the other side of things, we have banks and energy lagging. This, of course, is a continuation of what we saw in the third quarter. On the econ side of things, mixed data, keeping sentiment in check by just a little bit. In U.S. manufacturing front, and U.S. manufacturing activity slowing. Jobless claims better than expected. We did see a week-over-week drop, but not by much. Jobless claims plateauing over the last month or so, still way above those pre-pandemic levels. And then on the consumer side of things, higher spending in August, but we also saw personal income falling by 2.7%, much of that because of the expiration of additional unemployment benefits. So, of course, that mixed data there, keeping some of the gains today in check. But for more on this, I want to bring in my co-host for the next 27 minutes, Miles Udland. And Miles, when we take a look at the action that we're seeing today, we had stocks searching for direction for much of the trading day when you saw at least how the Dow was behaving. But what stands out to you in today's trading action?
Well, I think what stands out more is the headlines we're seeing from DC, and it does sound like stimulus is going to happen. Now, of course, it is possible that if we get a very good jobs report tomorrow, everyone says, oh, see, the economy is doing fine, and then we move on as we had been operating for some time under the assumption there will be no additional stimulus until 2021. But when you look at that income and spending data, Shauna, that you highlighted earlier, where incomes are down, spending moderates somewhat, the savings rate comes down dramatically as consumers draw on the cushion they built up during the summer. We can tell that while things are okay now, that data say very clearly the clock is ticking on the health of the U.S. consumer, which I've written several times over the last, I think, 10 days, that it's quite resilient. I mean, I think that's the best word right now to describe the state of the consumer. But those dynamics it's obvious to see why that is the case. And if indeed we see Washington come through with additional stimulus, I think that's very positive for the economy and by extension, probably positive for markets into the fourth quarter. Otherwise, I think we're still kind of doing what we've been doing for the last few weeks, which is waiting for the election to happen, see what happens, and then we can talk about markets from there, whether we get to record highs again, whether we see the market correct further. I know Jared will talk about the positive nature of the technical setup today, and indeed it has turned around. But I am, again, I think just surprised by where the fiscal conversation has gone just in the last couple of days.
Andy, you're muted.
Sorry about that. Happens to the best of us and the worst. So just to pick up on what Miles was saying, yeah, stimulus front and center day after day after day after day. But just to give you a sense maybe of some urgency here, I was doing a Zoom call with Eric Garcetti, the mayor of Los Angeles, with a bunch of other mayors and CEOs. And the mayor picked up his phone while he was talking to it. Like he just went like this. And I was like, that's not right. I mean, you don't do that, right? And he apologized. This is all real time. He goes, I'm sorry, that was Treasury Secretary Mnuchin. And so, there's stuff going on. There are conversations, as Woody Allen used to say, right? But unless, of course, he was looking for some help in his motion picture business, which, of course, Steve Mnuchin used to be in. But no, I mean, in all seriousness, I mean, there's some urgency here. With Nancy Pelosi and Steve Mnuchin, it remains to be seen whether they're going to get in across the goal line here. The other point I want to make is just with regard to layoffs, which we've been talking about this week, which is really taking the turn for the worse. I don't think it's any coincidence that we're heading into the fourth quarter here So not only are things getting better necessarily with COVID, and in some instances, Wisconsin, New York, they're getting worse. But, from an accounting standpoint, I just, boy, what do companies like to do in the fourth quarter? Clean house. And so I don't see this jobs picture necessarily getting much better over the coming weeks and months, unfortunately, Shauna.
Yeah, it's interesting there because we've been talking about the fact that we saw that first wave of layoffs a couple of months ago. Miles has brought up a couple of times just in terms of the white collar jobs that could be lost and probably will be lost over the next couple of months. We certainly are seeing some of that at least take place over the last couple of days. But Jared Blickery, I want to bring you in very quickly. Miles mentioned you a couple of minutes ago, just talking about the technical setup and what we're seeing at least from, I guess, the past 24 hours, what we saw today in trading, it at least looks positive. I guess you can put that spin on it when you take a look at the fact that the Dow eked out gains today, S&P above its 50-day moving average, and the Nasdaq by far the leader, up almost 1.5%.
Yeah, I'd say fairly constructive day here. And Steve Mnuchin, I got to get back to this guy. But we did close above the 50-day moving average today, and this is the S&P 500. I think I've said this way too many times over the last few days, but 1410 is the resistance point to look at. You look at the Nasdaq, even better, because it has now cleared this resistance from early September. I still believe that S&P 500 level is going to be more determinative of where the market goes next. But we'll also take a look at the Russell, which was up 1.38% or 1.3% today, and it's right at that. At its very own deciding level right here. So I think in the month of October, we're just going to have a lot of back and forth, probably end up frustrating a lot of traders to the upside and the downside. And that's what everybody's pretty much expecting right now.
All right, Jared, we'll let you get back to that very important phone call that you had there. All right, but for more on today's action and really the setup that we're seeing as we begin the fourth quarter, we want to bring in our first guest. We have Jason Draho. He's the head of America's Asset Allocation at UBS Global Wealth Management. And Jason, you heard what Jared was just saying, just in terms of the technical setup, coming off a pretty weak September. It's the start of a new quarter. What are you telling your clients? Where are you seeing opportunity in the market today?
So, we've had a challenging month. I think the narrative of the market has changed a little bit from a tech-induced kind of sell-off at the start of September, where it was very much kind of technically driven, to what we've seen over the past, I think, 2 weeks is something that the markets are more focused on the growth outlook. And you had some data points earlier that you described for today where some were good, some were mediocre. I'm talking about also about the fiscal stimulus. I think what the backdrop we have right now is there's just kind of fairly high uncertainty of what is the growth trajectory for the U.S. economy over the next 6 to 12 months, because if things could go well if we get stimulus, and if we don't, things could kind of deteriorate. And as we get day-to-day news flow on whether we get a fiscal package or not, news on the vaccine, on COVID, all that kind of shifts the distribution around of where could growth be. I think that's going to lead to the choppiness we're seeing in the markets, and the election uncertainty is all part of that. I think the fact that we're getting maybe a little bit more glimmers of hope of a fiscal deal possibly before the election, but I think increasingly likely after at some point. I think the markets are sort of moving on that news right now. But if we don't get positive news in the next 2 days, no stimulus before the election, then it may not be until the first quarter of next year, and the market's going to kind of pull back. So that to me is the key thing that's kind of driving the overall narrative in the markets right now.
Hey, Jason, Rick Newman here. Just to take this perhaps 1 degree further, there is a scenario out there in which there is no stimulus now, but Joe Biden wins the White House, Democrats take control of the Senate, and we get an even bigger stimulus bill early next year than we've been talking about right now. Is that something that investors are contemplating yet, or is that just one turn around the bend too far?
So I think it's something that it's interesting that you're seeing that narrative and people start talking about that possibility a little bit more. If we go back 2-3 months, the fear among investors was, if we get this sort of blue wave scenario, that you're going to get taxes going up, the markets are going to sell off 10+% because of higher corporate taxes, personal taxes. So that would be negative for the markets. As we get close to the election, and I think it's also because we haven't had fiscal stimulus when we thought we'd get something in the summer, and then by September, if we don't get it, I think it increasingly puts the focus on, for the Democrats in that scenario, like, let's pass more spending first and deal with taxes later. I think for the markets that are coming around to the possibility that the blue wave may not be as negative as they anticipated. And in fact, if we get a lot more spending, if we get like $2+ trillion by next February, that's good for growth, especially if we don't get tax increases, which is probably not going to happen, at least in the first go around.
Jason, when you talk about all the uncertainty that's out there in the market and there's more signs or there's obviously those risks that still remain, if you take a look at how the market has been behaving, a lot of those typical safety plays haven't been working when you take a look at what's happening in treasuries or what's happened in gold over the last month or so. So if you are looking at for safety in this environment over the next 5 or 6 weeks, where do you go?
Well, if you're really concerned about the next 5 or 6 weeks, I think the only way to really kind of protect your portfolio is to de-risk in some way, like take down kind of equity positions. If you don't want to do that, then you're buying sort of protection through options, things like that. That's pretty expensive because the market's anticipating volatility, so it's not cheap to buy that. I still think that one of the best hedges out there is if you buy long duration treasuries, like 20 to 30 year treasuries, because they can still do decently well if we get a growth off scare. And just to give an example, if we look at last week, for the most part, equity markets and risk assets were down, gold was down, but the 30-year yield dropped about 5 basis points. So a long duration bond was up about 2% last week, which is obviously not a huge amount. But if the 30-year went from like 1.4% to like 1.2 or 1% in a real true growth scare, you could be up 10, 15% when everything else is probably going to be down. So that's one area I think it still has some juice in terms of providing protection to the portfolio, but you really got to kind of go out of the further out of the curve to get that kind of protection.
All right, Jason Draho, head of America's Asset Allocations at UBS Global Wealth Management. Great to talk to you again. Thanks for joining us.
Thank you.
Up next on the final round, a new national poll following the first presidential debate on Tuesday night. We'll tell you who's got the lead right after the break.
Is like,
welcome back to the final round. A new poll showing that Joe Biden is widening his lead over President Trump in the 2020 race. A CNBC Change Research survey released today showing that Joe Biden is garnering 54% of the vote to Trump's 41%. And Rick Newman, once you also go through this poll, it also breaks down the performance that we saw on Tuesday, just in terms of what voters are thinking. The poll showing that 53% saying that Biden won the debate the other night.
Yeah, that's a big number. I don't think even the Biden campaign thinks Biden won the debate by that much. I mean, he survived, let's put it that way, and he didn't declass himself the way Trump did. So that's a net gain for Biden. But what's really happening here, Shauna, this poll shows a bigger margin for Biden than a lot of other polls, and it could be overstating Biden's lead a little bit. But I think we are seeing Biden widen his lead, even if it's in the, in small percentage numbers. It's just looking more and more dire for Trump. I'll throw in 2 other data points here. the Center for Politics at the University of Virginia, which is one of the top places that tracks the electoral vote, they now say they're estimating Biden has 279 electoral votes based on the way they think states are going to vote. And Trump only has 179, and there are still 80 toss-up votes. So you need 270 to win. So they're already forecasting that Biden's likely to have enough electoral votes to win and possibly win handily. And the last thing we were just talking about off air, Scott Adams, who created the Dilbert comic strip and has been an unabashed Trump supporter, today said he's no longer supporting Trump because of Trump's support for white supremacist groups. So not looking good for Trump.
Rick, I think everyone is still viewing the world through a 2016 lens. And so they say, oh, well, all polls are actually 49 Biden, 51 Trump, regardless of what the headline number is. Can you maybe briefly summarize how different the situation is now with polling averages and national polling between how Biden is running versus Trump versus how Hillary Clinton was polling against Trump?
Yeah, I can. Everybody knows that surprises could happen, and no one should ever think this is a done deal, even if it's even wider than this margin on the night before Election Day. But Biden leads Trump by more than Hillary Clinton did at this point in 2016. And he has some other things going for him that Hillary Clinton didn't. One important one is that his unfavorability ratings are much lower. People don't overwhelmingly love Joe Biden, but there aren't a lot of people who dislike Joe Biden. And we know from a lot of anecdotal reporting and data in 2016, a lot of people voted for Donald Trump just because they wanted to vote against Hillary Clinton. And there just are not that many people who want to vote against Joe Biden. One more thing I'll toss in is the Democrats, the party itself was fractured at this point in 2016, with Bernie Sanders very bitter, feeling the party had kind of cheated him out of some votes. That is not happening this time around. Sanders, Elizabeth Warren, AOC, that whole wing of the party is behind Biden. And let's remember, 12% of Bernie Sanders, people who voted for Bernie Sanders in the primaries in 2016, actually voted for Donald Trump in the general election. That was kind of an embarrassment for Sanders. And I think he's actually working hard to make sure that doesn't happen this time. So it could still go either way. But Joe Biden has advantages that Hillary Clinton did not have in 2016.
No, well, Rick, when you take a look, I mean, it's been a tough week for President Trump for a number of reasons. Aside from the debate, when you take a look at the poll numbers that we were just discussing, but then also that New York Times story about President Trump and his taxes, the new revelations that President Trump's tax filings in the New York Times, it really exposed more so this bigger issue, I think, and that is something that you're focusing on, and that's the potential problem with the IRS and its inability to really go after aggressive tax evaders. And a lot of times it's wealthy Americans who can afford this type of advice and figure out some of the loopholes. And I know you crunched some of the numbers for us. So one, why is this the case? And is this something that needs to be addressed? And I guess, how do you address it?
I think it needs to be thoroughly addressed. I mean, we basically have a tax enforcement system that does not work. And it lets wealthier people get away with paying less tax than they owe. It's that simple. So, people who are looking at this story about the taxes Donald Trump doesn't pay, they might be wondering if this is all wrong, why does the IRS let him get away with it? And it's a great question. And there are answers. So funding for the IRS, which Congress appropriates, has been dropping every year since 2011. And that's mainly because Republicans hate the IRS, and they have controlled one or both houses of Congress every year since 2011. So they've had the leverage to either block funding increases for the IRS, or in some years actually cut their budget. And so the IRS funding is down about 20% over that period of time. And the manpower, the person power, I should say, is down even more, because it just takes a lot of labor to do the kind of audits it takes to catch people who are cheating. So in one instance, the tax experts who do the most sophisticated audits, the number of those people at the IRS has dropped by 48%. So they only have about half as many of those people. Wealthy people know this. They amass, expensive lawyers and accountants, and they just outman and outgun the IRS. So the IRS just cannot keep up with all this. The government is losing about $130 billion per year in taxes that people owe, and the IRS just can't collect.
Hey, Rick, quick follow-up question. And I think that President Trump was trying to suggest this, that, there's this whole notion in the United States that, don't tax the rich so much because, and that's acceptable because people aspire to be rich in America, right? Do people aspire to be tax dodgers? I'm not saying tax frauds, tax dodgers and tax avoiders. I mean, President Trump seems to be saying, hey, look, this is what you should do.
Yeah, I think the answer is yes. I mean, I think we all want to pay the least amount of tax we possibly can. And even Joe Biden, who paid $300,000 in taxes in 2019, that was a tax rate of about 33%. Even he has set up these two S corps to handle the money he gets from book royalties and speaking fees, because you actually you actually pay less tax if you're able to do it that way, just because of technicalities in the tax code, than if you just take the checks and put them right in the bank and declare it as ordinary income. So I think there are multitudes of problems here. One of them is that the tax code is just too complicated, and that favors people who can afford to hire the experts who know where all the tax breaks are. But we had this big debate in 2017 about should we cut taxes when we're not even collecting all the taxes that people legally owe. So, I mean, Democrats, if they are able to take power in Washington, they do want to beef up the IRS and improve this performance. And look, the government needs money. I mean, I couldn't believe it when I looked it up today. The national debt is now almost $27 trillion. So at some point, we're going to have to find ways to get new revenue, and this is one of them.
It certainly is. All right, Rick Newman, thanks for breaking that down for us. All right, coming up here on the final round, how one of the biggest food festivals in the country is adjusting to the new reality in the wake of the COVID-19 pandemic. New York City Wine and Food Festival founder, he'll join us right after the break. Welcome back to the final round. Well, indoor dining returns to New York City this week, but a new report from the New York State Comptroller's Office showing that how dire the situation still is, warning that up to half of the city's restaurants and bars could close for good because of the pandemic. So for more on how the restaurant industry is navigating the pandemic and also how it's impacting live events, we want to bring in Lee Schrager. He's the founder and director of New York City's Wine and Food Festival, which gets underway tonight. And Lee, I first just want to talk about the pandemic's impact on the restaurant industry, because I know you speak with chefs, with the owners. Many of them are involved in your festival. Just give us a sense of how they're feeling right now and how they're navigating the challenges of the pandemic.
Thanks, Anna. On a good day, it's hard to make money in a restaurant, especially in New York City with union and the high rents. So it's incredibly hard. That when you take, that these restaurants have been closed for many months and they've had minimal outdoor seating, and now they're allowed to do 25%. A restaurant can't survive off of that. Unlike where I live in Florida, where the governor did the exact opposite and opened everything up. I don't agree with that either. But I will tell you, it's going to be tough for these restaurants, if they don't open up indoor dining for significantly more people, before it gets really cold and impossible to eat outside. I just fear that some of our favorites, some of the small mom and pop restaurants, some of the white tablecloth restaurants just won't be able to survive or hold on.
Well, it's interesting because we're talking about how restaurants have had to pivot their business and make the necessary changes in order to survive. New York City Wine and Food Festival starting tonight, which you're behind. You've had to restructure things. What is it going to look like this year? And how has the past couple of months been trying to plan an event like this?
Well, it's going to look and feel different, but our message will remain the same: to eat, drink, and end hunger. The festival benefits the food bank for New York City and No Kid Hungry. We kind of spent the summer saying it's going to happen, it's not going to happen. We're going to go live, we're going to go virtual, we're going to do this, we're going to do that. And finally, our tickets for the New York Festival normally go on sale in June. We have 4 months of selling. Our tickets went on sale 2 weeks ago because we really held off as long as we could, waiting to hear if we were going to be able to do any outside events, obviously following every protocol and policy that we had to. And about 2.5 weeks ago, I just said, this is not going to happen. And we pivoted everything. We're doing all the culinary demos. We're doing, a whole series, 40 or 50 culinary demos with some of the greatest names in the world, not just in New York, but throughout the country. And we have chefs joining us from Paris, France, and Spain doing culinary demos. We've introduced a new virtual series called Cook from the Book that will kick off tonight with Martha Stewart. October is normally that month when a lot of new cookbooks come out. So there's a whole series where you can sign up, take a virtual class with a Martha Stewart, a Yotam Adalenge, a Jeff Morrow, a Thomas Keller, and cook along with them right from their book and receive a copy of their book the day that it comes out. It will be in your mailbox. We're also doing our signature event, the Johnny Walker Burger Bash, which would normally be a live event. We normally would be on the roof of Pier 92 and have 3,000 people spending $200 a ticket next Friday night, and we have gone virtual. We are going to do it in a catering commissary in Bronx. We're going to have the last 5 years of winners, the top chefs in the city who have won the Burger Bash. They'll be doing it live. We have a panel of judges. Elvis Duran in the morning show will be picking the judge's choice. Then consumers will be able to vote on their favorite burger at home. If you sign up for the class, you get a box of burgers and Cabot cheese, and you get Martin's potato rolls and Pat LaFreda meat, so you can make the burgers along with the chefs that night. And also a Johnny Walker kit, so you can make the cocktails along with the professionals that night. So you can eat and drink at home. You don't have to get dressed. You can just watch it on Zoom that night and enjoy it, and then ask questions as we go along.
All right, well, Lee Schrager, unfortunately, we're out of time. I know it's been a challenging couple of weeks, but it sounds like you guys have a couple of fun events lined up. So we wish you all the best. Thanks for taking the time to join us today.
Thank you so much.
All right, coming up here next on Yahoo Finance, be sure to stick around for our latest weekly special 2020 A Time for Change. Today, we're going to be talking to NBA star and also fellow Lehigh alum CJ McCollum. He'll talk to us about his new show, Remaking America. That's coming up in just 2 minutes.
Sorry about that, guys. I was muted. Welcome to Yahoo Finance. I'm Kristen Myers, and this is 2020, a time for change. The racial tensions and the protests over the last several months have underscored the need for justice for the Black community. Earlier this week, a new fund called Black Voices for Black Justice was launched by dozens of Black leaders in the hopes of making change to the criminal justice system, education, voting rights, and more. We're joined now by one of the fund's leaders, Kristen Clark, President and Executive Director of the Lawyers Committee for Civil Rights Under Law. In her role and throughout her career, Kristen has worked on issues like voting rights and election law, fair housing, and more. As always, Bill Marcellus and Jen Rogers are here for today's conversation. So Kristen, thank you so much for joining us today. I want to start with that news of the fund, which launched just a couple of days ago. We've seen over the last several months, companies like Netflix, Facebook, and others donate millions of dollars to organizations and causes to increase racial equity. I'm wondering if you can explain why it's so important to have a fund like this by Black people for Black people, and what it can do that those donations from those companies can't.
Well, first, thank you so much for having me. And I think there's something special about this moment that we're in 2020. In many respects, we're a nation at a crossroads contending with racial justice and police violence and the rise in white supremacy. And for me, as a civil rights lawyer, I know that the power of grassroots activity and the power of protest are really critical to driving movements. And if we look around us, no doubt there is the largest, I think our nation's largest racial justice movement underway right now, the largest movement of its kind that we've ever had in our nation's history. And to me, for this movement to really sustain itself and to grow, we need to support the folks on the ground right now that are doing the work, the ones that are rolling up their sleeves, the ones that are organizing their communities and leading marches and holding peaceful protest. So that's what this fund is about, really giving some of those new leaders and emerging voices the support that they need to take their leadership to that next level.
I want to dive into one of the issues that the fund is actually going to be working on, which is voting rights. And I know that you work on voting rights in your current role, and it's something that you've actually tackled throughout your entire career. I want to read this tweet to you from the president. This is from back in July. He said, quote, "With universal mail-in voting, not absentee voting, which is good, 2020 will be the most inaccurate and fraudulent election in history. It will be a great embarrassment to the USA. Delay the election until people can properly, securely, and safely vote." I'm wondering if you think that the president's attempt to cast doubt on this election is working, and how are those attacks on the integrity of this election going to impact the Black community, which has historically been disenfranchised?
You know, the president has a mega bullhorn, and sadly, we've seen him use that bullhorn to spread misinformation at every Dow, to promote chaos, to undermine confidence in absentee voting. And it's so troubling because the nation is undergoing an ongoing pandemic, and for many people across our country, the only way for them to have voice is to vote by mail. And I think this is a real concern. Some of the folks that we have supported through this fund are on the front lines doing work to activate people in their communities to get registered to vote, to get out and vote. One of our award recipients is Ryan Haygood of the New Jersey Institute for Social Justice, and he has done some remarkable work to re-enfranchise returning citizens in the state of New Jersey. But, I think there is a powerful connection between the right to protest and the right to vote. And a lot of these activists that we have supported through this fund are doing that work, doing work that really speaks to rights and principles and values that lie at the heart of our democracy and lie at the heart of who we are as a nation.
And I want to touch on the debate that happened this week. Did you find that it energized and helped your work in trying to get as many people as possible to vote either by mail or at the polls? Or do you think it might have discouraged some voters?
It certainly complicated our work a little bit because there are a lot of people who continue to call my organization, the Lawyers Committee for Civil Rights Under Law. We lead a program called Election Protection, which is the nation's largest and longest running nonpartisan voter protection program, anchored by a hotline, 866 Our Vote. And we're getting flooded with calls from people across the country who are saying, is vote by mail a true and trusted way for us to participate in 2020? And so we're doing a lot of work to overcome the myths and the misinformation and really, giving the public the confidence that they need to know that this is indeed one way that you can have your voice heard in 2020. We know for a lot of people, they have been impacted by the pandemic. So many of us have been impacted by the pandemic, and no one should have to choose between protecting their health and exercising the right to vote this season.
No one should have to make that choice. But of course, this is just an unprecedented time. And given what the president said at the debate, encouraging supporters to be looking out at the polls. People are concerned about going not just for their health, but for what's going to be in front of them there. However, even though we've never seen any issues with mail-in voting, now people are trying to say, go and vote in person. These calls that you're fielding, are you starting to change what you're saying to people? Do you think it's important to go and vote in person this year?
We believe it's a deeply personal choice at the end of the day, but what we do is we work to empower people so that they know all of the available options that they have in their state. We want to make sure that people know about how to vote by mail and what are the timelines and restrictions that apply. We want to let people know if there are early voting opportunities. And there's so many people who across the country have already gone out and voted in person during early voting. And then we're letting people know that if you wait till election day, that it's important to check your polling site because so many sites have changed and moved because of the pandemic. There are many, retirement homes, for example, that are no longer being used because of the pandemic. So it's all about empowering people so they have as much information available to them to make the best choice possible for them. And I'll say this, that, we know that for some communities, that experience of going out and voting in person is really important to them. Our hope is that people will take full advantage of all of the available options so that we can ease the burdens that officials otherwise will face on election day itself.
All right, well, we will have to leave that conversation there. Kristen Clark, president of the Lawyers Committee for Civil Rights Under Law. Thanks so much for joining us today.
Thank you so much for having me.
And coming up after the break, a new study from the Brookings Institution shows that there isn't a lack of skills in the labor market, but rather a lack of opportunities. One of the authors of that report joins us next.
Welcome back to 2020, A Time for Change. I'm Sabine Marcellus. New records are being set for job cuts. September saw a 186% increase in layoffs compared to this time last year. Another 837,000 Americans filed for unemployment for the very first time just last week. And this week, from Wall Street to Main Street, employers told their workers that tens of thousands of them would be let go. Joining us now is Annalise Goger, economist at Brookings Institution. Annalise, you recently wrote a report about how the labor market doesn't have a skills gap, but an opportunity gap. Now, given the wave of recent layoffs, how do we close that opportunity gap among Black workers and other minorities?
Great question. Thank you for having me. So, Luther Jackson and I, who co-authored this piece, Luther's based at a workforce development organization in Sunnyvale, California. And we, several years ago, worked together on a project with Tech Hire Oakland, focusing on really interviewing job seekers and finding out what their pain points were in terms of getting into a quality job in tech. And the talent that we interviewed were all underrepresented, either women or Black or Latinx workers. And generally, I was struck by the fact that all of our policies are based around things like skills training, and a lot of it has to do with going through a bunch of hoops to get some help and trying to figure out what program you might qualify for, kind of similar to how people were trying to figure out how to get into UI. Similar thing for a lot of our jobs, of our programs for workforce development. And Luther and I were reflecting on how when we talked to people, a lot of the issues that they mentioned had nothing to do with their policies. And it was things like finding out information about, how does a user experience person get started? What kind of programs do the employers of those occupations like to see better? What are the options that they like to see? That kind of information that you have to be an insider to have access to. And so we started thinking about more recently working with some regions around the country to try to pilot an approach to workforce development that doesn't just sort of take someone who walks in the door and think about what are your barriers? Like, are you a person with a disability? Oh, we have this program for you. Are you a homeless veteran? We have this program for you. But more about like, what are the unique skills and talents and aspirations and constraints of a specific individual, and what can we offer you in terms of a wide range of options, instead of just sort of funneling people into short-term programs that generally we haven't seen very good outcomes in. So in general, I would say we need to take a much more holistic approach to helping people find a new job and transition in their career, because it's not just about skills, it's a whole set of other things.
Yes, absolutely. And I just want to address, Annalise, a recent apology we got from Wells Fargo's CEO. He fell into hot water for reportedly saying over a Zoom meeting over the summer that the reason why the bank can't meet its diversity goals is because there aren't enough qualified minority candidates. Now, do you think a viewpoint like that, he did apologize, but do you think that is a viewpoint that's shared by many hiring managers? And what should Black workers and other minorities do if that's the view at the top?
Yes, I think unfortunately there's a mindset that sees any kind of skill building work that a company does, or investing in education and training, as a charity operation, and it's often segmented off into like corporate social responsibility. So it's not really integrated into the core business of the company. And then when you unpack the hiring process, it turns out that they're fishing from a very small pond, right? They're maybe going to the top 10, if it's tech, let's say, the top 10 computer science programs in the country, and trying to recruit there, trying to hire interns from colleges. So you're already pre-selecting out people that might be actually quite good and quite capable and quite talented in tech, simply because you're going through these elite institutions and not looking at a wider pool. So I think what companies can do is, instead of looking at who's showing up in front of them and trying to make judgments without really understanding all the things that led to that person being in front of them versus someone else, and really looking at their own processes, not just where they're looking for talent, but how they're screening for talent, what kinds of signals are they using in their job ads that might encourage one type of person to apply and not another, and really just making sure that they're taking a more inclusive approach to talent. A lot of times they rely on internal networks. So even if you're a worker at a company, what can you do to broaden your network and reach people that maybe normally you might not refer? It's a little bit of self-awareness of how you kind of are reproducing people that have similar characteristics, instead of being open to more diverse talent pools, which we have a lot of evidence for actually leads to more innovation if you have a more diverse team. And then I think also there's a lot that companies can do to train their managers on how to work better with teams that are more diverse, because I think that's one thing we learned from employers in our work in the Bay Area. As far as talent goes, I think the best thing that you can do is network and go, as if there are events in local community organizations where you can actually meet an employer face to face, meet somebody from a company that you're trying to get into. You have to do informational interviews, and really when you can make a personal connection and tell your story and learn how to sell your skills to that audience, that's really the key recommendation that I have in order to get started in a new field.
Absolutely. Closing the opportunity gap remains a priority as we undergo this economic crisis. Annalise Goger, Brookings economist, thanks so much.
Thanks for having me.
Coming up, NBA star CJ McCollum joins us to talk about how he's tackling social issues head on.
Welcome back to 2020, A Time for Change. Sports and athletes have always had those moments when they are able to transcend our differences and create change. And this summer, we have seen athletes out front in the fight for social justice, voting rights, and so much more. Never one to sit on the sidelines, NBA star CJ McCollum announced yesterday a new talk show he's hosting for Players TV called Remaking America. It's going to tackle social issues head on, and he joins us now. Hi, CJ.
Hello, thanks for having me on. I appreciate it.
You are launching November 3rd. There's a big thing happening that day. It's the day of the election. I mean, I'm excited for that show, but we got a lot going on right now. We just had the debate. So you're going to be kind of taking over our jobs here. I want to put you on the spot. If your show were on this week, what conversation would you be having about the debate and specifically President Trump's comments on white supremacists?
Well, first and foremost, it was tough for me to watch, just as I'm sure it was for everyone else. A lot of going back and forth, a lot of arguing, a lot of lack of maturity being displayed throughout the discussion. But I think that the reoccurring thing that's been discussed, not only on TV, but amongst, some of my circles and from a lot of athletes who were able to watch, is the fact that he refused to denounce specific forms of racism coming from the likes of the Proud Boys, among other groups. And I think that's something that's kind of stuck out, especially to me as an African-American, a member of the Black community who continues to try to figure out ways to fight for us as a whole and as a collective. I think, not being able to do things as simple as that kind of shows you where we're at right now from the man who's leading our country.
And I want to follow up with a question, actually, one of my co-anchors, Sabine Marcellus, asked another guest, which is, do you think that the debate, what was the impact, do you think, on people of color in terms of getting them either excited about going out to vote, or are people, kind of just giving up here? Did the debate make an impact one way or another?
I definitely think, based on what I've heard and seen from, More Than a Vote and some of the campaigns I'm a part of, is that we've done a great job of spreading awareness on the importance of the vote, the importance of each vote, especially the minority vote, and being able to see how the first debate went. I hope that's inspired people to want to go out and try to promote change, inspire people to really understand that it's not only important to vote November 3rd for the election, but some of the local campaigns that are going to be going on, and just understanding the importance of voting in your communities. I come from a small city, like Canton, Ohio, about 70,000 people, but being able to really take advantage of voting in all aspects is extremely important to us. And I think based on what we've seen, a lot of people are inspired and encouraged to go and vote. And if you're not inspired to go vote after that, I don't know what else you need to see.
So, CJ, there's often the frequent criticism that athletes need to just shut up and play. But historically, sports has often been used as a diplomatic tool. The Olympics comes to mind, and as a way to transcend not just borders, but also politics. What do you think that the role is of athletes, particularly in a moment like this one, to have the conversations that perhaps most people don't get to hear, or even to bring to the table folks that often don't get to come to the table?
I think we have a huge responsibility, obviously understanding where we've come from and what we've been able to accomplish to get to this point. A lot of the neighborhoods we grew up in, a lot of those kids, a lot of those families, my cousins, even my brother, aren't treated the same way we're treated. Obviously, we're extremely privileged to be able to be compensated the amount of money we are. We have a different type of spotlight, but we're speaking on behalf of those who don't have a voice. We're speaking on behalf of those who aren't treated the same way we are when we're pulled over. And I think we have a responsibility to not only speak up on behalf of them, but to continue to try to educate people, especially kids who are looking up to us, and to kind of paint that picture of why it's important you read, why it's important you educate yourself on matters outside of what you're comfortable with. And I think me as a professional athlete, I've learned a lot, and I'm ignorant in a lot of ways because I wasn't exposed to some of these uncomfortable conversations that we're now having in regards to voter suppression, education reform, some of the criminal justice issues we have that seems to target Blacks and Browns.
Do you think we've moved past the criticism for not standing during the national anthem? Do you think we've evolved from that point?
I thought we did, and then I watched a football game where the players stood in unison to show that they're supporting each other and to show that they care about equality, they care about spreading the message, and they still were booed. So at that point, I knew that there's just something that's deep ingrained into our society to where, regardless of how you protest, some people are just uncomfortable with you continuing to support Black people, people of color, and understanding the importance of equality. So I think we are past it, but there's just some people that they were raised a certain way in which they will never conform to our realization of equality.
In terms of you as a public person, you're also an entrepreneur. You're out there with your show now. You're a business person as well. What do you want to do with with your show? Is it, what kind of a range of issues and guests, I guess, do you want to have come on?
Yeah, that's a great question. I think that the biggest thing we wanted to do was continue to spread awareness, have those uncomfortable conversations. And it's an educational process for me as well. I'm no expert in the realm of politics by any means, but I think having those conversations, being able to ask those questions and figure out actionable ideas, similar to what we were trying to do in the bubble, figure out ways to immediately impact our society. And one of the things we came up with was opening up some of the polls, opening up some of our stadiums and allowing those to be polls to create larger environments for people. I think, being able to not have games, not have practices on the election day allows us to go out and continue to help. So the show will more so be centered around people who work in politics, activists, professional athletes. Obviously, I love to have authors on, a variety of guests, because the conversations that need to be had need to expand upon so much more than sports. And we need to focus on all the issues that we have in today's society.
CJ McCollum, you are really good at our job. I don't think any of us are as good at doing your job. Thank you so much. And we will be sure to watch the new show. Remaking America is going to be out on November 3rd, which you already have in your calendars. Thanks a lot.
Thank you. Appreciate it.
Yeah, Jen, anyone that's seen me with a basketball in my hand knows that I do a terrible job at that. Well, that is our show for now. Thank you all for watching. Be sure to tune in next week for our next episode of 2020, A Time for Change.